Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's get started with a new chapter called as standard costing, right? Guys, this chapter is a very important chapter from an examination perspective, and this chapter carries roughly a weightage of around 10 marks, 8 to 10 marks in every attempt. Generally, this chapter gets tested. And guys, this chapter is also there in your CA finals, in your self-paced online modules. So it's important left, right, and center from any angle from which you're going to look at, this chapter. This is going to be a very important chapter. And guys, one more thing that is common in this chapter is generally I've seen students mug up this chapter because it has a lot of formulas here. So trust me, nothing of that sort. This chapter is filled with logics, and you absolutely need not take the pain in remembering or mugging up any kind of formulas. Fine, guys? Shall we get started? Yes. Now, for you to get into this particular chapter, you need a certain background. Why we are learning this chapter? Because at the intermediate level, what you're learning is very limited, right? Because at the final level, you will see the entire chapter, but at the intermediate level, you're only actually studying a portion of this particular concept or the chapter of standard costing. So for that, you need to know the background. You need to know why you are studying this chapter. That's the most important thing. Once if you have these things set in your mind, obviously any kind of insight concept that we see in this chapter is going to be super easy for you. Shall we get started, guys? Yes. Now, first of all, our subject has how many objectives? Come on. 3 objectives. Very good. What are they? Stock valuation and profit computation, decision making, control. I'm really amazed by the energy, guys. Good. Fine. So now, guys, this really, I mean it. I mean it. Very good. Please maintain it. It's for your own good. Now, guys, this chapter standard costing helps you achieve the third objective of this chapter, which is control. Right? How, sir? How? That's what we're going to see here. Now guys, every year, or instead of using the word year, I would say period. Every period, because in our subject, I can fix anything as a period. I can do this costing exercise yearly, or I can do it monthly, half yearly, biannually. It's my choice, guys. Clear with this. Now, for every period before the start, what these guys do, generally the management, they set the targets for all their employees. Correct, guys? They set the targets, and then they give them the authority to perform. So they have this hierarchies and all, who needs to do what. So they give them the authority to perform, and then the actual task gets performed by them. And at the end of the year, what happens? The targets gets compared with the actuals, and then they do a performance appraisal. Correct, guys? Right? And based on this, they take any corrective actions. Correct? Corrective actions, what will they take? They might either reward or punish the employees. Reward could be by way of promotion. If this guy has overperformed, they will give them a reward by way of promotion, bonus, incentive. And in case these guys have not performed well, they might be getting some kind of dismissal or maybe a pay cut, or as the case may be. Clear with this, guys? Right? So basically, guys, every company does this. Correct? No? Right? At the beginning, they set the targets, they give the employees the authority to perform, and then these guys actually do the job. The targets are compared with the actuals, and the performance gets evaluated. Correct? No, guys? Right? Now this is actually what the concept of standard costing does. Right? Budgets will set you the targets. Having set the targets, how do you actually evaluate the performance of all the employees in your organization is actually done by this particular chapter called as standard costing, and hence this is how it helps you achieve the objective of control. Clear with this, guys? How and all these things are the technicalities which we are going to discuss right now. Are you all understanding this? Yes. So literally speaking, when I say control, it is actually a 4-step mechanism. First, we will establish the standards. Correct? We will establish the standards. Once that is done, we will actually evaluate the performance, and then we will actually, what we will do is, targets are set, that is nothing but standards, actuals are there, because whatever these guys have done, we know this. We compare the two and we will try to find out the difference between the two. Guys, correct? That difference is called as variance. Variance means what? By how much it has varied. Guys, clear with this? So basically, we will analyze the variance. Guys, correct? That variance could be actually beneficial variance for me or unbeneficial variance for me. Guys, correct? No? If they have performed well, it's a beneficial variance. If they have not performed well, it's actually not beneficial for me. Guys, correct? And finally, what you do is you either reward them or you punish them. Guys, clear with this, guys? So I need to know which are all the employees in the organization who have performed well, who are all the organization or who are all the employees in my organization who have not performed well. Correct? No, guys, this is what I need to do. This is exactly what this particular chapter, standard costing, does. How, sir? Now let's get into the actual background of this chapter, a very important discussion. And once you're through with this, that's about it. This chapter, you will be having a common sync. You will be in sync with this chapter and you will be able to get all the concepts inside of this. Now, guys, at the beginning of the period, every company prepares something called as a budget. Agreeing with me? Correct? Now, in this budget, they will be having budgeted sales minus all the components, budgeted cost and all. They will be arriving at what? My budgeted profit. Agreeing with me, guys? Now, once this is done, what they do, they enter into the year. Actual performance happens. Correct? Now, at the end of the year, I know the actual sales. I know the actual costs and all. At the end of the year, now I will know the actual profit. Guys, correct? Yes? Correct? No? Now, will my budgeted profit and actual profit tally? No. No. There will be a difference between the two. Guys, correct? This difference is called as profit variance. What is it called as? Profit variance. Means what? The variation in the profit is called as profit variance. Are you clear with this, guys? Now, you guys tell me this difference in profit, why did it happen? Simple. Profit is a function of two components, sales and cost. So this difference or variance in my profit could have happened either because of the sales side variances or because of cost side variances or jointly because of both. Agreeing with me, guys? Yes. So can I further split this into two? Can I further split this into two and write sales variances and cost variances? Clear with this, guys? Agreeing with me on this? Yes. Now it is not enough if I just say, sir, sales side is so much variance, cost side is so much variance. Further dig in and see, sir, cost, there are different components of cost. Which components of cost have attributed to how much amount of variance I need to know? Guys, correct? So broadly on the cost side variances, you have four different kinds of cost. One is material related variances. Then you have labor related variances. Then you have variable overhead related variances. And then you have fixed overhead related variances. Are you all clear with this, guys? Are you all clear with this? So now I further deep dive. If I just say, sir, cost side variance is so much, no, further deep dive into it and tell me which are all the components of cost that have attributed to how much amount of variance. Are you all clear with this, guys? Are you all understanding this? Yes. Now basically this is the structure of this particular chapter. Now, guys, so overall this chapter, what does it do? It compares my budgeted profit with my actual profit. The difference between the two is called as profit variance, and that only we are deep diving and digging it and finding out which are all the reasons why this variance has arrived. Now, guys, you tell me, I'll give you a scenario. You tell me budgeted profit, actual profit, and the variance. Let's say I budgeted a profit of 80 crores. I budgeted a profit of 80 crores. My actual profit was 100 crores. Is it a good thing for me or a bad thing for me? Good thing for me. So this variance, I call it as a favorable variance. Clear with this, guys? Why? Because it is favorable for the company. Clear with this, guys? Right? Now, suppose the company had budgeted 80 crores of profit, but the actual profit comes out to just 60 crores. Now, this 20 crores difference, is it a favorable variance for me or unfavorable for me? Unfavorable. Unfavorable variances are called as adverse variances. Clear with this, guys? Are you all understanding? These are the two jargons we will be using in this chapter, right? Now the first 80 minus 100, or the difference between the two, 20. If I just say, sir, variance is 20, it doesn't make sense. You should say whether this 20 rupees of variance is worked for me or worked against me. Is it a favorable or an adverse variance? Clear with this? So here I will say it is 20 within bracket, you will put it as F. Clear with this, guys? Suppose if it's an adverse variance, second scenario, you will put it as 20 within bracket A. Clear with this, guys? So a variance cannot be mentioned as such. It should be suffixed with either F or a favorable or adverse variance. Clear with this, guys? And never ever mug this up. Students, some students, what they do, sir, if I get a positive answer, it's a favorable. Negative answer, adverse. Absolutely wrong. A very bad way of doing it. No, because on the sales side, everything else will change. On the sales side, if your actuals is greater than budget, it's good for you. On the cost side, if your actual is less than budget, it's actually good for you and all. So do not mug this up like this. Any variance that actually contributes to increasing your profit should be taken as a favorable variance. If a variance is going to pull down your profit, you take it as an adverse variance. Clear with this, guys, right? And in this chapter, overall budget profit, actual profit, the difference between the two is called as profit variance. This can happen because of variances on two sides. One is your sales side variances, other one is cost side variance. Cost side variance further can be classified into material related variances, labor related variances, variable overhead related variances, and fixed overhead variances. Clear with this, guys? And for your syllabus, you only have the cost side variance. So basically this overall chapter, what it does is it computes every single variance, and finally what you need to, both cost side as well as sales side, and finally having computed all the variances, you need to reconcile your budgeted profit with your actual profit, prepare a reconciliation statement, and only that will complete your chapter called as standard costing. But in your intermediate level, what is there in your syllabus is only computing the variances, and that too the cost side variances, and that too only these four variances. What are these four variances? Material related variances, labor related variances, variable overhead related variances, and fixed overhead related variance. Under every variance, further subclassification is there. Deep dive we will be doing it. Clear with this, guys? But only these four are there for your syllabus. But you should know why you are doing this chapter. For that background I gave. Are you all clear with this, guys? Are you all now understanding why we do this? So now literally the company, let's say you are the managing director of the company, you need to have full control over your operations, correct? Which are all the areas where you have performed well, which are all the areas where you have not performed well. You should know the areas that contribute to your profit. You should know the areas which are pulling down your profit, and we'll further deep dive inside this material and all this, every component. We will see who is the person behind this variance. We will be seeing. Clear with this, guys, right? And that is how this chapter helps you achieve the overall objective of controlling. Guys, are you all clear with this, guys? Such a beautiful and a logical chapter, but I don't know for what reason students mug this up. So never mug this, guys. Clear with this, guys? Shall we get started now? You guys got the background here? Yes. Now before we move into the first variance, material related variance, you should know one concept called as standard cost. You should know one concept called as standard cost. Now guys, let me give you an example. Let's say my budgeted cost was rupees 1 lakh. Everyone please participate here. Let's say my budgeted cost was rupees 1 lakh, and let us say my actual cost was rupees 96,000, right? Now you tell me, guys, is there a favorable variance or an adverse variance? You guys tell me. Favorable or adverse? I budgeted for 1 lakh, but I incurred only 96,000. This will help you increase your profit only. No, it's a favorable variance of 4,000. Now I am adding one more data. Let's say this is the total cost for a budgeted volume of 10,000 units, but this is the total cost actually incurred for an actual volume of 8,000 units. Now you tell me, can this 1 lakh be compared with 96,000? Guys, can this 1 lakh be compared with 96,000? Absolutely not. Why? Because you can't compare a budgeted cost for a different volume with an actual cost which is incurred for a different volume level. Guys, clear with this, guys? So now in this case, what will you do? Using the budgeted data, first you will arrive at the budgeted cost per unit, or in other words, you call it as, when you are unitizing the budget data, you generally call it as standard cost per unit. I will first say, sir, what is a standard cost per unit? Sir, 1 lakh rupee is the cost you are allowed to incur for how many units? 10,000 units, which means based on the budgeted data, I can understand the intention of the company. Per unit, you are allowed to spend how much? 10 rupees. Now, what you will do, how many units have I actually produced? 8,000. For the actual units, what is the cost you were supposed to incur? 8,000 units into 10, which is going to be 80,000 rupees. Guys, correct? Right? That is called as standard data, or that is called as standard cost. Here, can I say this is nothing but rupees 80,000. How did you get rupees 80,000? It is going to be your standard cost per unit multiplied with your actual units. Guys, correct? No? For the actual production of 8,000 units, what is the cost you were allowed to incur? Guys, correct? Are you all understanding this? So here it's going to be per unit 10 rupees into 8,000 units. So now I can say, look, you were supposed to incur how much cost? 80,000, but you have actually incurred how much cost? 96,000. Now you tell me, is it an adverse or a favorable variance? Adverse. You were allowed to incur 80. You have actually incurred what? 96. 16,000 is an adverse variance. Because of you, my profit has come down by 16,000 rupees. Guys, clear with this, guys? Or in other words, always remember, you should never compare your budget with actual. You should always compare your standard with actuals, and hence the name of the chapter, standard costing. It's not budget costing. Clear with this, guys? Are you all understanding this? Because budget could be for any volume level. Using the budget data, arrive at the standard cost per unit and multiply that on the actual unit. So always remember, actual output is the base. Why? So I'm comparing what? I'm comparing the actual performance of my employees. Correct? Now, for your actual performance, what is the cost you should have incurred is what I need to backwork. Guys, correct? I cannot compare my budget with my actual. So I can compare for the actual output, right? What is the cost you should have incurred versus the what is the cost you have actually incurred. That's how you need to compare your variance and all these things. Are you all understanding this, guys? Yes, are you all understanding this? So remember, this concept of standard, it can be used on cost, it can also be used on hours, it can be used on anything. For example, for let's say for 100 units is the actual output. Guys, correct? Now these guys, what they did was, they actually took, let us say they actually took 900 hours to produce how many units? 100 units. But per unit you are actually allowed to take how many hours? Let's say 10 hours. So which means for your actual output of 100 units, you are allowed to take how many hours? 1,000 hours. Guys, correct? So you are allowed to take 1,000 hours. In this case, I call 1,000 hours as standard hours, whereas 900 hours is actual hours. So now I will say, look, you are allowed to take 1,000 hours. You have only taken 900 hours, which means you guys are super efficient. That's a favorable variance for me. With that, we'll give it a value and we will arrive at the variance in terms of figures. Clear with this, guys? Or in other words, the concept of standard, right, can be applied on cost, it can be applied on hours, it can also be applied on raw material kgs also. You are supposed to consume 900 kgs, I mean you are supposed to consume 1000 kgs, you have consumed only 900 kgs, which means you guys are efficient. Guys, clear with this, guys? This concept of standard means what? For the actual output, what you should have taken is called as standard data. Are you all clear with this, guys? Is everyone able to follow this? Yes. This is a very critical understanding to enter into this chapter, because here every computation will revolve around the actual volume. What is your actual output? For the actual output, how much you should have taken versus how much you have taken. Clear with this, guys? Are you all understanding this? Yes. So now with this background, shall we get started with the first variance called as material cost variances? Shall we do this, guys? Yes, guys. So now let's do this. The first variance called as your material variances. Now, guys, okay, one second. Now, guys, trust me, If we spend a little bit time on this material related variances, labor will be automatically done and your variable overheads will also be automatically done, which means out of the 4 variances we are going to study, if we complete this properly, 75% of the chapter is over. Trust me, I'm telling you the truth. 75% of the chapter is over. Fixed overhead variance is one animal altogether. We will see it separately. Clear with this? Shall we do this, guys? Yes. Now, the way you start the chapter will define how you are going to navigate throughout this chapter. So, if you have a good understanding in material variances, same logic, everything is same. Small changes, that's all. Labor and variable overheads done. Shall we do this? Right. Now, let's say guys, for me to produce 1 unit of output, I am allowed to take 10 kgs of raw material. Now, can I say standard quantity is equal to 10 kgs? Agreeing with me? Quantity means what? Quantity of raw material. We are computing what? Raw material variances. Material related variance. Clear with this? For me to produce 1 unit, how many kgs am I allowed? 10 kgs, right? And every kg I had budgeted and kept. Every kg should be purchased at rupee 1. Clear with this, guys? Every kg should be purchased at 1 rupee. Can I say this is called as standard price, which means this is the price I should pay to purchase every kg of raw material. Clear with this, guys? Now, what has happened? The company actually produced 1 unit. Now, actual quantity they consumed was, let us say actual quantity they consumed was 12 kgs, right? And the actual price, which means every kg they purchased, they paid, let us say 90 paise or rupees 0.90. This is the given data. Clear with this, guys? Are you all understanding this? To produce 1 unit of output, I am allowed to take 10 kgs of raw material, and every kg I should purchase it at 1 rupee. Whereas what actually happened, I actually consumed 12 kgs, and every kg what I did was I purchased it at 0.9 rupees. Now first you tell me, what is the material cost you should have incurred? Can I say it is 10 kgs into 1, or in other words, the total material cost variance, can I say, is equal to standard quantity into standard price. This gives me what? The material cost allowed to be incurred minus actual quantity into actual price. What is this? This is the actual material cost incurred. Agreeing with me? Standard material cost minus actual material cost gives me the material cost variance. Agreeing with me, guys? Now, you guys substitute the figures and tell me, how much is this? 10 kgs into rupee 1 minus 12 kgs into rupee 0.9. Now, 10 kg into 1 is going to be 10 rupees, and 12 into 0.9 gives me how much? Rupees 10.80. Agreeing with me, guys? Now you tell me, I was allowed to spend how much? 10 rupees. I have actually spent how much? 10.8. Is it a favorable or an adverse variance? Actually, I've incurred more than what I was supposed to incur. So I would say here 0.80 is an adverse variance. Agreeing with me, guys? Yes, clear with this? Now I am going to my managing director and I'm saying, sir, 80 pice is the adverse variance because of material cost. Now the next question my managing director will ask is, who is responsible for this? Who is responsible? Now I cannot just directly come to a conclusion who is responsible for this. For the purpose of fixing the responsibility, I will segregate this variance further into two. One is called as material price variance. The other one is called as material usage variance. Sir, what is this, sir? Now look at this. See, I was supposed to consume 10 kgs, but I consumed how much? 12 kgs, guys, correct? So on the kg side, usage side, there was some variance, guys, correct? That gets captured here under material usage variance. You were supposed to pay only 1 rupee for every kg, but you paid 0.9. So on the price side also there was a variance. I will take it separately and park it as one variance. Clear with this, guys? Are you all clear with this? Now, You guys tell me, material price variance, who is responsible for purchasing the raw material? Not production manager, come on, purchase manager. So whatever is this variance, the responsibility is fixed on purchase manager. Correct? Now usage, who actually consumes, converts it into your FG? Production. So obviously the usage variance is the responsibility of production manager. Clear with this, guys? Now if I compute these two variances, I will know who has contributed to what extent to my overall variance. Clear with this, guys? Now material price variance, it goes by the formula standard price minus actual price into actual quantity. And material usage variance, it goes by the formula standard quantity minus actual quantity into standard price. Now first let's do the computation, and then I will tell you the logic for these formulas. Absolutely logical. Now you guys tell me, standard price, what was the standard price? 1 rupee minus, what was the actual price? 0.90 into, what is the actual quantity, guys? 12 kgs. Yes. Now you tell me, so 1 minus 0.9 is 0.1 into 12. How much is that? This is going to be rupees 1.20. Adverse or favorable? Adverse or favorable? Think and tell me. You were allowed to pay 1 rupee for every kg, whereas you only paid, you stuck a good deal with that guy, you only ended up paying 0.9, which means this is a favorable variance. Clear with this, guys? Are you all understanding this? Are you all understanding this? Yes. Now sir, why this formula? Simple. I am fixing the responsibility on whom? Purchase manager. Purchase manager is responsible for what? Price decision. So obviously I will compare the standard price with my actual price. That's why it comes within the bracket. Guys, correct? Now purchase manager will not decide how much quantity to purchase. He will just have to shut up and purchase whatever quantity the production manager asks him to purchase. Guys, correct? Hence, that is not in his control. So for every unit he actually purchases, his responsibility is on the pricing, and hence standard price minus actual price on the actual quantity. Guys, clear with this? Are you all understanding this? Any problem here? Simple, isn't it? Simple, isn't it? So I'm fixing the responsibility on whom? Purchase manager. Purchase manager is responsible for price decision. Does he have control over quantity? No. He has to purchase whatever quantity the other guy, production manager, asked me to. So here what comes within the bracket, that is his responsibility. Standard price minus actual price into actual quantity. Clear with this, guys? Are you all understanding this? Now let's go on to the other guy. Who is this guy? Production manager. Now he is responsible for consumption. Guys, correct? Now how many kgs he should have consumed? 10. How many kgs he has consumed? 12. Now here 10 kgs minus 12 kgs. Now this guy has consumed 2 kgs more. Now you tell me, is the production manager dependent on any purchase manager for pricing? No, he is not dependent on this other guy. Or in other words, I can say there's only one-way traffic here. That is, purchase manager is dependent on his work, right? He's dependent on the production manager for whatever work he does. Whereas this guy, production manager, he is not dependent on the purchase manager. Suppose if I take actual price here, then what am I doing? I am passing on the efficiency or inefficiency of the purchase manager to the production manager, which I should not be doing. Are you all understanding? And hence I multiply this with standard price. What is the standard price, guys? How much is that? 1 rupee, right? So here, so 10 minus 12 into 1, don't say negative and all. You should have consumed 10. You have consumed 12. 2 kgs you have consumed more, and every kg gives you a cost of 1 rupee. That's going to be how much? 2 rupees. Adverse or favorable? Clear with this, guys? So now you add up the two adverse and 1.2 favorable, net off, you will get the top daddy figure, right? What is the daddy figure here? It's going to be 0.8 adverse, and that's about it, guys. What is the big deal here to mug up? Some people do line item 1 minus line item 2, column 1, column 3 and all. You guys can do this by yourself, no? Are you all understanding this? Isn't this simple? Isn't this simple? So now here, if you add up these two figures, you can clearly, you will get the top figure. That's why I said the daddy figure. These are two kids and top is a daddy. Guys, clear with this? Are you all understanding? So now you guys tell me, material cost variance comprises of how many components? Two components. What are they? Material price variance, material usage variance. Price variance, responsibility, purchase manager. Usage variance, responsibility, production manager. Simple. Now, you guys tell me material cost variance, what is the formula? Standard material cost minus actual material cost. How will you arrive at it? Standard quantity into standard price minus actual quantity into actual price, right? Now, this total variance, if I give it to my MD, what will he do? He will first dismiss me. He will ask me, why are you coming here, without telling me who is responsible for how much. I will bifurcate this into two. What are they? Material price variance, material usage variance. First, before you jump into the formula, remember, who is responsible for your price variance? Purchase manager. So for him, price will be the deciding factor. So standard price minus actual price. But I need to actually look at this variance for every unit is actually purchased. I am dependent on the production manager for my quantity decision, hence into actual quantity. Clear with this? Now on the other side, we have my material usage variance. This guy is a production manager, right? So for him, what is the decision? I mean, for him, he's responsible for quantity that comes within the bracket. Come on. Standard quantity minus actual quantity into standard price. Why? Because this guy is not dependent on the purchase manager. If I take the actual price here, his efficiency or inefficiency will be passed on to the production manager. Are you all clear with this, guys? Yes. And now what I will do, now look, overall, because of my material costs, my overall profit has been reduced by 0.8 rupees. But if you look at it, actually seeing the purchase manager has been doing a super efficient job. Yes, he has been contributing 1.2 rupees more to the profit, but because of the super inefficiency of the production manager, overall it is too negative. Net of overall, the top figure is actually a little bit negative. Clear with this, guys? So now I will definitely reward this guy and I will punish this guy. Clear with this, guys? So now the control needs to be done more into your production manager, and you need to take care of his usage and all these things. Clear with this, guys? Any problem here? This is all the concept of your material cost variance. Of course, there are a few more complexities. Slowly, we'll be adding it. Clear with this, guys? Are you all understanding this? Any problem here? Now, you guys tell me one last time. Material cost variance formula. Standard quantity into standard price minus actual quantity into actual price. Divided into two. What and what? Material price variance, material usage variance. Material price variance, responsible purchase manager. Formula: standard price minus actual price into actual quantity, dependent. Next, material usage variance, responsibility production manager, within bracket. Standard quantity minus actual quantity into standard price, because if I take actual, then I am passing on the other guy's efficiency or inefficiency to the production manager. This simple, guys. That's all it is. This is why I keep telling you. So if you give me 6 hours to chop down a tree, I will spend the first 4 sharpening the axe, right? We have right now spent all the time in understanding the concepts. Now let's go and do one numerical problem. Just see the speed at which you will be able to do it. But wait, little bit. Initially, there will be some kind of hiccups and all these things. Generally, students struggle. I'll tell you where. In calculating the standard quantity, that's where they generally struggle. I'm telling you, generally students struggle in calculating the standard quantity. Standard quantity means what? For the actual output, how many kgs of raw material you should have consumed, guys. Correct? Right? Have this in your mind. And will you do it? Yes? No, never look at the solution and do this by yourself. First, I will just read the question anyways. Take the first question, guys. Let's do this. Shall we get started? Yes, guys. Let's get started now. A manufacturing concern furnishes the following information. Material for 70 kgs finished product, 100 kgs. They have used the word what? Standard on the top. Don't go by this word. Don't go by this word. At times they use standard, at times they use budget and all these things. No, never go based on whatever wordings they have given. Standard means what? For the actual output, how much you should have consumed. Guys, clear with this? You have that in your mind, because whenever they give the data, standard budget, they interchangeably give it, but you be careful based on the wordings, you will understand. Now, on the top, what are they given? Material for 70 kgs finished product. How much is that, guys? 100 kgs. Clear? Next, price of material. Actual, they have given actual, okay, price of the material. Standard is how much? 1 rupee per kg, which means you are allowed to pay 1 rupee for every kg. Clear with this? Next, actual data. Output 2,10,000. This is what? Actual output. Clear with this? This kg is given, it is output. And material actually uses how much? 2,80,000. Cost of materials is how much? 2,52,000. Calculate all the variances. Now, first thing that you need to do is what? Now, calculate the standard quantity. Do not look into the solution. Can anyone tell me the standard quantity computation? First, the wordings given in the question, material for 70 kg finished product is 100 kg. Now, they have given 70 kg, 100 kg. Out of these two, which is the output and which is the raw material? Very good, very good. Now, they are saying 70 kg is output. Material for 70 kg means what? If you input, I mean, you are allowed to input 100 kgs to get an output of 70 kgs. Clear with this? Now, the company has actually achieved an output of how much? 2,10,000 kgs. Now, in order to get a output of 2,10,000 kg, what should have been my total raw material consumed is called as what? Your standard quantity. Agreeing with me, guys? Yes, now compute and tell me how much is that? 3 lakh. Very good. How did you get this? How did you get this? Simple. If 100 is for 70, how much is it for 2,10,000? So basically, what you do is 2,10,000 into 100 divided by 70. You get how much? 3 lakh kgs. Any problem here? Now, guys, the entire variance, I just need 4 figures. What are they? Standard quantity, standard price, actual quantity, actual price. Standard quantity, 3 lakhs. We just got it. Standard price, they have given it 1 rupee per kg. Guys, correct? Actual quantity given in the question, what is it? 2,80,000. Actual price. Now, they have given the actual cost of material. They have given the actual kgs used. Divide the two, you will get the actual rate. No. Guys, are you clear with this? Right? They have given you the actual cost of material. They have given you the actual kgs consumed. Divide the two, you will get the actual cost or the actual rate of, or the actual price of your materials. I said rate. Okay, rate and price are interchangeably used. Okay, fine. Let's call it as price. The actual price is going to be what? 2,52,000 divided by 2,80,000. How much is that? 0.9. Guys, correct? So here, if you see standard quantity, how much is it? Come on, just now we calculated 3 lakh kgs, right? Standard price, how much is it? Rupee 1 per kg. Now, actual quantity given in the question, 2,80,000 kgs, right? And actual price is going to be how much? 2,52,000 divided by what? 2,80,000. How much is it? Rupees 0.9. Now, with this, all the variances you yourself can compute. Yes, guys. Shall we do this? Shall we do this? Now, the first one, material cost variance. What is the material cost variance formula? Everyone, don't look. Tell me. Standard quantity into standard price minus actual quantity into actual price. Do not worry. Please repeat it. It's okay. Any number of times you do it, it stays with you. I keep telling you, learn like a child. Do that. Do that. You will never forget it. Now, guys, tell me, what is the standard quantity? Substitute the figures. 3 lakhs into what is the standard price? 1 minus actual quantity. 2,80,000 into actual price 0.9. So it's going to be a total of 3 lakh minus. So 2,80,000 into 0.9 is going to be 2.52 lakh. 2,52,000. What is the difference? You were allowed to incur a cost of 3 lakh. You ended up incurring only 2,52,000. Overall, there is a favorable variance to the extent of 48,000. Any problem here? Are you all understanding this? Yes. Now, this is broken up into two. MPV and MUV, correct? Material price variance and usage variance. Price variance formula, everyone. Standard price minus actual price into actual quantity. Now, put up the figures here. Now, standard price, how much is that? 1 rupee. Yes. Actual price, how much is that? 0.9 into actual quantity, 2,80,000. Now, how much you get? 0.1 into 2,80,000, that's going to be 28,000. You guys tell me, you were allowed to pay 1 rupee, you ended up paying only 90 paise, 0.9. Is it an adverse or a favorable variance? Favorable, because these guys, the purchase manager, he has been super efficient in striking a very good deal with the supplier. Guys, clear? He has done his job very well. Are you all understanding? So in this case, it's going to be what variance, guys? Favorable to the extent of 28,000. Clear with this, guys? Are you all understanding? The next one on the right side of the chart, what do you have? Usage variance formula. Who's responsible? Production manager. Now, can you tell me the formula? Standard quantity minus actual quantity into standard price. Standard price. Why? Because if you take the actuals, you're passing on the efficiency or inefficiency of the purchase manager to the production manager, and the production manager is not dependent on the purchase manager for any pricing decisions. Clear with this, guys? Are you all understanding this? Yes. So now what's going to be the application here? So standard quantity, you were allowed to consume 3 lakh kgs, but you consumed only 2,80,000 into your standard price of 1. How much is that, guys? 20,000. Favorable. So now material cost variance figure was how much? You guys tell me. 48,000. Monkey or donkey? You should say favorable. Yes. Okay. So now split it into two: material price variance and material usage variance. Price how much? 28,000 favorable, and usage how much? 20,000 favorable. Clear with this, guys? Add up the two. Do you get the daddy? Yes, you do. Clear with this, guys? Always check for this. Always check for this, because this luxury of checking you don't have in all the chapters, but this chapter, at least arithmetically, you can check whether you are right or not. Are you all understanding this, guys? Yes, are you all understanding? So if it tallies, it doesn't mean that it's always correct. It can tally with a wrong figure also. Let's say everywhere you've taken a wrong figure of standard price or standard quantity, perfectly it will tally, but with the wrong figure. So at least one thing, arithmetical accuracy, you can check for in case you are doing it. Are you all understanding this? Any issues here? No. Clear with this, guys? And that's about the basic thing inside this area called as your material cost variance. But right now we did only one type of raw material. If there is a multiple type of raw material, then few more variances are there. This material usage variance is there, no? That is further classified into material mix variance and material yield variance. What it is, we will be seeing in the next question. With the help of next question, we'll be learning it. Don't worry about it. Fine, guys. Shall we just go and update the library for adjustments? Write down. Please give all the cross-referencing and write down MCV-single RM. MCV-single raw material. Single RM. MCV-single raw material. You guys are understanding this? Okay. In my opinion, this is a very easy chapter. If you spend this time to learn all these things, it's going to be very easy for you. Scoring, very, very scoring. And the best part is it's less time consuming. The best part is that it is less time consuming. Generally, students struggle in arriving at the standard data, standard quantity or standard hours in case of labor. Standard data is where they struggle. Once you get that, everything else will be easy and set for you. Shall we go to the next question, guys? Let's do this. Look at how small the question is. Problem number 2. The standard cost of a chemical mixture is as follows. 40% material A at the rate of rupees 20 per kg. Then 60% material B at the rate of rupees 30 per kg. Wait, what are they saying? Now they are actually making some chemical mixture. Clear? Two chemicals they are mixing. And they are saying on an average, if I'm mixing, 40% of my total input should come from material A. 60% of it should come from material B. Clear with this? Clear? Next. A standard loss of 10% of the input is expected in production. Normal loss means what? Planned, allowed, unavoidable. Clear? Next. The cost record for a period showed the following usage. The company has actually used 90 kgs of A at a cost of 18 per kg, 110 kgs of B at a cost of 34 per kg. The quantity produced was 182 kgs of good product. calculate all the variances. Small sum. Guess how many marks it came for? Yes, 10 marks. That's all. Okay. Now guys, a very good sum to actually get introduced to this particular concept of mix of raw materials and all that. Now guys, if you notice in this question, there is more than one raw material used. Agreeing? Yes. Now guys, how do you compute all the variances? Simple. Whatever formulas we saw, you need to apply the formulas for every single raw material and arrive at it. That's all. So whatever material cost variance means, do it for material A, do it for material B, add up the two, you will get the total material cost variance. Similarly, material price variance, do it for A, do it for B, add the two, total material price variance, usage variance, also the same. That's about it. Nothing great here. But in this question, they have given losses and all these things. How do you go about with that? Now, first guys, you tell me, to crack this area, I need how many figures? 4 figures. What are the 4 figures? Standard quantity, standard price, actual quantity, actual price for both the type of raw materials A and B. Correct? If I am getting these figures, I'll be able to crack this question. You guys tell me, out of these 4 figures, 3 figures are readily available. What are they? I know the actual quantity of A and actual quantity of B. Actual quantity is available. Actual price is also available. Standard price is also available. Only standard quantity I need to compute. If I compute standard quantity, the entire sum is over. Clear with this, guys? That's the challenge here. Shall we do this? Now, you just participate. I will do this sum fully here. From the scratch, I will do it. And this is a very good way to do. In the study material, they have done it differently. Answer will be the same. I don't like the way in which they have done. Don't worry. I have given it in a printed solution also. Do not worry about that. Shall we get started? I want a full focus here, guys. If you do this, that's about it. That's about it. With this sum, literally, all this raw material related variance will be over. Shall we get started? Let's do this. Now, look at this. Look at this. First, I will draw a dabba. Now, raw material. One second. Okay. Raw material. Standard data. There I will put standard quantity, standard price, and then I will have one amount column also multiplying the two. Actual data. What are the two ones? Actual quantity, actual price, and finally I will have one multiplying the two amount column. Now, what are the two types of raw materials? A, B. Now, I will subtotal this, call this as total input. Correct? Yes. Now, whatever I input, will I get it as output? No. There is some loss here, less loss. If I do, what I will be getting is my output. Correct? Now, guys, standard prices and actual prices, easy things, fill up. First, you tell me the figures. Standard price of A, 20. Okay, I'll take a blue ink here. 20. Standard price of B, 30. Actual price of A, 18. Actual price of B, 34. Simple, no problem. No. Now, before you enter into the standard quantity, first what you should do is, standard quantity means what? How many kgs of A and B I should be inputting to achieve the actual output. What is the actual output? What is the actual output? 182. 182 should be kept as the base and you need to reverse work. How to do it? First you take the actual quantity column. Let's fill it up. It's given in the question. How much? 90 kg, 110 kg. What's the total input? Add it up. So overall I inputted 200 and effectively what was the output? I got how much? 182, which means actually I have lost how many kgs? 20. How many actual loss, ma? I'm not asking for your standard loss and all. How much is that? 18 kgs. Guys, correct? This is nothing but a balance figure. Any problem here? The first thing that you need to do is, you need to plug this figure here. Why? for the actual output. Now I need to reverse work and compute how many kgs of A and how many kgs of B I should have inputted. Guys, clear with this? This is the first thing that you need to do. Clear with this, guys? So now, what is going to be your actual output, guys? Actual output 182. Now you do all the reverse working. Read the question. What have they said? Now, a standard loss of how much is allowed, guys? 10% on the input. It means what? It means what? If I input 100, I am allowed a loss of 10. I will be getting an effective output of 90. If 182 is 90, how much should have been my 100 or how much should have been my 10 I can do? So 182 divided by 90 into 10, how much is that? 10 pa. It's going to be 20.222 something. Guys, correct? 20.222. Guys, correct? Or how much would have been my 100? 182 is for 90. How much is 100? 202.222 something. Retain the decimals in your calculator. Any problem here? Any problem here? No. So for me to get an effective input of 182, effective output of 182 kgs, I should have inputted a total of 202.222 kgs of total input. And out of that, how much percentage from A and how much percentage from B? 40% from A and 60% from B. Any problem here? Now what will you do? 202.222 you have in your calculator into 0.4 is equal to, write down how much is that? 80.8888, right? You should read in the decimals, and 0.6 is equal to 121.3333. You got all the figures now. Just go and do the sum. That's about it. Guys, clear with this? The problem is only with respect to calculating your standard quantity. Are you all clear with this, guys? So what do you mean by standard quantity? For the actual output, how much should have been my input? Guys, clear with this, guys? Are you all understanding this? Any problem here? This is one place where generally students struggle. If you put the statement, now it's simple. Now guys, let's do this. Now you have here you have okay, 80.8888 you have. No, retain all the decimals. 80.8888 you have into 20. How much is that? 1617.7777. It comes out. We are basically trying to compute the overall standard cost itself. So if you total, this is going to be the standard cost. If you total, this is going to be your actual cost. Subtract the two, directly you'll get your material cost variance, and further we can bifurcate and do the other components. Shall we? Yes. So now what is for product B? It's going to be 202.22222 into 0.6. You should read in all the decimals. 121.33333 into 30. How much is that? 3639.99999. Okay, so 3640. Okay, so you add up the two. So 3640 plus 1617.7777. How much you get? 5257.777. Literally, this is going to be my overall cost also. Guys, correct? Why? Because only if you incur this cost, effectively you will get 182. Normal loss, no. Guys, correct? Are you all understanding this? Yes, or basically I am allowed to incur this cost. Are you all clear with this? What is the actual cost here? Now 90 into 18, how much is that? 1620. 110 into 34, how much is that? 3740. So add up the two, how much you get? 5360. Literally, this is the overall cost actually incurred by you. Any problem here? Guys, any problem here? No. So now basically can I say you are allowed to incur a total cost of 5257.777, but you have incurred a total cost of 5360. Subtract the two, what do you get? So you get 102.222. Adverse or favorable? Adverse. Why? You have incurred more than what you are supposed to incur, hence it's an adverse variance. Any problem here? Guys, are you all clear with this? This is exactly what has been done here. Clear with this, guys? So if you notice here, so the cost you are allowed to incur was 5257.777. The cost you've actually incurred was 5360. So the difference between the two, I would say that the cost variance is overall. So the difference between the two, it's 102.22222 adverse. Clear with this, guys? Are you all understanding this? Now can we do material price variance? Now material price variance. Now material price variance formula, everyone. Standard price minus actual price into actual quantity. Now you should not even go back and look the question because all the data is here. Yes, one small change, guys. This is not R. Change it as P, because rate is generally something that we will be using in labor area. So here we call it as price. Clear with this. And one more change here. This is not 180. This is 182. Please change it, because in the study material they have done some confusion. They did for 180. I don't know for what reason. And then they converted it to 182 and all. That's why I said institute way of doing for this sum don't follow. Please follow our approach. That's better. That's why while doing this, our DTP person, they took whatever was mentioned in the heading of the institute. Right? All these workings I did and I gave it to them. Right? So please change it. Clear with this, guys. Just change it to 182, because standard is always for actual, no? Standard computation is for the actual output. So actual output is 182 kgs. Clear with this, guys. Now shall we calculate your price variance? Shall we do it? Now what is the price variance here? So for material A, standard price 20, actual price 18 into actual quantity 90. Guys, clear? So 20 minus 18 into 90. How much is that? 180. Now you are allowed to spend 20. You spend only 18. Favorable, adverse? Favorable. That's all, guys. That's all. Don't say negative, positive and all. Think and answer. Next, material B. Now standard price 30. Actual price 34 into actual quantity 110. So here 30 minus 34 into 110. Figure 440. Now you were allowed 30. You have incurred 34. You have pulled down the profit. It's an adverse variance. Clear with this, guys? Now net of these two figures, I have adverse more, no? So net of these two, 440 minus 180. How much is that? 260. Net figure is actually an adverse variance. Any problem, guys? Simple, isn't it? Simple, isn't it? Right? Provided you have this conceptual knowledge. Next one. Next one. Oh, they have done all these things. Okay. Next one, guys. Usage variance. Usage variance. Okay. So this is how they have done in the study material. I told you, no, randomly for 180 they did, and then proportionated for 182 and all. It's a very bad way of doing. Now, I don't know for what reason. No other sum they did like this. For this sum alone they did it. Anyways, simple, guys. Let's do this. Material usage variance. What is the formula? Usage. Standard quantity minus actual quantity into standard price. Standard quantity. How much is that? A. 80.8888. Right? Actual quantity 90 into standard price 20. Yes, correct. Standard price is 20, no? Yes. So 80.888888. Retain the decimals. Minus 90. You get some 9.122 and all that. Into standard price of 20. How much you get? 182.222. Directly we did, no? That's the figure you get. Is it an adverse or a favorable variance? You were allowed 80.88. You have taken more kgs. It's an adverse variance. Directly you can pick these figures. Clear with this. How about your product B? Standard quantity, how much? 121.33. And actual quantity, how much? 110 only. This guy is efficient, right? Into standard price of 30. So do it. 121.333333. Retain all the decimals. Minus 110 into 30. How much is that? 339.99999, or in other words 340. You are allowed to take 121 point something. You only took 110. You are efficient. It's a favorable variance. So it's going to be 340 favorable variance. Knock off the 2. What do you get? What do you get, guys? If you knock off the 2, 157.78 favorable. Clear with this, guys? And what was your price variance? 260 rupees adverse. So now if you knock off the 2, check if you are getting your daddy figure. You're getting it? So it's 260 minus 157.78. How much you get? 102.22. Net adverse. Adverse is more, no? Are you all clear with this? Always do this checking. Clear with this, guys? Any problem here? Any problem here? No. Are you all clear with this, guys? Yes. Now this usage variance is there, no? Right? It is further classified into 2 more variants. That's all. Once we finish this, that's about it. The entire discussion of material cost variance is over. Only one more adjustment. We will see it later. Now look at this. It's further classified into 2. What is it called as? Material mix variance and material yield variance. What is it called as? Material mix variance, material yield variance. What is that? What is that? Now guys, material usage variance. What is the formula? Standard quantity minus actual quantity into standard price. Okay. I am bifurcating this into two more figures now. Material mix variance, material yield variance, right? Now I will tell you material mix variance. What is the formula? It is revised actual quantity minus actual quantity into standard price, right? The other one we will see it later. That's nothing but a balancing figure of it. What it is, we will be seeing it now. Revised actual quantity minus actual quantity into standard price. What is this, sir? Simple. Now you have raw materials, revised actual quantity, standard price, and then your material mix variance. What are the two raw materials, guys? A and B. Now, when you're doing it, first fill the actual quantity column. What's the actual quantity, guys? 90, 110. Total is 200. Correct? 90, 110. Total is 200. Now, revised actual quantity. First, you fill this 200. Now, here, basically, guys, material usage variance. Why are we doing all this? Now, guys, material usage variance, what does it capture? What you should have consumed versus what you have consumed, because on the consumption side, whatever is amount attributable to variance gets captured here. Now on the consumption side, broadly, there are further two reasons why inside the consumption also, if you see, there are two further reasons that is attributable to the variance because happening because of your usage side. Sir, what is it, sir? That is, one is called as mix, the other one is called as yield. What do you mean by that? Now, material mix variance, what it says, now here I am not capturing the difference between your total amount, that is overall, if you see, you should have taken a total input of how much? 202.22. You have taken a total input of how much? 200 only. That difference I'm not capturing. That difference I'm not capturing. That is done in yield variance. What I am saying is, how many kgs you have actually consumed? 200. Correct? That 200 at least you should have consumed in 40-60 proportion. Guys, correct? That's why we say revised actual quantity. So in the mix variance, I am comparing actuals with actual. But what is the difference? I'm comparing actual at standard mix with the actual at actual mix. Guys, clear with this, guys? Sir, because of this, why, sir? Simple. You tell me, now this particular material, this particular material A is 20 rupees per kg. B is how much? 30 rupees per kg. Between the two, which is a costly raw material? B. Now, if I am deviating and if I am using more of a costlier raw material, less of a cheap raw material, because of the deviation in the mix, it will result in more cost. Guys, clear? Here, total quantity could be the same, but still inside composition could actually make a difference. Or other ways, if I am using more of a cheaper raw material and lesser of a costlier raw material, in this case, it will give me a favorable variance. Guys, correct? So now what I'm going to do, I'm going to further deep dive and see, because of the mix, how much is the variance. Because if this guy wants to take the credit, what he will do, he will use more of a cheap raw material, he will bring a favorable variance. Guys, correct? That will impact the quality for the company. Guys, are you all clear with this? So here I am comparing the actual quantity at standard mix with the actual quantity at actual mix. Because of deviating in the mix alone, how much is the variance that gets captured is under your material mix variance. Are you clear with this, guys? Are you all understanding this? So now here you tell me you consumed a total of 200. I am fine with that. I am not talking about totally you should have consumed how much and all. That 200 at least you should have consumed in what proportion, guys? 40 and 60, yeah? 40 and 60. So now tell me, how much should have been A? 80. And B should have been 120. So now this is the deviation. 80, 120 you should have done. What you have done? 90 and 110. Guys, correct? Or in other words, A, what is the standard price? Everyone, 20. B, standard price? 30. Now you tell me, B is a costlier raw material. What I did, 10 kgs lesser I consumed of what? A costly raw material, and 10 kgs more I consumed in a cheaper raw material. 80 kgs only you should have consumed. You consumed how much? 90 of a cheaper raw material. Obviously, this will give you a favorable variance. Guys, clear with this, guys? Now, inside cheating, these guys do know that also we should control and we should capture. Guys, are you all understanding this? Yes. So now tell me, how much is this variance? You could have consumed 80, but you've consumed 90. That's an adverse variance. 10 into 20, how much is that? 200 adverse. Clear with this? Whereas for B, what happens? You are allowed to consume 120. You have only consumed 110. 10 kgs less you consumed into 30. How much is that? 300 favorable. So overall, if you see, how much is that? It's going to be 100 favorable because of using a cheaper raw material more and actually using lesser of a costlier raw material. Clear with this, guys? Yes, are you all understanding this? Yes, simple, right? So here, what is the formula for material mix variance? I'm comparing actuals with actuals. Revised actual quantity minus actual quantity into standard price. Are you all understanding this? Yes. Now material yield variance will be what? Materials yield variance will be what? It will be the exact opposite of this. It is going to be standard quantity minus revised actual quantity into standard price. Clear with this? Sir, how, sir? Simple. You can also call this as balance figure. What is your daddy figure here? Standard quantity should be compared with what? Actual quantity. Guys, correct? In between here, I introduced one guy called revised actual quantity, and I said, look, revised actual quantity and actual quantity I already compared now, right? Now the daddy says compare your standard with actual. Right now on the left side, I've already compared revised actual with actual. So now I just need to compare my standard quantity with my revised actual quantity. So now this difference alone needs to get captured now. Are you all clear with this, guys? Are you all understanding this? Yes, you guys are understanding this. So here what I'm doing, literally if you say, standard quantity is obviously a standard mix. Revised actual quantity is also a standard mix, but we are comparing the actual quantity. Guys, clear with this? So here we are comparing the standard quantity with the actual quantity, but both are being compared at the standard mix. Guys, clear with this? So because of the mix variance that we are separately capturing that, here only because the quantity difference gets captured here, and hence the name yield variance. Are you all understanding this, guys? You guys are able to follow this? Are you all understanding? You want me to repeat anything? You guys are understanding this? I'm repeating once again. I'm saying here, revised actual quantity. I'm comparing with actual quantity. Guys, correct? On this side, what am I doing? Standard quantity. I'm comparing it with what? Revised actual quantity. Now, the standard quantity is obviously a standard mix. This revised quantity is what? The total actual quantity. This is also a standard mix now. So here I'm comparing the standard quantity with the actual quantity, but both of them are at the standard mix. Internal change composition is not getting tracked here because that purely gets tracked under your mix variance. Here total quantity difference alone gets captured here, and hence the name yield variance. Are you all understanding, guys? Are you all understanding? Or if you find it difficult to remember, simple. What is the daddy figure that you need to get? Standard quantity minus actual quantity into standard price. Forget the standard price. Everywhere on the outside that is the case. Now on left side you have what? Material mix variance is there. Correct? Material mix variance. What and what you are doing? What and what you are doing basically. One second. You are saying revised actual quantity minus actual quantity you are doing. Guys, correct? So here minus actual quantity has already come. So now in my daddy standard quantity should be there, but here you have what? Revised actual quantity. So introduce that standard quantity and remove this RAQ. So if you add the two, RAQ and RAQ gets cancelled, and overall if you add up, you get standard quantity minus actual quantity to standard price. Or in other words, I can say this is nothing but balancing figure. Guys, correct? Are you all understanding this? If I add the two, I need to get the top figure. Right? So this way also you can remember, or logically also you can remember. Are you all clear with this? So now here material yield variance. So now guys tell me what is going to be the figures. So for raw material A, standard quantity is what? Come on, you guys tell me standard quantity. Tell me. Yes, correct. 80.888888 something. Okay. So 80.888, 1 second. Yes. Minus revised actual quantity is how much? 80 into standard price is how much? 20. And for B, it's going to be what? 121.333333 minus 120 into what? 30. Yeah. Okay, fine. So now tell me, this is what you should have consumed. 80.888888. Yes, minus 80. You only consumed something like 80 into 20. How much does it come out to? 17.7777. Adverse, favorable. You could have consumed more, you consume less. It's favorable. Guys, correct? So now here it's 121.333333 minus 120. How much is that? 1.333 into 30. How much is it, guys? 39. 9999, or you can write it as 40. Favorable or adverse? Once again, favorable. Add up the two, you get what? 57.7777 favorable. Huh? Guys, correct? Yes. So now, what's your mix variance? 100 favorable. What's your yield variance? 57.777 favorable. Correct, guys? If you add up the two, you should get 157.777 or 157.78 favorable. Guys, correct? That should be your usage variance. Is that what we are getting? Is that what we are getting? Look at this. This is the figure we are getting. 157.78 favorable. Guys, clear with this, guys? Are you all understanding? Are you all understanding this? Yes. So now, can you tell me what is the mix variance formula? Left side. Actuals with actuals, but actual at standard with actual at actual mix. Tell me. Revised actual quantity minus actual quantity into standard price, because standard price only, because I cannot take actual price. I'm still in the production manager department only. Clear with this, guys? So actual price will never come here. Clear with this, guys? Now on the other side, yield variance. Standard quantity minus revised actual quantity into standard price. Here I compared my standard quantity with the actual quantity, but both of them are the standard mix. Deviation in the mix will not get captured here. That will only get captured in my mix variance. As simple as that, no, guys? Yes. Now tell me the full chart, guys. Come on. Tell me. First, material cost variance formula. Everyone. Standard quantity into standard price minus actual quantity into actual price. Right. Now this gets bifurcated into two: material price variance, material usage variance. Price variance responsibility. Purchase manager formula: standard price minus actual price into actual quantity. Perfect. Now reason, you know, dependency, one-way traffic. On the other side, usage variance responsibility: production manager. Standard quantity minus actual quantity into standard price. I am not dependent on him. Now this usage variance gets further classified into two: material mix variance, material yield variance. Mix variance formula: revised actual quantity minus actual quantity into standard price. Perfect. Now your yield variance formula: standard quantity minus revised actual quantity into standard price. Excellent, guys. That's about this entire area. Are you clear with this, guys? So simple this is. Why should you mug up? As simple as that, no? Guys, clear with this, guys? Yes, literally I'm telling you, literally with this, we have covered your material variance, labor variance, as well as your variable overhead variance. You will be seeing that here instead of quantity, there will be hours. That's all. Right? And instead of price, it will be rate. Every other concept is same. Some little concept like idle time and all these things alone will be there. Clear with this, guys? Right? And look, this sum, you got it right. So first thing, the first issue is with respect to calculation of standard quantity. For that, what you should do, take the actual output and put it here. For the actual output, what should have been my material input is the calculation. Clear with this, guys? Go and update your library for adjustments right now. Write down. MCV, material cost variance hyphen mix of raw material with loss. Mix of raw material with loss. Mix of raw material with loss. Done, guys? Shall we proceed forward? Yes. Now take the next question, question number 3. With that, we'll be finishing material related variance. There's some practice questions that I've given you here. Please practice it. Now, question number 3. Come on, take it, guys. Come on, let's do this. Shall we? Let's do this. Come on. Now, one small adjustment variant in this question. We will be having some stocks and all. If there is a stock, how do you go about with this? We will learn. And with that, all the varieties of material variances will be over. That's all, guys. It's very simple, provided you have the right way of understanding. Shall we start? Perfect. Now let's do this. ABC Limited produces an article by lending two basic raw materials. They have used some American English now. Lending means using. Now, it operates a standard costing system, and the following standards have been set for raw materials. AB, standard mixing, 40-60. Price, 4 and 3. Standard prices readily given. Next, the standard loss in processing is 15 percentage, and during April the company actually produced 1700 kgs of finished output. You know how to reverse work and calculate A and B required. Required means what? Standard quantity. Done just now we did similar. Now the position of stock and purchases for the month of April are as under. Now first they have given A and B. Opening stock given, closing stock given, purchases during the month is given, and the rate is given. Clear with this? Clear with this, guys? Rate, rate as in the value is given, which means they purchase 800 kgs of A by paying how much? 3,400, which means what is the actual price? 3,400 by 800, how much is it? 4.25 is going to be my actual price. For product B, it's going to be 3,000 by 1,200, how much is that? 3,000 by 1,200 is going to be 2.5. Clear with this, guys? You got it? Any problem here? No. The opening stock of raw material is valued at standard price, right? So opening stock is valued at standard price. Calculate the following variances. Basically, all the variances they have asked for. Now, guys, what do you do? How do you go about with this? First one. In this question, you know how to compute standard quantity, correct? Actual output is 1700, loss allowed 15%, reverse work, arrive at the total input to be done, and on that 40% A, 60% B, not a problem, you know how to do it. But this question for a change is on, the issue is on the actual quantity side. Now what they have given, simple, guys. Opening stock 35, closing stock 5, current year purchases 800. Now here if I am preparing your SLC ledger, opening stock of raw material, purchases, closing stock of raw material, the balancing figure is called as raw material consumed, correct? Now they have given me, this is 35, this is 5, this is 800. Now if I knock these three things off, I'll get my actual quantity consumed. How much is that? 35 plus 800 minus 5 gives me 830. This is going to be what? This is going to be my raw material consumed. Clear with this, guys? Now wait, that is not the end of the story. One more adjustment is there. Now what is it? You should assume in this case, now you have multiple lots of receipts. Each lot is valued at different rates. How, sir? Your opening stock is valued at standard price. What is the standard price? 4 rupees. And current year purchase is valued at actual price. What is it? 4.5. Obviously stock valuation issue comes in. So now what you will do, sir, I want to compute variances. Simple, use FIFO. So now this 830 is there, no? Bifurcate it into 2. So opening raw material, opening stock consumed is going to be 35, and balancing figure, how much is that? 795, right? That's going to be out of the current year purchases. And for this, the actual rate, you will take it as 4 rupees. For this, you will take the actual rate at 4.25. So when you are computing the variances, what you need to do, inside A also, for the first lot, what is the variance? Second lot, what is the variance? You need to do. Are you all clear with this, guys? Any issues here? No. As good as this is treated as different varieties of raw material inside material A. Guys, clear with this? Yes. So lot wise compute the variances. That's all. No. What is the big deal here? Are you all understanding? Are you all understanding? But this problem will be there only if you are calculating the, when you are calculating the price variance. Guys, correct? What is the price variance formula? Standard price minus actual price into actual quantity. Correct? So this is where the problem will be. You are using actual prices and all. Two different prices are there. Usage variance, what is the formula? Standard quantity minus actual quantity into standard price. Here only standard price I'm using, which is 4. And what is my standard quantity? We will compute that. Actual quantity 830. Quantity only they're asking, no? So here this lot issue will always be there only for your price variance. So when you have stocks, the problem comes only with respect to calculating your price variance, not with respect to your usage variance, because with respect to usage, we only track the actual quantity. Quantity is not dependent on rates and all that, guys. Clear with this, guys? Are you all understanding this? Is everyone able to follow this? Shall we do this sum? Yes, simple. Now you get it. You get the point. Similar calculations you need to do for B as well. Shall we get started? Shall we get started? Yes. Now guys, you tell me, what will you do? The same thing. Raw material type A, B, input, loss, and output. Now guys, one thing I want to tell you. you write this as loss, don't write it as standard loss. Why? Loss on the standard column is called as standard loss. This loss in the actual column is called as actual loss. So you need to use a common terminology here. Clear with this? Because in this column also we are filling the loss. That is not standard. That is actual figure. Are you all understanding? Are you all able to follow this? Yes. So now, shall we do this, guys? Now, I want you guys to tell me the figures. First, what are the figures available? First, let's fill the easy figures. Standard price, actual price. Shall we do it? Okay, fine. Now, for standard price, how much is it? 4 and 3. Now, actual price, okay, for that first we need to fill the actual quantity, guys, correct? Now, actual quantity, just now we saw, I have consumed a total of 830, out of which 35 comes from my opening stock, 935 comes from my current period purchases, correct? So here, 35 at the rate of 4, 795 at the rate of 4.25. Any problem here? Guys, yes, you guys are clear with this? Next one. Now, for your product B, what happens? Similar story there, no? Opening stock 40, current year purchase 1200, closing stock 50. So which means how much was consumed? So 40 plus 1200 minus 50, how much is that? 1190, correct? And out of this, I will further bifurcate. 40 came out of opening stock. The remaining 1150 comes out of my current period purchase. Now 40 should be valued at standard price. What is it? At the rate of 3. And how about your current period purchases? It should be valued at 2.5. Are you all clear with this? Actual figures. These are actual figures. So 40 at the rate of 3, 1150 at the rate of 2.5. Any problem here? So now we have filled up the standard price, actual quantity, and actual price. Clear with this, guys? Yes. Any problem here? So now what we can do now? So now what we can do is, now add up all the input columns. So now totally, basically this is nothing but 830, yeah? And this is nothing but 1190. Am I right? Add up the two. 830 plus 1190. How much is that? 2020 was the total input. But they have given effectively what is the output they got? 1700 was the effective output they got, which means there was a loss of how much? 320. It's a balancing figure. Clear with this, guys? Now, first thing that I will do is what? Next, immediately put it here. For my actual output, what should have been the kgs of A and B? I should have input. That's called a standard quantity. Now, how do I do that? You're allowed to have a loss of 15% on dash input, on your input. If nothing is mentioned, it's on the input. Don't assume that 15% on production and all. That's in your process costing area, right? So you guys said you like process costing, no? Yes, I got reminded of that. So don't get reminded of it here. Okay, so now that into 15 here, effectively you get what? 85. Now, you know to do the calculation. What do you do? If 1700 is equal to 85, how much is 15? 1700 divided by 85 into 15. How much is that? 300. And accordingly, you can add it back, or you can say if 1700 is equal to 85, how much is 100? How much is it? Yes, it's going to be 2000. Guys, clear with this, guys? Are you all understanding this? So totally you are allowed to input a total input of 2000 kgs, and that should be in the ratio of 40 is to 60. So 0.4 into 2000, 800, 0.6 into 2000, 1200. Now literally, guys, I got all the figures. Now you can start and substituting all the formulas and do the sum. Shall we do it quickly? Yes. Now one more thing I want to tell you. In the previous question, everything ran into decimals, no? Deliberately they have kept it like that because the moment something runs into decimals, students have the mindset we have made a mistake. Yes. So literally, guys, that's to break your confidence. You should have the confidence that, look, I'm not going wrong. I have overconfidence, but yes, somewhere if something is going in decimals, we would just give it a look. Okay, I'm fine. That's all. This is just to test my confidence, because beyond this it cannot be the case. Many students told me that, sir, it was running into decimals. Yes, I still remember some students, not in this question, some other question, I don't know exactly which concept. Sir, I got an answer, sir, so much point cut, so and so. Said, that's the right answer. Sir, Abdiya, sir, I lost my complete confidence. That was actually some second sum or so. Literally throughout the paper, it was carrying forward. Guys, it's a test of your emotions. Be strong. Be strong. If at all it's going wrong, forget. Let it be wrong. You go to the other sum, at least that you will get it correct. Do not carry it forward. CA exams are a test of your emotions. I'm again and again telling you. And half the students fail even before they enter into the exam hall because of that fear. Right? So please have that in your mind. Be confident in your preparation. Go do it. As simple as that. Shall we proceed forward now? Yes. Now, first, guys, what do you do? Material cost variance, no? Fine. So basically, guys, that's nothing but standard material cost minus actual material cost. Or in other words, it's standard price into standard quantity into standard price minus actual quantity into actual price. So here itself, you can multiply that, no? 800 into 4 is 3200. 1200 into 3 is 3600. So the total cost, your material cost allowed to incur is 6800. But actually incurred how much? 35 into 4, 140. 795 into 4.25. How much is that? 795 into 4.25. How much is that? 3378.75. Here 40 into 3 is 120 and 1150 into 2.5. How much is that? It's going to be 2875. Add up everything. What do you get? 6513.75. So you were allowed to incur a material cost of 6,800 rupees, but you have ended up incurring only 6513.75. Your adverse or favorable? Favorable variance, but you cannot stop it here. You need to find out which is the guy, who is the guy responsible to what extent, and that too inside the usage area, whether you have done cheating or not, you need to calculate. That is mix variance, yield variance, how much effectively you need to calculate. Let's quickly do that. So now, guys, here it's 6800 minus 6513.75. How much is that? It's going to be how much? Yes, it's going to be 286.25. Clear with this, guys? And it's a favorable variance. Is the topmost figure. It's bifurcated into what and what? Price variance and usage variance. Correct, guys? Yes. Yes, sir. Price variance and usage variance. Price. Now, guys, here, now if you look at this, 1 minute. On the opening stock units, it's valued at standard price. So there will be no variance for them, no? If at all you want to do, what will you do? Okay, standard price 4 minus actual price 4 into your standard quantity. Guys, correct? So into actual quantity, into 35 you will do 4 minus 4, 0 into 35. Guys, correct? That is, on the opening stock units, there is no price variance. Guys, correct? So directly, can I only apply the price variance on the remaining units? Are you all understanding? Yes. So here what I will do here. So on the actual quantity of 795. So standard price is how much? 4. Actual price is 4.25. Clear with this? Compute the variance. Similarly for B, standard price 3, actual price 2.5. On the actual quantity 1150. Clear with this, guys? On the opening stock units, there is no variance because it is already valued at standard price. Clear with this, guys? Is everyone able to follow this? Are you all understanding this? So now tell me, guys, what is the figure? So 4 minus 4.25, I've incurred more than what I was supposed to. It's going to be an adverse variance, correct? So it's going to be 795 into 0.25. How much is that? 198.75, and that's an adverse variance. Here 3 minus 2.5, favorable or adverse? Allowed to incur. 3, you have incurred only 2.5. It's a favorable variance. 1150 into 0.5. How much is that? 575 favorable. Knock off the 2. How much you get? Net off, I get 376.25 favorable. Clear with this, guys? That's going to be my price variance. And how about usage variance? Formula: standard quantity minus actual quantity into standard price. So now, what's your, please have the question with you. Tell me, guys, what's it? I mean, the top figures. So for A, standard quantity 800, actual quantity 830. Guys, correct? Everything put together. Correct? Right? Into your standard price of 4. Similarly for B, it's going to be standard quantity 1200 minus actual quantity 1190, both put together into your standard price of 3. Guys, clear with this? Any problem here? You arrive at it. Here you were supposed to consume 800, you consumed 830. Difference adverse 120. Here 1200 was allowed, you only consumed 1190. Is it a good variance? Yes, at favorable variance to the extent of 10 rupees into 3, 30 rupees favorable. Net off, you have 90 adverse. Knock off these two and try to get your daddy figure. How much is that? So it's 376.25 minus 90. It's going to be 286.25. That's going to be your daddy figure. Clear with this, guys? And further usage should be subclassified into mix variance and yield variance. Correct? Mix variance. What is the formula? Revised actual quantity minus actual quantity into standard price. Now, what's my total actual quantity? Total input. Input I'm saying. What is the total input? 2020. So revised actual quantity alone we will compute now. So total actual was 2020, right? A and B should have been in the ratio of 40%, 60%. 20 into 0.4 is equal to 808. And here this has to be 0.6 is equal to 1212. So 808. And what's the actual quantity, guys? You guys know that? How much is that? 830, 1190. Add up, you get 2020. Correct? So here 808 revised actual quantity minus 830 into your standard price. How much is that? 4 rupees. Now you were allowed 808. You took how much? 830. Difference is actually an adverse variance. So 88 adverse. Similarly, 1212 is allowed. You took only what? 1190. So now the difference into 3 is going to be 66 favorable. Net off. Net off, if you see what you get, 22 adverse. Clear with this, guys? Why is there an adverse variance? Material A, material B, which is costly? Material A. Now I am using more of material A and less of material B, more of a costly material, and hence I am getting an adverse variance. Clear with this, guys? Are you all understanding this? This is how it needs to be interpreted. Clear with this, guys? And on the contrary, your yield variance is actually the balancing figure. Standard quantity, these figures you have, standard quantity at the top you have no 800, 1200 minus revised actual quantity 808, 1212 into the respective figures, you get 68 adverse as a whole. Guys, are you all understanding this? Isn't this simple, guys? Isn't this simple? Very easy, right? Provided you just learn this conceptually, please don't ever mug this up. Are you all clear with this, guys? Is everyone able to follow this? Yes, right? And that's about this question. Please go and update your library of adjustments. Write down. Write down. Write down. MCV hyphen mix of raw material with stocks. Mix of raw material with opening and closing stock. You please write it. Mix of raw material with opening and closing stock. Mix of raw material with opening and closing stock. Done? Now guys, that's about it. Don't worry, I'm not going to do any more sums, but just in this case, stock alone, one explanation I need to give, and with that we'll be through. Wait. So, 1 second. Now, guys, when there is stock, now, there is one small adjustment here, a very important and a critical understanding. It is mentioned in the study material theoretically, but sums when they did, when there is a stock, whatever we saw right now, that's how you need to compute. Clear with this? But that's not a very correct way to do. But let me tell you, guys, everyone, please carefully listen. It's a very important understanding. Now you guys are going to tell me the formula for material cost variance. Formula: standard quantity into standard price minus actual quantity into price. Correct. Actual quantity into actual price. Now this is bifurcated into broadly two. Correct? What and what? Material price variance, material usage variance. Formula: standard price minus actual price into actual quantity. Here, formula: standard quantity minus actual quantity into standard price. Very good. Now, logically, you think and answer. This is the responsibility of whom? Purchase manager. This is the responsibility of whom? Production manager. Very good. Now, when I am judging the performance or the efficiency of the purchase manager, strictly speaking, you guys tell me, actual quantity refers to actual quantity consumed or actual quantity purchased. You think and tell me logically. This guy is responsible for purchasing or consumption? Purchasing. For every raw material that you purchased, on that only you should judge his performance. How much consumed? That is not my concern. I don't even know that. correct? So literally here, actual quantity should stand for actual quantity purchased, correct? Whereas on the other side, this guy is whom? Production manager. Here, actual quantity stands for actual quantity consumed. So now the price variance has this issue. Now remember, there are two ways in which you can calculate price variance. Method number one, the variance can be calculated at the time of purchase. If the variance is calculated at the time of purchase, then actual quantity and the price variance stands for actual quantity purchased. Clear with this? In that case, now you can't do the top figure and say that now MPV plus MUV is like this. No, first you can never do the top figure. Why? Because on one side you take actual quantity purchased, on the other side you take actual quantity consumed. In this case, material cost variance need to be arrived. How? Arrive at the price variance, arrive at the usage variance, add the two and call it as cost variance. Clear with this, guys? Are you all understanding this? The second method which we've been doing right now is, no, we will compute the variance only at the time of consumption. If you take this stand, then in this case, what happens? In this case, you will actually take actual quantity as your actual quantity consumed in both the situations. Clear with this, guys? In this case, whatever we did till now is acceptable. Clear with this, guys? Now, one more small thing. Between the two, which is correct? Strictly speaking, first one is correct. Why, sir? Why, sir? Now, what happens if I am actually calculating the variance at the time of purchase itself, correct? Now, clearly I will know what is the variance. Clearly I will know what is the variance, and any extra efficiency or inefficiency, I will remove it from it and I will value my stock at standard cost. Suppose I am not doing the variance analysis at the time of purchase, my stock will be valued at actual cost. Actuals will have efficiency, inefficiency. It defeats the objective. Clear with this, guys? To this extent, it is conceptual. Clear with this, guys? Are you all understanding? Strictly speaking, that is the correct method, and I am telling you that there are two methods, but in the absence of information, you can follow that method which we followed right down. That is, we assume that even the price variance is actually calculated at the time of consumption. Take the actual quantity under the price variance as actual quantity consumed only. Are you all understanding this? Are you all understanding? If at all in the question, if they give you that actual quantity, your price variances are computed at the time of purchase, then what will you do? Then you will compute the price variance separately, then you will compute the usage variance separately, add the two and call that as cost variance. Don't first compute the cost variance and segregate. It will never tally. Clear with this, guys? This is what I wanted to tell you. Are you all understanding this? Are you all understanding this? A very important discussion here. Clear with this, guys? So we will just wrap it up, but before that, I'll just show this to you. This is what I have mentioned. Overall, the big picture of this chapter, I have mentioned total cost side variances, material, labor, overheads, under overheads, variable and fixed. And here we did the first variance called as material cost variance. Under that we had price variance, we had usage variance. Under usage we did mix and yield variance. Clear with this, guys? Yield variance is also known as material sub-usage variance. Usage, sub-usage. Clear with this, guys? Right? So this is also known as, you can just write it down here itself. It is called as material sub-usage variance. Clear with this? Material sub-usage variance. Clear with this, guys? Are you all understanding this? Yes. And all these formulas I have given here. All the formula I have given here. And one second. I have mentioned under price variance, I think so. Yes, look at this. Look at this. Material price variance can also be calculated by taking the material used as the actual quantity instead of material purchase. There are two ways of doing it. I told you this method is also correct, but does not serve the purpose of variance computation. If you take actual quantity as actual quantity consumed, strictly speaking, it's wrong. So procedurally, for calculation purpose, it is easy, but strictly speaking, it is wrong. And all these things I have mentioned. So doubt buster here, actual quantity means actual quantity of material purchase. Ideally, that is only correct, guys. Correct, right? If in the question the material purchase is not given, it is taken as equal to material consumed. MPV can also be calculated by taking the material consumed as the actual quantity instead of taking material purchase if both the figures are available. This method is also correct, but it does not serve the purpose of variance computation. Students should write a note in this regard in exams. Clear with this, guys? This is something that I've kept in the doubt busters, what it is and all. We have seen it in detail. Are you all understanding this, right? And with this, the total material cost variances are completed in all aspects, right? And guys, you are good to go with respect to this chapter. This is a launching pad to enter into this chapter. Just see how quickly the remaining sums we can finish it off. Labor and variable overhead variances and all. Just like that, you can finish. Fixed overhead variances alone. Some calculation and some conceptual knowledge is required. So once we do that, the entire chapter will be over. Clear with this, guys, right? So with this, I'm concluding this session. Please do revise till whatever we've covered till now. And I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, standard costing. So till now, so in the previous session, we got started with this chapter, standard costing. So we saw the introduction and we saw why we are studying this chapter and all that. And we completed one variance that is called as your material cost variances. Now, shall we move on to the next variance called as your labor variances, shall we, guys? Yes. Now let's move on to the second variance called as labor variances. Now our costing standard, our chapter standard costing, we compare what with what? Standard cost with your actual cost. Guys, correct? We don't compare the budget with actual. So labor cost variance means what? Any variance happening on the labor side, that is with respect to your labor cost, is called as labor cost variances. So obviously the formula or the logic here is going to be standard labor cost minus actual labor cost will be called as your labor cost variance. Agreeing with me, guys? Yes. Now once again, let me just take an example for you. Now let us say the standard hours to produce one product is 10 hours, right? And the standard rate, so in your labor you call it as hourly rate, guys, correct? The standard rate per hour, let us say, is 100 rupees, right? Sorry, so it's 100 rupees, and actual hours taken, let us say, is 12 hours, and the actual rate, let us say, is 90 rupees. This is the data, right? With this, shall we compute the variances? Yes, guys, shall we? Now, in your labor variances, you will be having what? First, your labor cost variance. The first thing, the topmost figure, is called as labor cost variance. Now, you guys tell me what should be the formula. Come on. Standard hours into standard rate minus actual hours into actual rate. There it was quantity, here it is hours, there it was price, here it is rate. As simple as that. That's why I said the moment you finish material variances, labor and variable overheads are completely over. Shall we do this quickly? Yes, come on, guys. Let's fill these figures up. So I'm just putting up the formula here. Standard hours into standard rate minus actual hours into actual rate. Now, here it's going to be what? 10 hours is what you should have taken, and every hour you should have paid 100 rupees, whereas you took a total of 12 hours, and every single hour you actually ended up paying 90 rupees. Come on, tell me, guys, what's the standard labor cost? You should have incurred a total of 1000 rupees, whereas you ended up incurring rupees 1080. So here you tell me you should have incurred 1000, you have incurred something more. Is it a favorable or adverse variance? It's an adverse variance, rupees 80 within bracket adverse. Clear with this, guys? Any problem here? No. Now, this material cost variance can be broadly classified into two. It can be broadly classified into two. What and what? There we saw material price variance. Here we call it as labor rate variance. Guys, clear with this? Everything is same. So labor rate variance. Then on the right side of the chart, there we saw material usage variance. Here usage of labor is actually called as efficiency. You are judging the efficiency. Guys, clear with this? So here we call it as labor efficiency variance. Any problem here? No. So now labor rate variance. First, who is responsible for the rate? HR department. Guys, correct? HR department is responsible for the rate. With respect to efficiency, who is responsible for the efficiency of the workers? No, the labor is basically the production department, because the production head, the plant head is the person who is responsible for all the production, who is responsible for getting the things done. Guys, correct, right? Yes, correct, guys. So now in this case, who is responsible for your efficiency? Obviously, this guy, the production department. When I say production department, this guy is the production head, is responsible for whatever is happening inside the factory shop. Guys, clear with this? Are you all understanding? Any problem here? No. Now, labor rate variance. Rate variance, who is responsible? Come on. HR department. Now, his responsibility is only on the rate. Now, what comes within the bracket? Come on. Standard rate minus actual rate. Now he needs to pay whatever is a rate on the actual hours. He doesn't have the control over the hours. He can't say, why did you work so much? No, whatever the hours the employees are made to work by the production department, for those many hours he is responsible on the rate. Guys, correct? So the HR department is responsible, is actually dependent on the production department for the hours. Guys, correct? Yes, so standard hours minus actual hours into actual rate. Now here you tell me the figures. You should have paid how much? Sorry, it's actual hours. Sorry. So into actual hours. Sorry, guys. Yes, actual hours. So now here you tell me standard rate. You should have paid how much? 100. Actually, you ended up paying how much? 90. Now into actual hours, how much? I told you 12 hours. Now you should have paid 100 rupees, but you had a very good negotiation with the workers. Somehow you stuck the deal for just 90 rupees, which means every hour you saved how much? 10 rupees for the company into 12. How much is that, guys? Rupees 120. Favorable or adverse? It's a favorable variance. Clear with this, guys? Are you all understanding this? Now, on the contrary, labor efficiency variance. Efficiency variance, what this is what I will compare. The standard hours, I will be comparing it with actual hours. Now, into what I will do? Standard rate. I should not take actual rate, because the production department is not dependent on the HR for anything. If at all I take the actual rate and plug it here, then I am passing on the efficiency or inefficiency of the HR to the production manager. Are you all clear with this, guys? Same logic, guys. Same logic. Come on, tell me, guys. The figures here. Standard hours. How many hours you should have taken? 10. But you have actually taken how many hours? You've taken 12 hours. Into standard rate, how much is that? Rupees 100. So now you took 2 hours more. Guys, correct? Yes, 2 hours more. And into 100, that's going to be 200 rupees adverse. So if you net off these two, you get the daddy figure. That's 80 adverse. Guys, clear with this? Are you all understanding this? Any problem here? Any problem here? Absolutely not. Now, shall we just go do one sum? Shall we do one sum? Yes, let's go and knock off one question. So please take question number 4. Please take question number 4. Now, the standard and actual figures of a firm are as under. The standard time for a job is what? 1000 hours. So to do a job, you are allowed to take how many hours? 1000 hours. Standard rate per hour? 50, but the actual time taken is how much? 900 hours. The actual wages paid is given as 36,000. With this, you can calculate what? Actual rate. Actual rate is how much? I paid 36,000 for 900 hours. Per hour, actually, how much have I paid? 40 rupees. So now, guys, you need to calculate all the labor variances. Now, to compute labor variances, how many figures do you need? 4 figures. What are they? Standard hours, standard rate. Actual hours, actual rate. Standard hours 1000, standard rate 50, actual hours is 900, actual rate just now you guys told me 36,000 divided by 900, it's going to be 40 rupees. Any problem here? No. Shall we just go and do the variances? Yes. Now, guys, everyone, please again and again keep telling it. It will stay here. Now, labor cost variance formula. Standard hours into standard rate minus actual hours into actual rate. Standard hours is how much? 1000 into standard rate. So I'll put it here. 1000 into standard rate is how much? 50 minus actual hours. How much is that? 900 into actual rate. How much is that? 40. Now, guys, calculate. This is going to be 50,000. 50,000. This is going to be 36,000. So you were supposed to incur 50. You ended up incurring only 36,000. So now tell me, guys, what is the difference here? 14,000. Adverse or favorable? Obviously, it's a favorable variance. You have incurred something less than what you're supposed to. This will only increase your profit. Guys, clear? Now, who is responsible for this? Now, I need to segregate and see labor rate variance and labor efficiency variance. Labor rate variance, responsibility. HR manager. Formula: standard rate minus actual rate into actual hours. I am dependent on whom? I am dependent on the production manager for the hours. For every hour he is making the employee work, I am responsible for the rate. Guys, clear with this, guys? Figures here. So at standard rate, you were supposed to pay 50, huh? Yes, but you ended up paying only 40 into your actual hours, 900. That's going to be 9,000 favorable. So overall 14,000 is the labor cost variance. It has increased my profit by 14,000. Out of this, to the extent of 9,000 rupees, my HR manager has contributed. Guys, clear with this? So accordingly, I will reward him or punish him. In this case, I will reward him. Guys, clear with this? Now, on the contrary, on the other side, you've got what? Efficiency variance, responsibility, production manager. Clear with this? Now, this production manager, right? So what is the formula here? Standard hours minus actual hours into standard rate, not actual rate, because I am not dependent on the HR manager for anything, so I cannot take the actuals. Guys, clear with this? As simple as this. Now, tell me the figures here. Standard hours, 1,000. Actual hours, 900. Into standard rate, how much is that? 50. It's going to be how much? 5,000. Add up the two, you get the daddy figure. Yes, 14,000. Guys, clear with this? So 14,000 rupees is the overall favorable variance in my labor cost area. Out of that, to the extent of 9,000, it is attributable to the efficiency of my HR manager, rate variance, HR manager, and to the extent of 5,000, it is attributable to the efficiency of my production manager. Clear with this, guys? Now, accordingly, I can reward these guys for whatever contribution they have made to my company. Are you all clear with this, guys? Yes. Now, just go and update your library of adjustments. Write down LCV hyphen, write down LCV hyphen single skill set. Just write down single skill set. Single skill set. See, in labor also you can have different. In your material you had multiple type of raw material. In labor you can have different type of skill set. So which means based on every skill, a skilled laborer will be paid an hourly rate more. Semi-skilled little less, unskilled very less. So you can have different variants and all. In this case, that mix variance kind of thing can come here. That is called as gang variance and all. What it is, we will see. Clear with this? Yes, it's called gang variance. A few people together is called as a gang, crowd or a gang. So it's called as a gang variance, right? What it is, we'll be seeing. Guys, are you all clear with this? Right? Shall we proceed forward? Shall we proceed forward? Yes. Now, I gave you guys an example, I gave you guys an example here, right? Now, this example, let me just tweak this a bit. This example, let me just tweak this a bit. Now, I am just taking this and have an option to copy. Okay. Okay. Now, guys, what I'm doing is, now, look at this. Look at this. Let's say the standard hours required to produce one product is how much? 10 hours. Standard rate is how much? 100, right? Now, what I'm doing is, I am just making a small difference here. Now, actual hours for which I am paying my employees is going to be how much? 12 hours. That is, they have actually taken a total of 12 hours. Now, I'm giving you guys one breakup here. Now, actually seeing the actual hours for which they worked was only, let us say, 11 hours. Why, sir? Because there was an idle time of 1 hour. Clear with this, guys? Idle time means I'm talking about abnormal idle time. Clear with this, guys? Right? Are you all clear with this? So now what happened? They came to my factory. They started working on this particular product. Now 1 hour was due to power cut. They had to sit in the dark. you tell me, I will have to pay them even for this 1 hour. They came because of my own inefficiency, right? What happened? I am making them sit for 1 hour idle time. Guys, clear with this? So now here this actual hours stands for actual hours paid. So I need to pay them for the 12 hours. But actually seeing what they did was they took this 12 hours overall that included 1 hour of idle time. But in 11 actual working hours itself, they completed the product. This is the scenario. Are you all clear with this, guys? Is everyone able to follow this? Are you guys able to understand? Yes. Now let's compute the variances. Now, labor cost variance. Come on, guys. Everyone, tell me. So that's standard labor cost minus actual labor cost. Now, formula, you guys tell me. Everyone, standard hours into standard rate minus, now actual hours, I will take the entire actual hours paid only, no? Guys, correct, because my actual cost I'm incurring for the 12 hours worked. Guys, clear with this? Actual hours paid into actual rate. Any issue here? No. You guys compute and tell me. This is 10 hours, standard hours, into rupees 100 minus 12 hours into rupees 90. Guys, correct? This is going to be rupees 1000. This is going to be rupees 1080. They have incurred a little more. It's going to be rupees 80 adverse. Correct? Any problem here? No. Now, I am broadly classifying this into two: labor, rate, variance, and labor efficiency variance. Rate variance, responsibility. HR manager, he's responsible for the rate. So what comes inside the bracket? Standard rate minus actual rate, but this is on actual hours for which I'm paying him. Guys, correct? So he has to pay for the entire 12 hours. So here it's actual hours paid only. Any problem here? Guys, clear with this? There is no problem at all here. So now tell me, what is the standard rate? You were supposed to pay 100, but you have ended up paying only 90 on all the actual hours of 12. Any problem here? No. So figure, you tell me. So 10 into 12, 120. Yeah? 120. Is it favorable or adverse? Obviously a favorable variance. Any issue here? No. Now let's go on to the other side. Labor efficiency variance. Now, who is responsible for this? Production manager. Now you guys tell me, this production manager, I'm judging his efficiency. Now what is the general formula that we use here? Standard hours minus actual hours into standard rate. Now when I am judging his efficiency, you guys tell me, he should have taken how many hours? He should have taken how many hours, pa? 10 hours. But he actually completed the work in 11 hours. When I'm judging the efficiency, I can't take 12 hours and compare. It means that you are saying he's actually taken 12 hours. No, that was not his mistake. Guys, clear with this? Sir, 1 hour, sir, lost. That is not the mistake of this workers or production manager. That is your maintenance department problem. They should have maintained it properly, or they should have had a good dealing with your EB department, electricity board, and all. The power cut should not have happened. Guys, correct? So now do not pass on the efficiency or inefficiency of the maintenance department to the production department. So here when I am comparing, I will compare standard hours with actual hours worked, not actual hours paid. Guys, clear with this? Are you all understanding this? Are you all understanding this? So here, what will be the formula for labor efficiency variance? Everyone, standard hours minus actual hours worked. Guys, correct? Are you understanding the logic? For the actual hours he has worked, how many hours he should have taken versus how many hours he has actually taken to to complete this particular job? Into what? Into standard rate. Figures, you guys tell me. So now standard hours is how much? 10 hours. But actual hours worked is how much? 11 hours. Into what? Standard rate. What is your standard rate here? It's going to be 100 rupees. So tell me, guys, how much is it? So literally he has taken only 1 hour more than what he was supposed to take. It's going to be what? 100. Adverse or favorable? Obviously adverse. Clear with this, guys? Sir, now, sir, for that 1 hour, sir, 1 hour, what is that? Bring in a separate variance called as labor idle time variance. Clear with this, guys? What is it called as? Labor idle time variance. Simple. idle time into standard rate. The difference, no, the difference here, so that is going to come here as idle time into what? Idle time into standard rate. Are you all clear with this? Idle time into standard rate, or if you want, idle time is nothing but the difference between your actual hours paid and actual hours worked. Guys, correct? So you can also say this is nothing but actual hours worked minus actual hours paid. The difference between these two is only your idle time variance. Guys, are you all clear with this? And now what is the idle time here? Guys, 1 hour into how much? Into rupees 100. So how much is that, guys? It's going to be rupees 100. Always it is going to be in adverse. It can never be in favorable. Clear with this, guys? Are you all understanding? Now you add these three figures. Do you get your daddy? Yes, you get it. So 100, 100, 200 adverse minus 120 favorable. Net off you get what? 80 adverse. Are you all clear with this? And this 100 variance, I will pin it to whom? I will pin it to the maintenance department. Are you all clear with this, guys? Any problem here? Any problem here? So literally, guys, literally your overall labor variances is actually seeing classified into three. What, and what? Everyone. Labor rate variance. Who is responsible? HR formula. Standard rate minus actual rate into actual hours paid. Completed. Actual hours paid. Now on the rightmost corner, efficiency variance. Responsibility. Your production manager. Formula. Standard hours minus actual hours worked into standard rate. Sir, here we have taken paid, here we have taken worked. The difference comes under your labor idle time variance. Formula, idle time into standard rate. So that is always going to be an adverse variance. Or you can also say idle time is nothing but actual hours worked minus actual hours paid. Clear with this, guys? It has to be negative. Guys, clear with this, guys? Are you all understanding? As simple as that. And that's about this area. Shall we just go and do one sum here? Yes, let's go and do it. Please take question number 5. Please take question number 5. Now, the standard output of product X is 25 units per hour in a manufacturing department of a company employing 100 workers. So now tell me guys, now what is going to be the standard, the standard hours and all. Now guys, what is mentioned here? The standard output of a product X is 25 units per hour in a manufacturing department of a company employing 100 workers. What is the meaning of this? To produce 25 units, how long does it take? How long does it take? No, it actually takes 100 hours. What they are saying is it takes 1 hour if 100 people are simultaneously working on it. Clear with this, guys? Are you all understanding this? It will be over in 1 hour itself, provided 100 people are parallelly working on it. It means what? It takes 100 labor hours to complete 25 units. Are you all understanding this, sir? How do you know? Look at the complete wordings here. Read the sentence fully. The standard output of product X is 25 units per hour in a manufacturing department of a company employing 100 workers. Clear with this? Are you all understanding this? Yes? No. The standard wage rate per labor hour is how much? 6 rupees. Standard rate is given? Yes. In a 42-hour week, the department produced 1040 units of X, despite 5% of the time paid being lost due to an abnormal reason. Clear with this, guys? Now, the hourly wages actually paid were 6.2, 6, and 5.7 respectively to 10, 30 and 60 workers. Sir, why, sir? Everyone should have been paid at 6 rupees. Correct? There is no multi-skill set and all. Nothing is there. They have said, whoever is the worker, you pay him at only 6 rupees. But what they have done, they have created a differential treatment. For 10 workers, they have paid at 6.2. 30 workers, they have paid at 6 rupees. And 60 workers, they have paid at 5.7. Ideally speaking, they should have paid everyone at only 6. For these 10 people, they have paid more. Maybe they are friends. Right? And the 60 people, they have paid less, maybe because relatives. Okay? So this is how they have paid. It is wrong, no, guys? What, bro? It's very wrong, bro. No? Right? So now look at this. They shouldn't be doing this. Guys, correct? right? So basically there's only one skill set here, guys, correct? They have paid differently, so accordingly there are 3 different actual rates in this question. Guys, clear with this? Now the next one, calculate the relevant labor variances. So now what are the things that we need, guys? What are the things that we need? Standard hours, standard rate, actual hours, actual rate, actual hours paid, actual hours worked, and then the actual rates. Clear with this, guys? Right? Now I will give you a minute time. Please collect these 5 ingredients and keep. We will do. If you get these 5 ingredients, you can do the question. That's about it. Now 1 minute time I'll give you, guys. Do not look into the solution. Try to attempt and do it by yourself. Collect these 5 ingredients and keep. We will get started. And the online folks, pause the video now. Collect these 5 ingredients exactly after 60 seconds. Continue watching the video. Now, guys, now the first thing, let's compute the standard hours. What do you mean by standard hours? Hello? What do you mean by standard hours? For the actual output, how many hours you could have taken, that is called as standard hours. Now what is the actual output, guys? 1040 units. Now guys, you tell me, in this question what have they given? 25 units will be produced. If 100 workers are working simultaneously on it, then it will get produced in 1 hour. It means to produce 25 units, it takes how many hours? 100 labor hours or 100 man hours, guys, correct? Which means to produce 1 unit, how many hours you are allowed to take? So you can take for 1 unit 100 divided by 25, you can take 4 hours for every 1 unit. Now you have actually produced how many units? 1040 units, which means for 1040 units you are allowed to take a total of how many hours? 1040 into 4, a total of how many hours? 4160 hours is allowed. Guys, clear with this? Any problem here? No. And what is the standard rate, guys? It's given in the question as 6, so you can put it as 6 here. Guys, clear with this? Any problem here? No. Now what is the actual hours? What is the actual hours? You have some differential rates and all. So now we can compute this for each and every set of employees. Ideally there is only single set of employee, but these guys have actually created something, and hence we will do it set wise. Shall we, guys? Yes. Now 10 workers. Now there is how many hours in a week? 42 hours in a week. So 10 workers, each of them have worked 42 hours a week, which means these 10, so let's put it as 3 different groups, 10, 30 and 60. Now there are how many hours in a week? 42. So 42 into 10 is equal to, so this 10 workers have worked for totally how many? I mean they will be paid for how many hours? 420 hours. 30 is equal to, these 30 workers into 42, how much is it in total? 1260 is the total hours for which I will be paying them. Guys, correct? And how about the 60 workers? So it's going to be, your 60 is equal to, you get 2520. Guys, clear with this? Each and every worker is working for 42 hours every week. Are you all clear with this? Total it up. What is the total hours for which I'm paying them? 4200. Any problem here? No. Now out of this, what has been given in the question, 5% of the time is lost due to abnormal reason. So what will you do? So take 0.05 into the respective figures. 420 is equal to how much? Guys, 21. 1260 is equal to how much? 63. 126 is equal to how much? Sorry. 2520 is equal to how much? 126. Add up the 3. Totally, what is your abnormal idle time here? It's going to be 210. Any problem here? Guys, out of the total actual hours paid, 5% is going to be your idle time. Clear with this, guys? Which means the remaining is your actual hours worked. Are you all clear with this? Any problem here, guys? No? So now, actual hours paid 420 minus 21. So actual hours worked is going to be 399. Here, 1260 minus 63. How much is that? 1197. Here, 2520 minus 126. How much is that? 2394. Total it up. They have actually worked for a total of how many hours, guys? Guys, 3990. Clear with this, guys? Now, actual rate, it is different. 6.2, 6 and 5.7. Put it up here. 6.2, 6 and 5.7. Any problem here? Guys, any problem here? So now we have literally computed what? The standard hours. We have computed standard rate. Then we have computed actual hours paid. we have computed actual hours worked, we have computed the idle time, and also we have computed the actual rate. Clear with this, guys? With this, we can go ahead and do the sum just by substituting the formulas. Now, guys, let's quickly do this here itself. Now, here standard, what is your standard labor cost to be incurred? You should have taken a total of 4160 hours, and every hour you should have paid how much? 6 rupees. Multiply the two, how much you get? 24,960 is actually your total labor cost you should have incurred. But what is the cost you have actually incurred? Actual hours paid into actual rate, guys. Correct? Right? Figures tell me. 420 into 6.2, how much is that? 2604. Then 1260 into 6, how much is that? 7560. 2520 into 5.7, how much is that? 14,364. Now total it up, how much you get? 24,528. Clear with this, guys? So basically, you were allowed to incur how much? 24,960. You have just incurred how much? 24,528 lesser. So is that a favorable or an adverse variance? Favorable variance. Any problem here? So now, guys, first labor cost variance, standard hours into standard rate minus actual hours into actual rate. Actual hours stands for actual hours paid only. Guys, clear with this? So here directly, since you have the figures, 24,960 minus 24,528, you get how much? 432. Favorable is the topmost figure. Guys, any problem here? Any problem here? Guys, direct formula substitution. Clear with this? Any issues? No. Next one, labor rate variance. Come on, guys, what is the formula? Without looking, tell. Standard rate minus actual rate into actual hours paid. I am not bothered about how much work, the idle time and all. Every hour you are spending inside the factory, I will have to pay you. That's all the HR department is bothered about. So now you have, now this one you need to do what? Respectively, because there is a differential treatment and all. Guys, correct? So now for the first set of workers, tell me, guys, standard rate is how much? For all the workers, 6. Actual rate is how much? 6.2 into actual hours paid is how much? 420. Guys, clear with this? So 6 minus 6.2, I paid more or less? More. Adverse variance. So 0.2 into 420, how much is that? 84 rupees adverse. Any issue here? No. For the second category of worker, there is no category. I have created something. Clear with this? So here if you see, standard rate is 6. Actual rate is also 6 into actual hours paid 1260. There is no variance here, 0. Because the standard rate is equal to actual rate, guys. Clear? The third one, what is it? Standard rate 6 minus actual rate 5.7 into 2520. Guys, how much is that? It's going to be 0.3 per hour. I am paying them less. It means I'm standing to gain. It's a favorable variance. 0.3 into 2520. How much is that? 756. It's going to be favorable, right? Net of everything is going to be 756 minus 84. The net of favorable is 672. Clear with this, guys? Next, rightmost extreme. Guys, you can also do it in a chart format. You are allowed. Don't worry about that. In exam, if you want to do it like that, you do it. Who is going to stop you? Basically, all these figures need to be there. That's all. So you can also put labor cost variance, branch it into 3 and all. First, you can branch it into extreme 2, and then in between, you can pull one branch and do it. Yes, you can do it, provided it's not looking congested. It's absolutely fine. You can definitely do it and add up the 3 and all. You can neatly present it just like how I taught you. It's absolutely fine. You can follow all this presentation in exam. Coming back here, efficiency variance formula. Standard hours minus actual hours worked into standard rate. So now, on the outside, I'm going to multiply everything only with standard rate, no? So what I can do, total standard hours is how much? 4160, and actual hours worked, I can directly take in total. Guys, correct? Because on the outside, I'm only going to multiply it with standard rate, no? Guys, correct? If you want to do it separately, there's no point in doing it. Guys, clear with this? So now, what is it going to be? 4160 minus actual hours worked in total is 3990, a whole into what? 6 rupees. So now, how much is that? These guys were super efficient. So 4160 minus 3990, these guys saved 170 hours for the company. Guys, correct? Into 6, how much is that? 1020, favorable. Are you all understanding this? Right? Now what has happened? There is an idle time. So idle time, how much is it? 210. So now your labor idle time variance is going to be 210 into standard rate is how much? 6 rupees. How much is that, guys? 1260 adverse. Immediately, if you get these 3 figures, what will you do? Go and add it up. So now here it's going to be 672 minus, 672 plus 1020 minus 1260. How much you get? 1 second. What did we do here? 1 second, 1 second. What happened, ma? Rate, efficiency, and idle time. Oh, sorry, boss. I should have taken this. Okay, 672 plus 1020 minus 1260. How much you get? Oh, 432. Right, that's the top figure. I'm sorry, guys. I got confused. Right, clear with this. You are getting the top figure. So yes, with that, we have completed this area. Any issue, guys? Any issue here? No. So now this is all about your idle time treatment. The first sum that we did was single skill set without idle time. So now we have done a single skill set with idle time. Clear with this, guys? Just go and update your library for adjustments right now. Write down LCV hyphen single skill set within bracket with idle time. LCV hyphen single skill set within bracket with idle time. Single skill set within bracket with idle time. Done. Shall we move forward? Now guys, if you have a multiple skill set, now what you will do all the calculations for every skill set wise, guys, correct? Skilled labor, semi-skilled labor, unskilled labor and all. If you have multiple skill set, do all the calculations for every single skill set. But apart from that, I told you, in your labor, in your material area, right? So under your usage variance, we further classified it into two, what and what? You had your mix variance and your yield variance. So here your efficiency variance will be further classified into two. One is called as your gang variance, the other one is called as your yield variance. Guys, clear with this, guys? Shall we do this? Yes, let's do this. The next question number, guys, question number 6. Now, labor type, there are two types of labor, what and what? Unskilled and skilled. Standard hours per unit is 2 and 1, right? What is this? This is not total standard hours per unit only they have given. This needs to be multiplied with the actual output to get what is the time you should have taken to complete the actual output. Guys, clear with this? Is everyone clear with this? Yes. Standard rate given, actual hours given, actual rate is also given. The workers produced 11,000 units. Find out the labor variances. First thing, in this question, do you have an idle time? Guys, you have an idle time. Please answer. Do you have an idle time here? No idle time. They have not given anything. So there is only one actual hours, which is actual hours paid is equal to actual hours worked. There is no idle time. Clear with this? Forget no idle time in this question. Now you just need how many ingredients? 4 ingredients. What are they? Standard hours, standard rate, actual hours, actual rate. Now, all the three are given. Standard hours alone, per unit they have given. What will you do? Multiply it with the actual output. So, unskilled laborers. So, now, we need to calculate the 4 ingredients. First, unskilled labor. So, now, you tell me, guys, what is the total unskilled labor hours you could have taken? 11,000 into 2. How much is that? 22,000. How about your skilled labor time? 11,000 into 1. 11,000. Any problem here? Clear with this, guys? Yes. Next, standard rate 10 and 20. Actual hours 22,000, 8,000. Actual rate 11 and 22. These figures are all given. Now with this, shall we do the computation? Guys, come on. Tell me the formula. First, labor cost variances formula. Standard hours into standard rate minus actual hours into actual rate. First, unskilled. Standard hours 22,000. Standard rate 10 minus actual hours 22,000. Actual rate is how much? 11. Guys, clear with this? So 22,000 into 10 is how much? 2,20,000. Huh? Yes, please add 1 0 here. Minus, so 22,000 into 11 gives you how much? 2,42,000. You should have incurred 2.2 lakhs. You have actually ended up incurring how much? 2,42,000. How much you have incurred extra? 22,000 adverse. How about skilled? It's going to be 11,000 into 20 minus 8,000 into 22. 11,000 into 20, how much is that? 2,20,000. 8,000 into 22, how much is that? 1,76,000. You were supposed to incur 2.2 lakhs. You have just incurred how much? 1,76,000. It's a favorable variance to the extent of 44,000. Any problem here, guys? Any problem here? No. Now, what is the total labor cost variance? So adjust the two figures, no? It's net of, how much is that? 22,000 favorable. Any problem here? No. This is the daddy figure, the top figure. Now classified into two, what and what? Everyone, rate variance, efficiency variance. Rate variance formula, standard rate minus actual rate into actual hours. Responsibility, HR department. Very good. Now, skill set wise, let's do it. Now, skilled. Okay, they've first done skilled. Okay, right. Skill set. How much is that? Yes. So, how much is it? 10 minus 10 now. I think there is a mistake here, no? Okay, standard rate for skilled is how much, guys? Oh, this is unskilled only, huh? Guys, sorry, guys. This is unskilled. This is skilled. I think they have done a, I mean, it's wrong. Guys, first they have done only unskilled. Unskilled standard rate is how much? 10. Actual rate is how much? Please change it. It is 11. Right? Into your actual hours. What is the actual hours? 22,000. You were supposed to pay 10 rupees. You ended up paying how much? 11 rupees. You paid 1 rupee extra for 22,000 hours. It's going to be 22,000 adverse. How about your skilled workers? You should have paid them standard rate 20. You have actually paid them 22 into actual hours. How much is the actual hours here? Sorry, actual hours is 8,000. Huh? Randomly they have done something. Okay, please change it to 8,000. But I think calculation is correct, no? Yes. So 2 into 8,000. How much is that? 16,000 adverse. Guys, clear with this. Now add up the two figures. How much you get? So 22 plus the 16. How much is that? So it's going to be 38,000 adverse. Clear with this, guys. Clear with this, guys. Overall on the top you've got a favorable variance, but here on the left side you've got an adverse variance, which means these guys have actually worked inefficiently. And on the efficiency variance side, the production department has worked super efficient. That's why even after an adverse variance on left side, you have overall got what? A favorable variance. This is how you need to interpret it. Clear with this, guys. Suppose this breakup was not there, overall you got a favorable variance. Both these guys will be rewarded. Guys, correct? So now I am further bifurcating and deep diving it, and now I am finding out, look, one guy has actually pulled down. Had this guy worked properly, my overall favorable variance would have been even more. Guys, clear with this. This is the kind of control that you can exercise in this particular chapter, standard costing. Are you all now understanding why this chapter goes on to achieve the objective of control? Clear with this. Now, go on here. Now, guys, efficiency variance formula. Standard hours minus actual hours into standard rate. Now, skilled workers, standard hours 22,000, actual hours 22,000 into standard rate, it is 10 rupees. Make a correction here, it's 10 rupees. Yeah, so how much is that? That's going to be 0 because they have worked whatever they should have taken, they have actually taken that time only. Unskilled workers, standard hours. What happened, guys? They have changed it again, huh? Okay, please. This is unskilled. This is skilled. Correct, guys. Please change it. So now, what's your standard hours? Guys, 11,000. Actual hours is how much? 8,000. Right? Into your standard rate. How much is that? 20. So now it's going to be what? It's going to be they should have taken 11,000. They have only taken what? 8,000. These guys were actually productive. Guys, correct? Huh? It's a favorable variance. So 3,000 into 20. How much is that? It's going to be 60,000 favorable. Guys, clear with this. Overall, 60,000 favorable is on the efficiency side. So now if you knock off the two, 60,000 minus 38,000, you get what? 22,000 favorable. It's tallying. Guys, clear with this, guys. Are you all understanding this? Any problem, any issues here? No. Now, shall we move on to the next one? Now, this efficiency variance, I told you, can be further classified into labor gang variance and labor yield variance. Shall we do this, guys? Yes. Now I will do this separately and show it to you. Now your labor efficiency variance. What is the formula, guys? Everyone, labor efficiency variance. standard hours minus actual hours into standard rate, guys. Now, always remember efficiency variance, standard hours minus actual hours worked. Guys, correct? We are only talking about actual hours worked. That's how you judge the efficiency. So here, under the efficiency variance, whenever I say actual hours, it represents actual hours worked. So further, if I am classifying and all into gang and yield, wherever you see actual hours, it stands for actual hours worked only. Guys, clear with this? Now here I am further classifying this into two. What and what I told you, labor gang variance and then labor yield variance. It is also known as labor sub-efficiency variance. There I told you, material yield variance, also called as material sub-usage variance. Clear with this? In exam, if they ask sub-efficiency variance, don't think that, I didn't teach you and don't start scolding me. So what students do? They don't just scold me. They will pull 2 generation upward, 2 generation yet to come, everything they will pull and they will start scolding. It is actually another word they use, that's all. Guys, clear with this, guys? Yes. So now coming back here, so now labor gang variance, recall there, what did we see in material area? Revised actual quantity minus actual quantity into standard price, we did, correct? So basically here, what am I doing? I am comparing actual with actual. The only difference is I'm comparing actual with standard mix with actual mix. Clear with this, guys? Because you deviated from the mix, how much is it attributing to your variance? Guys, clear with this, guys? So here the formula is going to be revised actual hours minus actual hours into standard rate. Clear with this, guys? Now, topmost figure, efficiency variance, compares what with what? Standard hours with actual hours. But here, what am I doing? I'm introducing something, revised actual hours. So revised actual hours minus actual hours, I'm comparing, right? So on the other side, yield variance, what it will compare? Standard hours will be compared with in between guy, revised actual hours. So here, the formula is going to be what? The formula is going to be, so standard hours minus revised actual hours into standard rate. Any problem here? Now, you guys know how to do it, but anyways, let me do it once again. So here it's going to be the skill set that you first need to mention, then revised actual hours, then actual hours, then standard rate, and then you get your labor gang variance. Clear with this, guys? Now, what are the two skill set we've got? First is unskilled, no? First unskilled, and then you get your skilled. First, what will you do? Fill up the actual column. Actual hours, tell me, guys, how much and how much? 22,000 hours and then 8,000 hours. Guys, correct? Right? So now tell me, what is the total? 30,000 actual hours. Now, immediately what will you do? Plug this 30,000 here. Now, I am not saying how much you should have versus a standard. I'm not comparing it with actual. Okay, for some reason you have taken 30,000. But at least this 30,000, it should have been in the standard mix, If you go to the question and see what is the standard mix overall for every unit, let us say you need a total of 3 hours. 2 hours should have been from unskilled, 1 hour should have been from skilled. Guys, correct? So 2/3 should be what? From your unskilled, 1/3 should have been from your skilled. Guys, correct? So here unskilled should have been what? 2/3 of 30,000. How much is that? It's going to be what? 20,000. Guys, correct? So 20,000 should have been your unskilled, and your skill should have been how much? 10,000 hours. Any problem here? No. Now, what's going to be a standard rate, guys? Guys, everyone, 10 and 20. So now tell me, gang variance, how much is it? 20 is what you should have, whereas you have taken 22, you have taken 2,000 hours more at the rate of 10. How much is that? It's going to be 20,000 adverse. Correct? Right? And here skilled, you should have taken 10,000, but you've only taken 8,000. 2,000 hours you saved. 2,000 into 20, how much is that? 40,000 favorable. Net of 20,000 favorable. Now, what has happened here? Simple, guys, simple. Now, what they have done, ideally, I am not comparing how much you should have taken, standard and all. For some reason, you have actually taken 30,000 hours. This at least 20,000 should have come from unskilled and 10,000 should have come from skilled. Guys, correct? Between unskilled and skilled, who is the most costliest labor? Skilled guys, every hour I'm paying double the amount, 20. Unskilled, only 10 rupees. No, what they have done, instead of 20,000 hours of unskilled, they have used more of a cheaper labor and less of a costlier labor. Because they have deviated from the mix, what has happened, since they are using more of a cheaper labor, they have generated 20,000 rupees of favorable variance, or in other words, they could save 20,000 rupees for the company. Clear with this, guys? This is actually not because of their efficiency, this is because of deviating from the mix. Guys, are you all understanding this? This alone gets captured in your mix variance. Are you all gang variance? Are you all clear with this, guys? Are you all understanding this? Yes. Now goes to the now you just go on to the other side, your labor yield variance. So here standard hours. So how much is a standard hours, guys? We have the figures with us. Standard hours. So first unskilled, then you do skilled. Unskilled standard hours is how much? 22,000 hours, right? You should have taken, but minus revised actual hours. How much is that? 20,000, right? Into standard rate. What is the standard rate? 10. So now tell me, guys, how much does it come out to? So 22,000 minus 20,000. So there's a 2,000 saving. 2,000 into 10. 20,000 favorable. Clear with this, guys? Any problem here? No. Now the next one. What has happened here? Skilled here. So what is your standard hours? 11,000 hours minus revised actual hours. Just now we did. It's going to be 10,000, right? Into what? 20. How much is this, guys? How much is this? 20,000. Once again, favorable. So totally 40,000 favorable. So now you get what? 20,000 favorable, 40,000 favorable. So now add up the two. Do you get 60,000 favorable on the top? 60,000 favorable. Guys, clear with this, guys? Yes, I think there are a few mistakes here. We just need to correct that. So the same thing, unskilled and skilled. Okay, please make the change. It's unskilled and skilled. And apart from that, formula way tappanga. So RAH minus AH into standard rate. Okay, fine. So revised actual hours into, so here it is mistake, standard hours minus revised actual hours into standard rate. Here also the rate is 10 rupees. Okay, that's about it. Is there any other mistake here? I'll make all these corrections in the final version. I'm sorry for this. So I'll make all the corrections. Some DTP issue here. Guys, done, guys. Any problem here? Any problem here? So now, guys, now literally with this, we have covered all the formulas in this particular segment called as labor variances. Can you guys tell me all the formulas first? Now, guys, tell me all the formulas. Come on, guys. First, everyone, labor cost variance formula. Now, one second. When you are saying, tell this with actual hours paid or worked and all, I want it including idle time, right? Tell me, guys. Standard hours into standard rate minus actual hours paid. Actual, I will pay them for everything. Actual hours paid into actual rate. Clear? Now, broadly classified into three. First, left extreme, labor rate variance, responsibility, HR manager, formula, standard rate minus actual rate into actual hours paid. I will pay them for everything. Rightmost extreme, labor efficiency variance, responsibility, production manager, formula, standard hours minus actual hours worked into standard rate. Why into standard rate? I am not dependent on that guy. Clear with this, guys? In between, kurukku inda kausik vandangra madri. In between, idle time variance. Now, formula, idle time into standard rate. That's nothing but basically the difference between your actual hours worked and actual hours paid. Clear with this? No. Further, rightmost corner, efficiency variance, further classified into two. What and what? Labor gang variance and labor yield variance. Yield is also known as sub efficiency variance. Now, gang variance formula, revised actual hours minus actual hours into standard rate. Now on the other side, now you compare standard hours with minus revised actual hours into standard. That's about this area, guys. That's about this area. Clear with this? Now to conclude this, let's do one full-fledged sum. with all the mix of skill set, with idle time and everything. And with that, this particular segment of discussion is over. Shall we move on to the next question? Let's do this question number 7, library of adjustments. Okay, thank you. Question number? The 6. Okay, take question number 6, library of adjustments. Do it, guys. Write down. LCV hyphen mix of skill set. That's all. Mix of skill set. That will do. LCV hyphen mix of skill set. LCV pa LCU la. Okay, LCV. Now let's move on to the next one. He created a name for himself, no? I'm talking about Lokesh Kanakaraj. Yes. That first, I mean, that movie he took, Kaidi, no? It broke all the stereotypes. It really broke all the stereotypes. There is no song in that movie. Sorry? No heroine. And kind of comedy as Dina was there, but it broke all the stereotypes. Most of the shots were actually shot during the night time, literally almost the entire movie. One night movie, yeah. And that's something that's really, I mean, amazing. Anyways, coming back. See, that's all. To create a history, first you need to make it. So that's what this guy has proved actually, and not just that, he didn't stop there. So when he did that other movie, Vikrama, so he linked all these things, parallel universe, and that's when people started talking about LCU. And then he created a even great movie, Okay, coming back, I'm not getting into that. There might be some Vijay fans here. Okay, now, question number 7. So Leo was great, huh? Okay, right. Question number 7, guys. NPX Limited uses standard costing system for manufacturing of its product X. Guys, come on, let's wrap it up properly. Let's wrap it up. The following is the budget data given in relation to labor hours for manufacturing of 1 unit of product X. To produce 1 unit of output, guys, there are 3 different skill set of labor that you can take: skilled, semi-skilled, unskilled. So to produce 1 unit of this output, you can take 2 hours of skilled labor time, 3 hours of semi-skilled labor time, 5 hours of unskilled labor time, total 10 hours. And for every single skill set, standard rate is 6, 4 and 3. Skilled will be paid the most. Unskilled, semi-skilled little less, unskilled very less. Clear with this, guys? This is how typically all these factories do work. Next, in the month of Jan 20X1, a total of 10,000 units were produced, and the following are the details. Wait. Now, 10,000 units were produced. With this, I can come up with your standard hours, per unit. This is the standard hour. Overall, for actual output, standard hours is multiply the respective figures with 10,000 and you're getting it. Clear with this? Standard rate is also available. Clear with this? Next, during this month, following data is available: skilled, semi-skilled, unskilled. Actual hours is given. Actual rate is given. Amount has been given. And then actual idle hours abnormal during the month, skill set wise given, total. Calculate the labor variances. And second part, they have asked something. We will also see what it is. Now, easy sum. Directly everything is given. But 1 minute. I want to ask one question. This actual hours is given, no? Is it actual hours worked or actual hours paid? Why I'm asking is there will be a difference. If you take this as actual hours paid, this idle time needs to be subtracted to arrive at your actual hours worked. If you take this as actual hours worked, it should be added to arrive at your actual hours paid. You guys tell me, is it worked or paid? How many of you say paid? Okay, that's most of the class. Okay, how many of you say it's actual hours worked? I said most of the class, so which means some portion of the class is still not raised the hands. Solunga. Oh, some people say it's... Come on, guys, own your opinion. It's okay. Rise. Ibrina? யோசிச்சிட்டு இருக்கீங்களா? Okay, it is. Is it a subject matter of assumption? Definitely not. So it has to be actual hours paid only. How did you say paid? They have multiplied the rate and arrived at the amount, which means the moment they have arrived at the amount, it means that is actual hours paid only. Are you all clear with this? Yes, guys, clear with this, right? If you have made a mistake, it's okay. In fact, I'm happy that those people raised their hands. You need that guts to actually raise your hands. I'm telling you guys, don't be so self-important and all. I cannot make a mistake. We are all humans. Every one of us can make mistakes. There is nothing, no harm in that. Okay, guys, everyone, are you all getting it? No subject matter of assumption. It is always actual hours paid if they have multiplied with the rate and arrived at the amount. Clear with this, guys? Shall we do this question? Now, do we have all the ingredients? Standard hours? Yes. Standard rate? Yes. Actual hours, paid and worked and idle time? Yes. Actual rate? Yes. Then what are we waiting for? Let's go and do the sum, shall we? Let's get started and knock this off. First thing, put this dabba. That is very important. First, guys, this working note, it will help you throughout. Standard is always for actual. We know that. Correct? Now, figures, tell me. 2, 3, and 5 is per unit. I've totally produced how many units? 10,000. So it means 2 into 10,000, 20,000, 3 into 10,000, 30,000, 5 into 10,000, 50,000. This is going to be a standard hours. Standard rate 6, 4, and 3. Now here itself you can multiply the respective figures. If you arrive at the subtotal, it's called as your standard labor cost. Topmost figure, that is the topmost line item. Here itself you can multiply and do it, saves time. Else once again you need to come down and write all these things. Guys, correct, play it smart. Insert one more column here. Are you clear with this? So 2 in 20,000 into 6 is 1,20,000. 30,000 into 4 is 1,20,000. 50,000 into 3 is 1,50,000. Add up, you get a total of 3,90,000. This is the total labor cost you should have incurred. Guys, correct. Next, go to the actuals column. Actual hours paid. This is AH paid. Figures given in the question 18, 33, and 58. Subtotal, how much is that? 1,09,000. Clear with this. Rate given in the question 7, 3.5, and 4. Clear with this. Clear with this, guys. Any problem here? No. So now multiply the figures. 18,000 into 7. 1,26,000, right? I hope you guys are using that M plus and all, because last figure, one button MRC, you should get the subtotal. Yes. Next, 33,000 into 3.5. 1,15,500. Then 58,000 into 4. 2,32,000 MRC. 4,73,500. Use all these things in the classroom. That's when in exam you will be able to, it will be a breeze. Trust me, guys. The person who is sitting next to you will think you're doing it so quickly. How is it? Your efficiency will be more. Trust me, guys. This is how it works. Right? Now, so now this is going to be your total actual labor cost incurred. Guys, correct? Right? The difference between the two is going to be your labor cost variance. Any problem here? You have incurred more or lesser? More. It's an adverse variance. On the face of it, you can say. Next one, idle hours given or given. Yes. 500, 700, and 800. Total is 2,000. Guys, correct? Right? Now, actual hours worked will be how much? It's going to be actual hours paid minus idle time. So 18,000 minus 500, 17,500, 33,000 minus 700, 32,300, 58,000 minus 800, 57,200. Add up everything, you get what? 1,07,000 is going to be your actual hours worked. Clear with this, guys? No, one second. Before we move to this question, we have all the ingredients with us. Now, in this particular labor variances, in between we saw one variance, labor idle time variance. That idle time is abnormal idle time, correct? Sir, for normal idle time, what will we do? Can anyone tell me? Normal idle time variance will not be separately done. Huh? Why? Normal loss, unavoidable, adallam okay da. You are correct. We have to pay. Even for abnormal item, we have to pay. I am asking, why is it not calculated separately? Inflating la okay pa. Here I am asking you. Solunga ma. It's okay. Come on. It's okay. Part of normal operation. That's okay. I'm expecting something. You guys are almost nearing there. Okay, guys. Normal idle time means what? To produce one unit, I definitely know that yes, this is unavoidable. Guys, that would have been factored into your standard hours itself, no? Guys, correct, no? that would have been factored in your standard hours itself. Standard hours, if I say standard hours is 4 hours, actually seeing 3.5 is only required for half an hour lunch break, but I would have included this in the standard hours itself because I know it is unavoidable. Guys, clear? Separately should not calculate. Are you all understanding this? Yes, so it is factored into your standard hours itself. This is why I'm saying logical understanding is very, very required, very much important. Now, if I'm telling you guys are able to understand, yes, so if someone comes and asks you why only abnormal idle time you're computing a variance, normal idle time you will not compute, you should say normal idle time is already included in your standard hours. Every time you're doing standard hours, it is actually, it includes the normal idle time. Separately, I need not calculate it. It is unavoidable. I know that. Guys, clear with this, right? Have the clarity when you're moving around. Trust me, guys, the knowledge and wisdom that you have, people will respect you like anything. Trust me, the kind of respect you will get will be tremendous. Honestly, I'm telling you, you will know this when you are actually, when someone is asking you a question, if you're coming with a solution to that. Oh, this is the reason. Logically, if you're analyzing, trust me, the kind of respect you will have in industry will be something else. Because people will now understand that if I go to this person, my work will be done. He will come up with a solution no matter what. That is the kind of respect you can command. This, any kind of money will not give you. Any kind of money will not give you. Only your knowledge and your wisdom. These two things are the things that will actually help you out. Knowledge is nothing but accumulation of information. Knowing something that AI can replace you. But knowing how to apply these knowledge in your real life, that is wisdom that no artificial intelligence can actually replace you. That is where your conceptual learning will help you out. Trust me, guys, the kind of respect you will get for these kind of knowledge and wisdom you have will be tremendous. Today, if I tell you, I don't know how many of you can appreciate that. The moment you step out and see in the market or in the industry, anywhere you go, if you have this kind of knowledge and move around, people will start respecting you automatically. Even if they don't like you also, the respect alone will parallelly come. Just see this. Now, shall we come back and do the sum? Yes, guys. Now, first, labor cost variances. Now, we guys know this. Directly, let's do this. 3,90,000 minus 473,500. Difference is 83,500. Guys, what is that? Adverse variance. Everyone, yes, guys, clear with this? Yes. Next, labor rate variance formula. Everyone. Standard rate minus actual rate into actual hours paid. I'm talking about HR department, not bothered about worked idle time breakup. For every hour he's spending inside the factory, I pay. Now, figures, guys, here. So, for skilled laborers, standard rate is 6, actual rate is 7, actual hours paid is 18,000. 6, 7, 18,000. Next, semi-skilled, it's going to be 4. It's going to be 4, 3.5, and here it's going to be 33,000. Guys, correct? Yes, 4, 3.5, 33,000. Here, standard rate is 3, actual rate is 4, and actual hours paid is 58,000. Now calculate the figures. I was supposed to pay 6, I paid 7. Favorable or adverse? Adverse. 1 into 18,000, 18,000 adverse. I was supposed to pay 4, I paid 3.5, I paid less. It's a favorable variance. 33,000 into 0.5, that comes out to 16,500. I should have paid 3, I end up paying 4, I paid more, adverse variance. 58,000 into 1, that's going to be 58,000 adverse. So add up the three figures, you get 59,500 adverse. This is your rate variance. Any issues? No. Next one, labor efficiency variance formula. Standard hours minus actual hours worked into standard rate. So here you please write down it's actual hours worked. Right? Actual hours worked. Now guys, tell me, standard hours, what is the standard hours? 20,000, 30,000, 50,000. Guys, correct? 20, 30 and 50. And actual hours worked, here we have this 17,500, 32,300 and 57,200. Yes, put these three figures, and then standard rate we all know 6, 4 and 3. Do the calculations. Now calculation figures, you know, just tell me adverse or favorable. Now skilled, you could have taken 20,000, you have only taken 17,500. Favorable, adverse? Favorable, right? Figure, it is correct, I suppose. 15,000 is correct. Yes, then you should have taken 30,000, you have taken 32,300. Favorable, adverse? Adverse to the extent of 9,200. 50,000 you could have taken. You have taken 57,200. Adverse, favorable? Obviously an adverse. So now add up these three figures. So 9200 plus 21,600 minus 15,000 gives you what? 15,800 adverse. Guys, any problem here? No. An idle time variance, idle time into standard rate, 500, 700, 800. So 500, 700, 800 with 6, 4 and 3. So 500 into 6, 3000. 700 into 4, 2800. 8000 into 3, 2400. Add up everything, you get what? 8200 rupees of adverse variance. Any problem here, guys? No. So now what do you do? Immediately check this one. Shall we check it? So now you get 59,500 plus 15,800 plus 8200. How much you get? 83,500. You get the topmost figure. Material cost variance is equal to your, labor cost variance is equal to labor rate variance plus labor efficiency variance plus idle time variance. Clear with this, guys? Any problem here? Are we done with this question? No. No, what you need to do, your labor efficiency variance is further classified into gang and yield variance. Let's do that. Let's do that. Now, always remember here, gang and yield variance are based on, whenever I'm talking about this area, actual hour stands for actual hours worked only. Clear with this? Because this is sub efficiency, I told you it comes under your labor efficiency variance. Now, shall we quickly do this, guys? Shall we quickly do this? Okay, I'll put it up here. So now, this is question number 7, no? Okay, fine. Now, guys, tell me here. So, labor gang variance. Now, skill set. Then you have revised actual hours. Everyone participate. Actual hours, and then you have standard rate, and then you have your labor gang variance. Shall we get started? Yes. What are the three skill set? Skilled, semi-skilled, and unskilled. Now, what is the first column you will fill in? Actual hours. Figures. Actual hours is actual hours worked. It is 17,500, 32,300, 57,200, and add up you get 1,07,000 immediately. 1,07,000, you put it under actual hours. Here I'm comparing actuals with actuals. But what is the difference? Actuals at standard mix with actuals with actual mix. So because of deviating from the mix, how much is it contributing to my variance alone gets captured here. Sir, because total time difference, that is getting captured under your yield variance. Are you all clear with this, guys? Have the clarity. Now, what is the mix, the standard mix? Shall we just go and see the question here? What is the standard mix per unit? Also, you can take, that's not a problem. Yes, 2:3:5, right? Or in other words, 2:3:5, total is 10. 20% of the total time should come from your skilled, 30% of the time should have come from your semi-skilled, 50% of the time should have come from your unskilled. So now what you can do is 1,07,000 into what point into 0.2 is equal to how much is that? 21,400. Then 0.3 is equal to 32,100, and 0.5 is equal to 53,500. Clear with this, guys? What's the standard rate? 6, 4 and 3. Now, guys, gang variance, do it. Come on, tell me. So 21,400 minus 17,500 into 6. How much is the figure? It's going to be 23,400. Favorable or adverse? You could have taken more, you've taken less. It's going to be a favorable variance. Then 32,100 minus 32,300 into 4. How much is that? 800. Adverse or favorable? So you have taken more than what you are supposed to. It's going to be an adverse variance. Next one. 53,500 minus 57,200 into 3. Clearly an adverse variance. How much? 11,100 adverse. Add up the 3. So now 11,100 plus 800 minus 23,400, or you can say 23,400 minus 800 minus 11,100. How much is it? 11,500 favorable. Clear with this, guys? And your labor yield variance, what is the formula, guys? Come on. Standard hours minus revised actual hours into standard rate. Now you can just substitute the figures and you can arrive at it. Now look at this. Where is it? Yes, these are the three figures we got here. That's the total of your mix variance. Actually, labor mix, let's call it labor gang. Mix or gang variance, whichever way you want, you can call it as. So now, ulta. So your labor yield variance will come out to how much? If you add up, you get what? 27,300. Ideally, guys, what they have done, that proportion they have arrived at it. 20,000 by 1 lakh, it's nothing but the 20% proportion on the total actual hours, 1,07,000. Guys, clear with this? Now, instead of doing it, if you put it in a tabular format, it is going to be much easier for you. Clear with this, guys? But when you're doing it, clearly write how you have done that. So now what you can do is you can just write a note here, or you can write it is going to be how you have arrived at it. Maybe you can just write a working note reference here, and you can put this reference and all. It is 0.2 of 1,07,000, or you can say 2 by 10 into 1,07,000. This is what, 3 by 10, 3 by 10 into 1,07,000, 5 by 10 into 1,07,000. Please write it in exam. That's a must. Guys, clear with this, guys? Are you all understanding this? So now if I add up this two, am I getting the labor efficiency variance? So 27,300 minus 11,500. How much is that? 15,800. Am I getting the efficiency variance, guys? 15,800 efficiency variance. Any problem here? Guys, are you all understanding this? Are you all understanding this? Yes. And with this, the entire labor variances is also over. Guys, clear with this, guys? Any problem? No. Shall we just go and update the library for adjustments right now? Oh, sorry. Second part of the question is there. Okay. What is the second part of the question? Okay. Also, show the effect on labor rate variance if 5,000 hours of skilled labor are paid at the rate of rupees 5.5 per hour, and the balance were paid at rupees 7 per hour. So inside the skill labor also they are saying further actual hours they are making a discrimination. Come on, guys, attempt it. I'll give you a minute time. Quickly do this, and then we will close it off. Come on, guys, the online folks, I'll give you a minute time. Please quickly do this for the small change, labor rate variance when there is a change like this, and then please do it a minute time. So pause the video now, do it, and then come back. Now, guys, fairly simple one. So now what happened? For skilled laborers alone, there is actually two different actual rates. Guys, correct? Now, what have they said? So what is the total actual hours paid for skilled workers? 18,000 hours. Now, what they are saying, out of this, right, for 5,000 hours, they are paying at the rate of 5.5. The remaining 13,000 hours, they are paying it at rupees 7. Clear with this? And the remaining and all is going to be the same. Now what will you do? For each of the subdivision, once again, you need to calculate the rate variance and close it off. Shall we quickly do this, guys? Yes. So now labor rate variance, what is the formula? Standard rate minus actual rate into actual hours paid. Guys, correct? So now skilled workers, now it is further classified into two. For 5,000 hours and for 13,000 hours. Now, what is the standard rate for skilled workers? 6 rupees. That will definitely not change. Correct? So now actual hours alone changes. For the first 5,000 hours, they are paying what? 5.5. Remaining 13,000 hours, 7. Calculate. Instead of 6, they are paying only 5.5. Here, there's a favorable variance to the extent of. It's favorable variance, no? 2,500. It's correct, no? 2,500 favorable. Here, instead of 6, they are paying what? 7. Adverse variance, 1 rupee for every 13,000 hours. It's going to be 13,000 adverse. If you knock these two things off, you get a net of 10,500 adverse. I think the remaining two are the same only, no? Right? So your standard rate was 4. Actual rate is 3.5 into 33,000 actual hours paid. So there's a favorable variance of 16,500 unskilled. Standard rate is 3. Standard actual rate is 4 into an actual hours paid of how much? 58,000. That's going to be an adverse variance of 58,000. Add up everything, you get what? 52,000 adverse. That's about it, guys. Nothing great here. Shall we just go and update our library for adjustments? Right on. LCV mix of skill set within bracket with idle time. Mix of skill set within bracket with idle time. Mix of skill set within bracket with idle time. Done, guys, right? So with this, I am concluding this session. Please revise till whatever we have covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now guys, let's continue our discussion in this chapter, standard costing. So now, till now we have completed 7 questions, right? And we've covered the first 2 variances, which are material related variances and labor related variance. Now, shall we just go to the next question? Question number 8. Single question, it has both material and labor variances. Shall we do this? Let's get started. Now, question number 8. This was a past exam question in your September 24 attempt. Shall we do this? Yes, guys. Now, BG company produces a standard product and sold in a packet of 10 kg, right? Now, the standard cost card per pack, which means what? One pack has 10 kg. So, one unit is one pack only. So, to produce one pack, so you are allowed to consume 4 kgs of A at the rate of 50 per kg. B, you are allowed to consume 8 kgs at the rate of 40. And you are allowed to take 6 labor hours at the rate of 20 rupees per labor hour. The company manufactured and sold 1600 packets during the month, and the actual data of material and labor recorded are as under. Direct material 7000 kg is the rate of 40. B, it's going to be 12,500 at the rate of 45. Now guys, tell me, can I take these two are actual quantity? Guys, correct? And 40 and 45 are actual rate. Guys, correct? And my 1600 kgs is actual output, right? This would be the base for calculating my standard quantity, standard hours and all. Clear with this? The labor hours paid for two different categories of workers. Skilled 6000 hours rate of 25, semi-skilled 4000 hours rate of 20. Right now in the standard data, have they given any skilled, semi-skilled and all? No, they had only one category of worker. But what these guys are doing, these guys have given multiple skill set and all. Actually they have paid for two different skill set. Clear with this? Next, 5% of the time paid was lost due to abnormal reason. Calculate the following variances. Literally all the variances they have asked for. Guys, fairly a simple question, no? Guys, literally both they have given and they've asked in a single question. Shall we quickly do this and close it off? Right? Let's do this, guys. Let's do this together. First, come on, guys. I need the figures from you all. So now, material related variances. What are the figures you need? Standard quantity, standard rate, standard price, sorry, actual quantity, actual price. With this, you can calculate all the type of variances inside of it. Any problem, guys? No? Right? So then what can we do is, okay. So what I will do here is, let's not repeat this. These 4 ingredients alone we will compute, right? Everything else is given here. Formula substitution, you can directly do it. Shall we do this? Yes, let's do this, guys. Let's do this. Now, first, what is the standard quantity? Actual output is how much, guys? 1600 packets or units. So now, for you to produce 1600 units, how many kgs of A should have consumed? 1600 into 4. How much is that? Guys, please participate. 6400. For B, how many units? 8. So 1600 into 8 is equal to 12,800. So totally you are supposed to consume total input of how much? 6400 plus 12,800, 19,200. Any problem here? No. Standard price, I think directly given in the question, 50 and 40. You can multiply the two, you will arrive at it. Then actual quantity, I think that is also given in the question, correct? 7,000, 12,500 and actual price is 40 and 45. Any problem here, guys? No. Ideally speaking, this is not a budget data. This is a standard data. Clear with this, guys? This is not a budget data. This is a standard data, right? Now with this, come on, guys. One last time, you guys tell me the formula. Your material price variance formula. Sorry, material cost variances. I'm sorry, material cost variances formula. Standard quantity into standard price minus actual quantity into actual price. They bifurcated into 2. Material price variance. Wait, responsibility. Purchase department. Very good. Think and answer. Very good. You took that time. I like that. Now the next one. So formula. Standard price minus actual price into actual quantity. I am dependent on that guy. The other guy. Material usage variance. Responsibility. Production manager. Formula. Standard quantity minus actual quantity into standard price. Now further classified into material mix variance and material yield variance. Material mix variance formula. Revised actual quantity minus actual quantity into standard price. Very good. And on the other side, it's a balancing figure. Standard quantity minus revised actual quantity into standard price. Substitution you just need to do here. Revised actual quantity, how will you arrive? Take the total actual quantity with the standard mix, you do it. You will arrive at the revised actual quantity. Clear with this, guys? Any problem here? No. And that's about the sum. Let's move on to the next part of the question, which is going to be labor. Now, with respect to labor, in the standard data, have they given any skill set? Guys, no. Only they have given one data. Every unit should take 6 hours at the rate of 20. Skill set and all they didn't give. Guys, clear with this. So now tell me, guys, what is the standard hours? How many units have I actually produced? 1600 units. Every unit you are allowed 6 hours. So total standard hours 9600. Clear with this, guys, right? But and what is the standard? So standard hours is 9600. Correct. And what's going to be your standard rate? It's given in the question. How much is that? 20 rupees. Whereas actual hours and actual rate, they are different. Now actual hours 6000 skilled, 4000 semi-skilled, guys, correct? Or yeah, semi-skilled. And actual rate is also given differentially. So now what you need to do, accordingly in your actuals alone, you have two categories these guys have created. So accordingly you need to deal with that. So your overall for every single variance, you need to compute this separately, as simple as that. But for that, there is no difference. We have done sums in the previous few sums we did was relating to this. Any problem, guys? Any problem, guys? No. And here they have used multiple skill set. No, so that's they have not asked for yield and all. Labor, they have not asked for gang variance, yield variance, so leave it there, not a problem. Now guys, tell me labor variances. Tell me the formula. Labor cost variance, everyone. Standard hours into standard rate minus actual hours paid. Actual hours paid into actual rate. Bifurcated into 3. Idle time could be there. Here in the question they have given 5% is idle time and all. Guys, correct? So idle time. So now 3 variances. What are they? First one, labor rate variance. First, who is responsible? HR department. Formula. Standard rate minus actual rate into actual hours paid. Then rightmost extreme, labor efficiency variance. Formula. Standard hours minus actual hours worked into standard rate. In between this guy, idle time variance, idle time into standard rate. Responsibility is your maintenance department. Clear with this? And right side of the chart, labor efficiency variance further classified into 2. What and what? Labor gang variance and your labor yield variance. Gang variance formula, revised actual hours minus actual hours into standard rate. On the other side, standard hours minus revised actual hours into standard rate. Beautiful. That's simple, guys. Clear with this, guys? It's as simple as that, provided you know the logics. You guys know the logics here? Perfect, guys, right? And here they have given 5% of the time paid was lost and all. So now what will you do? So these are all actual hours paid. 5% of that you multiply, you'll get your idle time. The remaining is going to be your actual hours worked, and hence they have done all the calculations accordingly. This is what they have done. Clear with this, guys? Any problem here? No. So this is exactly what they have done. If you look at this, so yes, labor variances and all. I think here they have taken, yes, what is the total hours for which they have been paid? 6,000 plus 4,000, 10,000 hours totally. Correct. On that 5% is gone. Idle time. So 5% idle time. Basically 10,000 minus 9,500. Basically 500 is gone as idle time. Remaining 9,500 is your actual hours worked. Actual hours worked they have taken as 9,500. Everything else is a normal calculation, guys. Any problem here? We have done many sums in this regard. Clear with this, guys? Just go and update your library of adjustments. We'll move on to the next one. Write down MCV and LCV. MCV and LCV. MCV and LCV hyphen. MCV and LCV hyphen. Mix of RM. Mix of RM. Mix of RM and idle time. Mix of RM and idle time. Clear with this? Any problem? No. Past exam question. Just see whatever we have learned till now. right? That itself is easy for you to score in your exams. I think this was tested for definitely 8 or 10 marks, if I'm not wrong. So only that kind of question this is. So see how simple it was, provided you know the logic for the formula. Number 2, arrive at all the required ingredients. And number 3, you just go and substitute the ingredients in your formula and you're through. Clear with this? Any problem, guys? Any problem here? No. Shall we move on to the next one? Shall we move on to the next one, guys? Yes. Now, guys, there is one thing that I want to tell you before we move to the next one. Now, guys, please listen. In your material related variances, we saw one figure called revised actual quantity. Correct? In your labor related variances, we saw one figure called revised actual hours. Now, in your study material, they have, instead of revised actual quantity, they have used the word revised standard quantity. Instead of revised actual hours, they have used the word revised standard hours. Both are the same. So preferably whenever you're writing and substituting the formula, instead of RAQ, write it as RSQ. Now, then sir, why did you tell us it was RAQ? Yes, in exam you can also write it as RAQ, but I'm just playing it safe. You tell me, guys, which is more logical, RAQ or RSQ? Revised actual quantity. Why? On the actual quantity, I am only revising. So what am I revising? I am taking the actual quantity and revising it. What is the revision I'm doing? Applying the standard mix. Here if I say revised standard quantity, then what is the meaning of that? Revision I'm doing on I'm not doing it on the standard quantity. I'm doing it only on the actual quantity, no? But the wordings, they have given it like this. Everything is same. They have changed the wording. Instead of RAQ, they are mentioning it as RSQ. Instead of RAH, they are mentioning it as RSH. Clear with this, guys? So whenever you're writing the formula, try to use these two word institute terminologies. Else, sirs, no sir, I want to write this. Yes, you can write it. In the past, our students have written. I've also seen the answer sheet, certified copies and all. They have given full marks because, yes, generally, globally speaking, these two terminologies are interchangeably used. But I want to play it safe, and hence I am saying, why should we take the risk in exam? The word alone, you just change it. Everything, calculation all is the same only. Guys, are you all clear with this? Yes, but which makes more sense? You tell me, guys, honestly. So it's RAQ and RAH. That's the reason I did this. Suppose had I mentioned RSQ and all, your line of thinking would have been different. So this is standard quantity only, but some revision you would have taught. It is actually an actual quantity. On that, some revision has been done. Are you all understanding this? Yes, this is what I have mentioned here. In look at this. I think, yes, look at this. I've mentioned all the formulas and said revised standard hours can alternatively be stated as revised actual hours. Guys, clear with this? Similarly, there also I have mentioned one note. Revised actual quantity can alternatively be stated as revised standard quantity. Guys, are you all understanding? Any problem here? No. No, right? And you guys know the verification of labor variances. Labor cost variance is equal to rate variance plus efficiency variance plus idle time variance. And further, efficiency variance can be classified into gang variance and yield variance. You guys know this, right? Similarly, the case for the material related variance also. Clear with this, guys? Shall we move on to the next one? Shall we move on to the next one, guys? The next one is called as variable overhead variances. Very simple and plain vanilla case. Shall we do this? Shall we do this? Yes, guys. Now, variable overhead variance. Example, guys. Example, this power and fuel and all is there, no? Guys, power cost and all. It moves along with your production. Guys, correct? Now, in your variable overhead variance, simple, the formula is exactly same as your labor variances only. The formula is what? Standard variable overheads minus actual variable overheads. The formula will be standard hours into standard rate minus actual hours into actual rate. Guys, clear with this, guys? Basically, power cost, if you take, for every hour that I'm running my machine, for that only I'll be incurring the cost. Guys, correct? So first I'll compute for the actual output how many hours you should have run, and every hour you should be paying how much to the power department, the electricity board, guys, correct? So standard hours into standard rate gives you your standard variable overhead cost. Clear with this, guys? Please reciprocate. No, are you all understanding? Minus whatever you have actually incurred, actual hours into actual rate. So how many hours I've actually run my machines, and on that what is the actual rate at which I am paying them. Are you all clear with this, guys? Is everyone able to follow this? Any problem here? But there is one thing that you always need to understand here. In this particular calculation of variable overhead variances, your actual hours always stands for actual hours worked only. Clear with this? Why? Because only when they are actually working, I will be incurring this power cost. No. Okay. Will you incur a power cost during idle time? That is a power cut time. How will you incur the cost there? Are you all clear with this? Guys, clear with this, guys? So for this particular segment, actual hours paid, worked and all will not be there. Actual hours means actual hours worked, because only on the actual hour you're working, you will be incurring this cost of variable overhead. Are you understanding this? Everyone, guys? Yes, fine. So now tell me, guys, what is the formula here? Variable overhead cost variance. Everyone, please tell me. Standard hours into standard rate minus actual hours into actual rate. Now, this is broadly classified into two. What and what? Here, I don't call it as a rate variance. I will call that as an expenditure variance. Why expenditure? This rate only, but I'm not paying to my workers. To whom am I paying? Electricity board. Guys, correct? Hence, I call that as the expenditure variance. Are you clear with this, guys? Is everyone able to follow this? Yes. Now, this expenditure variance is actually the responsibility of the maintenance department. Sir, why, sir? These are the guys who will actually be dealing with the electricity board, and let us say per hour I gave them the authority to pay 10 rupees maximum. That is the budget. But what happened? We ended up actually paying 11 rupees per hour. Sir, per hour of my running my machine, I'm going to pay them 11 rupees of power cost. Guys, correct? Now, sir, this how can they negotiate? You and I can't negotiate because we are using domestic connections. Correct? But when you're running a factory, right, they have an industrial connection, not even a commercial connection. They have an industrial connection. There they can have a separate dealing, and based on that they can arrive at the rate and all these things. Negotiations will happen. Guys, clear with this? Are you all understanding this? So now here, these guys, that is the maintenance department, he's responsible for what? Rate alone. Guys, correct? Guys, correct? So now within the bracket, his responsibility will come what minus what? Standard rate minus actual rate, but I will multiply it with actual hours. Why? Whatever the production manager is making the workers work, for those many number of hours the machine will be run. So for the actual hours, I am responsible only on the rate. Are you all clear with this? So here, what is the formula, everyone? Standard rate minus actual rate into actual hours. Clear with this, guys? And on the other side, you've got what? Variable overhead efficiency variance. Efficiency variance is basically exactly the same as basically your the other one, labor thing. So basically you should have, for the actual output, let us say you should have run the machine only for 100 hours. Guys, clear? But you have run the machine for, let us say, 90 hours and achieved the same production. So now here, who is responsible? The production manager is responsible for this. So here within bracket, his responsibility will come. What is that? Standard hours minus actual hours, but multiply it with standard rate. Why? Because this guy, production department, is not dependent on maintenance department for anything. Guys, are you all understanding it? If I take the actual rate, then the efficiency or inefficiency of the maintenance department gets passed on to my production department. Are you understanding this? Guys, are you all able to follow this? Yes. Now quickly tell me, guys, variable overhead cost variance formula. Standard hours into standard rate minus actual hours into actual rate. Bifurcated into two. Left side, it's called as variable overhead expenditure variance, not rate. Responsibility, maintenance department. Formula, standard rate minus actual rate into actual hours. On the right side of the chart, name variable overheads efficiency. This is the same. Your responsibility, production manager. Formula, standard hours minus actual hours into standard rate. Clear with this, guys? That's all. Further gang and all is not there here. This can only be there. Clear with this, guys? Are you all understanding this? There can't be mix of any hours and all here. Every hour the machine is working, that is my cost. Guys, are you all understanding this? And the most important understanding is actual hours means actual hours worked alone. I am not bothered about actual hours paid. I'm not paying my laborers. Clear with this, guys? So idle time and all, I will not be incurring a cost. We are talking about variable overheads. Clear with this, guys? Shall we go do and one sum? And that's all. With that, this concept is over. Very small concept. That's all. So with this, guys, literally 75% of the chapter is over. Out of 4 variances, we have covered 3. Guys, correct. Just one more is left. And that's about it. Fixed overheads. I told you it's an animal. We will do it. Okay. So we'll do that. Don't worry. So this is question number 9 only, yeah? Let's do this, guys. Come on, let's do this. Okay, shall we get started? Yes, guys, please be participative. Let's quickly knock it off. Okay, from the following information of G Limited, calculate the variable overhead cost variance, expenditure variance, and efficiency variance. Shall we start? Now, budgeted production 6,000 units. Budgeted variable overhead 1,20,000 rupees. Standard time for producing 1 unit of output 2 hours. Actual production 5,900 units. Actual overheads incurred 1,22,000 and actual hours worked is 11,600. How many ingredients do I need? 4. What are they? Standard hours, standard rate, actual hours, actual rate. First, standard hours means what? For the actual production, totally how many hours I can take? Tell me, guys. How will you calculate this? Standard hours. How many units have been actually produced? 5,900. Every unit you are allowed 2 hours. 5,900 into 2. So for you to actually achieve the output, you could have taken 11,800. Very good. Standard rate. Now standard rate is directly given in the question? No, but they have given budgeted. I budgeted to incur 1,20,000 rupees for a budgeted unit of 6,000 units, but here rate stands for rate per hour. Guys, correct? Now, clearly, can I say budgeted variable overheads divided by budgeted hours will give me my standard rate? Guys, budgeted hours, how will you calculate? Simple. Budgeted output is there, 6,000, and here they have given the standard time for 1 unit is actually 2 hours. So in the budget, how many hours would have been that? 6,000 into 2, 12,000 hours, right? So now 1,20,000 divided by 12,000 if I do, I will arrive at what? I will arrive at the standard rate per hour. Guys, correct? How much is that? 10 rupees. Any issue here? Guys, any issue here? No. Then actual hours. Hello? Actual hours 11,600. Then actual rate is going to be how much? Overheads actually incurred 1,22,000 for actually how many hours? 11,600. So 1,22,000 divided by 11,600. How much is that? 10.51724 something. What you can do is put that under M plus. M plus calculator. MRC twice, clear your memory and put this in M plus. Why? You can't round off because figures should tally, no? Guys, correct? So please have this in your M plus and all. We will work on it later. Now you got the 4 ingredients. Shall we get started? Shall we? Yes, guys, fine. So now first variable overhead cost variance, topmost figure. Standard hours, how much? 11,800. Standard rate, how much? Into 10 minus actual hours, how much? 11,600 into actual rate, how much? 10.5172, but MRC you should keep. Guys, clear memory. So now 11,800 into 10. Hello? 1,18,000. Here 11,600 into MRC gives you 1,21,999.999. That's going to be 1,22,000. You should have incurred 1,18,000. You have incurred 122. Extra you have incurred 4,000. Call it an adverse variance. Any problem? Guys, please participate. Are you all understanding this? Next one, variable overhead expenditure variance. Formula, come on, don't look. Standard rate minus actual rate into actual standard rate 10, actual rate 10.5172 into actual hours 11,600. So what will you do? 10 minus MRC So you get something into 11,600. How much you get? 5,999.9999. You get 6,000. So you are supposed to incur 10. You have incurred something more. It's clearly an adverse variance. Clear with this, guys? Hello. Next one. Overhead, variable overhead efficiency variance formula. Standard hours minus actual hours into standard rate. Standard hours 11,800. Actual hours just 11,600 into standard rate 10. So now you get what you should have spent. You could have spent 11,800. You have just spent 11,600. You saved some time for the company. So 200 into 10, 2,000 favorable. So now let's add up this. So your topmost variable overhead cost variance is 4,000 adverse. Out of that, expenditure variance. Who is responsible for expenditure? Maintenance department, right? 6,000 adverse. That guys, these guys have underperformed like anything. Whereas how about your production department efficiency? 2,000 favorable. So now basically, guys, overall if you knock off, you are getting what? 4,000 rupees adverse. So we have clearly identified who are all the people responsible for this 4,000 rupees adverse variance. Are you all understanding this, guys? Any problem here? No. Shall we just go and update the library for adjustments? Write down VOHV, variable overhead variance hyphen direct computation. Variable overhead hyphen direct computation. Are we done, guys? Are we done here? No. Now, guys, let's go on to the last segment of discussion in this chapter, which is fixed overhead variances. Guys, I want full attention and focus. This is one area where students struggle. Now, if you think that, okay, this is also an extended arm of the previous three, you are gone. This will completely go over your head, not inside your head. Shall we start? Hello, shall we? Yes. Now guys, don't look into the book and all that. Just listen to me. Fixed overhead cost variance. Overall, the cost variance I am saying, the formula is standard hours into standard rate minus your actual fixed overhead. This is the formula. So guys, tell me, what does this stand for? What does it stand for? Standard hours into standard rate. That is actually your standard fixed overheads, right? Minus actual fixed overheads. Difference you get is what? Guys, fixed overhead cost variance is absolutely wrong. You guys tell me, do you have a concept of standard in your fixed overheads? Fixed overheads means what? It is fixed. Then where is the question of standard? Guys, correct? Yes. So I budgeted to incur a fixed overheads of 1 lakh rupees and the budgeted volume was 8,000 units, or let's say 10,000 units, right? I actually incurred 1.2 lakh rupees. My budgeted volume was how much? 8,000 units. Now you tell me, can I compare this 1 lakh with 1.2 lakhs? No. This is fixed cost. Yes, it can be compared. Guys, yes, are you all understanding? You can compare this. Are you all getting it? Guys, are you all getting it? Here we are talking about a fixed cost. Yes, sir, this is pertaining to different volume level. It should not change. That is the concept of fixed. No. Guys, are you all understanding this? Are you all able to follow this? So here, there is no question of, sir, for 8,000, how much should have been incurred? That question itself is not there. Directly, it can be compared. Are you all clear with this, guys? Are you all understanding this? So first and foremost thing, understand, in your fixed overhead variance, there is no concept of standard. Are you clear with this? Are you all clear with this, guys? Is everyone understanding this? Then, sir, what are we talking about here? This figure stands for absorbed fixed overheads. This is your actual fixed overheads. So this variance ideally calculates your under or over absorption. Are you understanding this? Are you all understanding this, guys? So this is a variance that computes what? Under or over absorption. Are you all understanding this? Is everyone able to follow? Here we are not even comparing budget with actual. We are computing absorbed with actual. Hence this variance computes what? Under or over absorption. Have the clarity first. have the clarity first. Are you all understanding this? Is everyone able to follow this? Yes. Now look at this now. Look at this now. Look at this. Here, fixed overhead cost variance is equal to absorbed fixed overheads minus actual fixed overheads. It stands for under absorption slash over absorption. Are you all understanding this? Is everyone able to follow here? Yes, guys. Yes. Now, absorbed fixed overheads, what I told you, it's nothing but your standard hours into standard rate. Guys, correct? Just now I told you this SH into SR stands for absorbed fixed overheads, not your standard fixed overheads and all, because there is no concept of standard in fixed overheads. Are you all clear with this? Guys, are you all understanding? Do you have any doubts? You should be having. You should be having. What is that? Someone. Yes, guys, please. Adu okay. Perfect. Very good. Excellent. Absorbed means what, sir? Predetermined rate into actual base quantity consumed. So, which means, sir, absorbed overheads, how are you saying standard hours into standard rate? It should have been standard rate or standard rate into actual hours only, no? Guys, are you all understanding? This should have been the first doubt you should have got. Guys, are you all understanding? Then how are you calling this as your absorbed or fixed overheads? Guys, this should have been the first doubt. Are you all understanding this? Yes, very good. Happy for the doubt. Now, because today you might not get it, tomorrow you'll definitely get it. And the entire class will come after me. How is it, sir? Guys, this explanation is not there in the study material. I will tell you how. Now, there are 6 different types of absorption rates. You know 6 different base quantities? What are the 6 different base quantities? Labor hours, machine hours, percentage of direct material cost, direct labor cost, prime cost, and production units method. Clear with this? No. Now, guys, this is nowhere there. This explanation is nowhere there. But only if you know this, you will understand why they have mentioned it like this. Clear with this? Shall we start? Okay, fine. Now, let me give you the following example. With the help of this example, I will walk you through. Now, guys, let us assume that budgeted fixed overheads is equal to rupees 1 lakh. Okay, this is an example that I am coming up with. So budgeted fixed overheads is 1 lakh. Budgeted output means what? Units. I am budgeting to produce and sell how many units? Let us say 50,000 units. Example. And budgeted hours in my budgeted period, I am budgeting to have 1 lakh hours. All these things are example that I am giving you. Clear with this, guys? Yes. Now you tell me guys, based on this data, can I say that, look, in the budget, I am budgeting to spend how much rupees? 1 lakh rupees. I am budgeting to produce how many units? 50,000 units. I am budgeting to have how many hours? 1 lakh hours. Guys, correct? So can I say based on the budget, to produce 1 unit, how many hours I can take? To produce 1 unit, how many hours I can take? For 50,000 units, you are allowed to take 1 lakh hours, which means to produce 1 unit, you are allowed to take 2 hours. Can I say the standard hours per unit is equal to 2 hours? Are you agreeing with me on this? Are you agreeing with me? To produce 1 unit, I can take a maximum of 2 hours. Clear with this, guys? Next. Suppose I am following the production units method for absorption. What will be the absorption rate? Can I call that as standard rate per unit? Agreeing with me? Guys, everyone agreeing with me on this? Standard rate per unit is how much, guys? 1 lakh divided by 50,000 units. So if I am using the production units method, the absorption rate is per unit, guys, correct? And the absorption rate, predetermined rate, is how much? Come on, everyone. It's rupees 2 per unit. Agreeing with me? Agreeing with me on this? Is everyone understanding this? Yes. Suppose I am using hours, labor hours as the base. In that case, standard rate per hour is going to be how much? So 1 lakh divided by 1 lakh hours. How much is that? Rupee 1 per hour. Is everyone understanding this? Is everyone understanding this? Is everyone able to follow this? Guys, yes? Are you all understanding this? Okay, fine. Now, let us say I am following the production units method as the base for absorption. What method I'm using? Production units method. You guys tell me absorbed fixed overheads. Logically think and tell me what is the formula standard rate per unit into actual output. Agreeing with me, guys? Agreeing with me on this? What is the standard rate per unit? Per unit you should absorb 2 rupees, right? And what is the actual output, guys? Actual output, okay, let me just give you, that's not that's a budgeted output. Let's say actual output is, let's say 60,000 units. Let's keep it as 60,000 units into what? 60,000 units. Is everyone following this? Now wait, here comes the interesting part. Now this 2 rupees is what? Absorption rate per unit, no? Guys, correct? Now you tell me, if you look at it from a different perspective, for every unit I am charging with what? An absorption rate of 2 rupees. How did this 2 rupees come? In another way, if I look at it, simple. Every unit requires 2 hours, correct? And every hour can get an absorption rate of 1 rupee. Guys, correct? Are you all understanding this? Are you all understanding this? So can I say inside every unit, you are allowed to take 2 hours and every hour can get an absorption rate of 1 rupee. Guys, correct? So can this 2 rupee, can I split this and write it as rupee 1 into 2 hours? What is this rupee 1? It is standard rate per hour. Correct? And this 2 rupees, what is it is standard hour per unit. Agreeing with me on this? Yes, you guys are agreeing with me on this, right? Into what? Into 6,000 units. Any problem till now? Any problem till now? Guys, are you all understanding this? A very critical understanding, guys. Are you all able to follow till now? Now what I will do is, let me club this to. Sir, what is this clubbing this to? You are producing how many units? 60,000 units, and every unit you are allowed to take how many hours? 2 hours, which means for the actual output of 60,000, totally how many hours you are allowed to take? 60,000 into 2. What do you get this, guys? 1,20,000 hours, guys, correct? And this is what? The same rupee 1. So now this 1,20,000 hours is nothing but total standard hours, guys, correct? And this 1 rupee is nothing but standard rate per hour, guys, correct? So literally this is what? Is nothing but your absorbed fixed overheads. Are you all clear with this? Sir, why, sir? Simple. What we are doing is, the question or this concept takes an assumption that always the company is absorbing using, the absorption is done using production units method. But production units method, if it is being converted into hours, it looks like this. Are you all understanding this, guys? Are you all understanding this? Suppose the company is directly using only labor hours, then whatever you said will be the formula, that is standard rate per hour into actual hours. Guys, clear with this? Completely it will be different. So here always we are taking an assumption that basically that the production unit method is being followed, and we are converting the production unit method into hours, and hence it looks like standard rate per hour into standard hours. Are you all understanding this, guys? Explanation nowhere given, guys. I'm deriving this and showing it to you. Are you all understanding this? You guys are able to follow this? So now you tell me, for all our calculation purposes, right? So if everything they want it in hours, so absorbed overheads will be what? Absorbed overheads will be, just now I said, standard hours into standard rate per hour, or standard rate per hour into standard hours. Are you all clear with this, guys? So with hours, if you are multiplying a rate, that rate will be per hour only, guys, correct? If you are multiplying a rate with unit, that rate has to be per unit. Are you all clear with this? Is everyone able to follow, guys? Are you all understanding this? You guys are able to follow this? Yes. Perfect. Now guys, suppose in the exam they have not mentioned anything about hours. Everything has been given in units. So now absorbed overheads, how will you calculate? Absorbed overheads? Come on. Standard rate per unit into actual output. Clear with this? You can directly use this formula in case only unit data is given. In case everything is given in hours, you take absorbed overheads as this figure. Clear with this? I'm not kidding. Past exam question. Students who mugged up this rate and all and went, they didn't get this answer only. Sir, insufficient data. What? Nothing is given in hours. Everything is given in units. Or absorption costing. That is overheads chapter will come to your rescue in this area. Are you all understanding this, guys? Look to what extent institute is testing. They have given all these formulas. So standard rate into standard hours. They would have thought that this is standard fixed overheads. Absolutely not. It is absorbed fixed overheads. Production units method got converted in terms of hours. They presented it like this. Suppose hourly data is not available. Everything is mentioned in units. Absorbed fixed overheads will be what? Standard rate per unit into actual output. Clear with this, guys? Are you all able to follow this? Guys, is everyone able to follow this, guys? You guys are able to understand this? Yes. So now, so you guys know. Once again, you tell me absorbed fixed overheads is what in terms of units? Standard rate per unit into actual output. Suppose you are converting this into hours. It is standard hours into standard rate per hour. Are you all understanding this? Any problem here? Yes, guys, you guys are clear with this? Yes. Now, this is actually a little bit tricky area. Because a portion of this is also linked to your sales side variances and all. Sales side variances. So if I have to explain full-fledged logics for every single component, then that itself will take about a 2-hour discussion, because I need to explain everything in sales side and all. So only one thing in this entire concept, I will just ask you to remember what it is and all. I'll tell you. So first, guys, you tell me variable overhead cost variance. What is it? Under or over absorption? Formula. Sorry, I said variable. I'm sorry, guys. Fixed overhead cost variance. It is nothing but under or over absorption. What is the formula? Absorbed fixed overheads minus actual fixed overheads. Absorbed fixed overheads. If the unit data is given, formula will be standard rate per unit into actual output. If everything is given in hours, formula will be standard hours into standard rate per hour, or standard rate per hour into standard hours. Clear with this, guys? So don't mug it up. It's absorbed figure. Clear with this? Next, this is broadly bifurcated into two: expenditure variance and volume variance. Now it's simple, guys. There are three figures. One is budgeted overheads. Then on the other side you have actual overheads. In between, kuruk in the kausik madri, you have what? Absorbed overheads. Clear, guys? Yes. Now this fixed overhead variance compares what with what? Absorbed with actuals. Clear with this? Any problem? No. Now on the left side, I'm talking about an expenditure variance. Expenditure variance means what? How much you should have incurred. Compare that with how much you have incurred. So clearly you tell me what versus what they are comparing. Budget versus actual. Can I compare budget and actuals for fixed overheads? Yes. Guys, clear with this? Hence, expenditure variance means what? How much expenditure extra or less I have incurred. So what versus what we are comparing? Everyone, budgeted fixed overheads minus actual. So here I am comparing these two, guys. Clear with this, guys? But on the top, what do I need? I need only this figure, only this difference. But on the left side, I am actually comparing these two, which means on the right hand side, what will I do? I will now compare absorbed with my budgeted. Are you all clear with this, guys? This is called as volume variance. So volume variance, the formula is what? Absorbed overheads minus your budgeted overheads. So guys, why is this called volume variance? Obviously, the budgeted overheads, this figure is for the budget volume. Guys, correct? No. Whereas the absorbed overhead is for the actual volume. I absorb, I charge it only in the actual output. Guys, correct? No. Are you all understanding this? So here, this variance is happening because of what? Because of your volume differences. Are you all clear with this? So once again, let us set the context right here. First, topmost figure. What is it called as? Fixed overhead cost variance. What and what you're comparing? Absorbed with actuals. Guys, clear? On the left side of the chart, you have expenditure variance. What you're comparing? Budgeted with actuals. So now what you need to do, this difference need to be now removed. So fixed overheads volume variance is what? Your absorbed minus budgeted. Guys, clear with this, guys? Are you all understanding this? Is everyone following this? Please respond. You guys are understanding this? Once again, you tell me. This is the area where students make mistake. Once again, you tell me. Topmost figure. Fixed overhead cost variance. What and what you compare? absorbed overheads minus actual overheads. Clear with this? Now on the left side of the chart, I call that as expenditure variance. What and what I compare? Budgeted overheads minus actual overheads. Clear with this, guys? Now that I've compared this to, I only want this one, so the balance you remove it. That is called as what? Fixed overheads volume variance, absorbed overheads minus budgeted overheads. Are you clear with this, guys? Are you all able to follow this? Are you all able to understand this? Any problem here? Any problem, guys? No. Now let me write it here. Let me write it here. Now, fixed overhead volume variance. You guys tell me the formula. 1 second. You guys tell me the formula. What is it? So it's going to be what? Absorbed overheads minus budgeted overheads. Clear with this, guys? Now this fixed overhead volume variance is broadly classified into two. You would have seen three figures here. But wait, I will tell you what it is and all. First, let us understand two, and then I will insert one more. Fixed overhead capacity variance, and then fixed overhead efficiency variance. Now, this is the place where I said, for you to understand the concept of capacity variance, first volume variance and then sub capacity variance and all, you need to go into the sales side variances, which is not a part of your syllabus. Now, only one thing I will ask you to remember. Can you? Only one thing I will ask you to remember. Now, what you need to do is only one thing here. Actual hours into standard rate minus the same here, whatever is there on the top, budgeted overheads. Clear with this, guys? Now, only one thing you need to remember, actual hours. Actual hours into standard rate. When I say standard rate, it is standard rate per hour. Guys, clear? Because everything is per hour only. Are you all understanding? Actual hours into standard rate minus budgeted overheads. Clear with this, guys? This is called as what? Capacity variance. What is it? Actual hours into standard rate minus whatever is there on the left side, right side, you put it here, minus budgeted overheads. Clear with this, guys? Yes. And efficiency variance is actually the balancing figure. I need to get my daddy here, guys, correct? Now, minus budgeted overheads, I already have it here, but on the left side, I should be getting absorbed overheads, but here I have inserted something. What I need to do, now you insert absorbed overheads and remove this guy. So this is going to be absorbed overheads minus AH into SR. Clear with this, guys? Are you all understanding this? Now, this is the only place in the entire subject where I'm saying, please remember only one thing, that alone, actual hours. Why? Because you should play it smart. It's not that it's not logical, it is logical, but for me to explain this logic, I will have to touch your sales variances and all that. Just because I know something, I don't want to waste your time, because it's not a part of your syllabus. And hence, I'm clearly telling you, this one thing alone, can you remember in the entire subject? Will you? Yes. What is that? AH. That's all. Obviously, AH into SR only. Guys, clear with this, guys? Now, fixed over its capacity variance, AH into SR minus whatever you get here, budgeted overheads. The other guy, efficiency variance, is a balancing figure. Absorbed overheads minus whatever I just inserted now, AH into SR. Clear with this, guys? Are you all understanding this? Are you all understanding this? Now, what I will do is, you guys will dictate and I will write down the entire chart. Shall we? Now, tell me, guys, first starting point. Fixed overhead cost variance formula. Absorbed fixed overheads minus actual fixed overhead. Very good. Now, this is branched into two. Now, fixed overhead, very good, expenditure variance, and the other guy, because of the volume he comes in, fixed overhead volume variance. Now, expenditure variance formula, budgeted fixed overheads minus actual fixed overheads. Now, volume variance formula, the balancing figure, absorbed fixed overheads minus budgeted fixed overheads. Here also you can say, look, I want absorbed minus actuals. Here minus actual is there, but I need to insert absorbed, but some other guy is sitting. So include your absorbed and remove your budgeted fixed overheads. So only now if you add this, what will happen is, so what will happen, 1 second, let me take that. Yes, this and this will get cancelled off. Guys, correct? And then you will get what your daddy figure, that's absorbed fixed overheads minus actuals. Guys, clear? Or you can say it's a balancing figure. Clear with this? But logically, I also told you, I drew those 3 lines and all, and I showed you what this is. This is happening because of the volume differences. Clear with this, guys? So absorbed overheads is applied on the actual output, whereas obviously the budget is happening on the budgeted output, and hence the difference. Are you all clear with this? Hello? Yes? Now what we need to do, this guy is further subclassified into 2 we have seen. The third one, what it is and all, we will see. What and what? Fixed overhead capacity variance, and then fixed overhead efficiency variance. Clear with this, guys? C comes first and then comes E. Guys, clear? So capacity and then efficiency. Clear with this, guys? Now what is the formula here? Only one wording I said to remember the entire subject. What is it? Actual hours into standard rate. Obviously rate means rate per hour, that's why you're multiplying it with hours. Clear with this, guys? Minus what? This figure you put it, budgeted fixed overheads. The other guy, balancing figure, insert this guy, absorbed fixed overheads, and remove this new guy, AH into SR. Clear with this, guys? Are you all understanding this? Are you all understanding this? Any problem here? Any problem here, guys? Clear? Sure? Perfect, guys. Yes, and that's about this particular variance called as fixed overheads variance. One alone in between, there's something called as your calendar variance. What it is, we'll be seeing using the next some example. We'll be doing it. Clear with this, guys? Shall we start? Yes. Now in case you are wondering, to some extent I will tell you the logic. Capacity variance, sir, why sir, AHSR and all. Simple, guys, simple. This is just for your understanding. I'll tell you, I will not get more detail into your variance, sales variance and all. AH into SR is there. Budgeted fixed overheads, can I split it and write it as BH into SR? Budgeted fixed overheads is nothing but budgeted hours into standard rate. Standard rate is nothing but budgeted rate. So this is nothing but AH into SR. SR can I take common? So can I call this as AH minus BH into SR? So actual hours is there, budgeted hours is there. The difference between these 2 hours is attributable to my capacity variance. Guys, clear? Capacity means what? I have a budgeted capacity of so much, but actually I'm operating at a different capacity because you are deviating from the capacity. Total hours, your capacity can be expressed in units or in hours. You guys know that now, we've seen it, right? Because you are deviating from this particular capacity level, how much is it attributable to your variance? Volume. Are you all clear with this, guys? Yes, this is the logic for that. But beyond that, this volume variance is actually something else. It's actually something else. You have no clue the importance of volume variance and all, because if you prepare a full-fledged reconciliation statement, I told you, first I started this chapter by saying what? You remember, this chapter reconciles what profit with what profit? Accounting profit. Budgeted profit versus actual profit. I told you, guys, correct? I told you at the beginning of the period, the company prepares a budget. Guys, yes, right? So budgeted profit will be there at the end of the period. Actual profit will be there. The difference between the two is called as profit variance. Now it can happen either on the sales side or on the cost side. Now cost side variance is further classified into 4: material, labor, variable overheads, fixed overheads. That's what we are seeing. Ideally, you should have asked me this doubt at that point of time itself. Sir, this entire chapter you said it reconciles what versus what? Budgeted profit versus actual profit. Every single variance that we did, we only compared standard with actual. No, then how will it reconcile budgeted profit versus actual profit? This doubt you should have asked me there, because this is being captured and nullified under something called as your sales side. There is something called a sales volume margin variance. That and this one, fixed overhead volume variance, will nullify this effect, and it will now push the standard and make it as equivalent to budgeted and all. This is a very intricate discussion which is there in your CA final. Thank goodness it's not there in your intermediate level. Thank goodness, as in it's also very logical only, but it will actually get into a very detailed discussion. So that is the reason, happily in the cost side variance, you're comparing standard with actuals and all, but when you are preparing a full-fledged reconciliation statement, it reconciles budget with actual. How? Using the sales mix volume variance or the sales volume margin variance. There is one variance there, and one more thing, that is fixed overheads volume variance. These two variances will merge together and it will further help you to reconcile your budget with actuals. How is it and all is a subject matter of discussion in your final. Right now is not required. That is the reason I said here also, some smart way of learning it is, yes, in this case it is also logical. To the extent logic is applicable, I told you right now. Else if I start explaining the detailed logic just because I know it, then it will enter into 1-2 hour discussion. I don't want to waste your time. Rather, let's make peace with this. One word in the entire syllabus you need to remember. What is that? Actual arson. That's about it. Clear with this? Play it smart. You should know where to do what. Clear with this, guys? So now one last time, can you tell me the entire format? Because I'm telling this again and again, students struggle here. Students struggle here because I know this is the area in the entire chapter which can be completely different from whatever you've seen. The other three, did we see all these things? No, it was all very logical, direct logic driven. Here it's a very intricate discussion. Come on, guys. Fixed overheads cost variance formula. Absorbed versus absorbed minus actuals. Classify into two, what and what? Expenditure variance and volume variance. Expenditure variance. Budgeted overheads minus actual overheads on the volume side. Absorbed minus, yes, budgeted. And this volume variance is further classified into capacity variance and efficiency variance. Capacity variance. Actual hours into standard rate minus this figure, budgeted overheads. The other guy is a balancing figure. You know that. Clear with this, guys? Absorbed minus AH into SR. Clear with this, guys? So now, just final touch I will do. Now, guys, in order to crack sums under fixed overheads variance, what are all the ingredients you need? List out these ingredients, and obviously first step is what? Finding out the ingredients. Second step, you can actually put this branch, write the formulas. Third step, substitute, you will get the answer. Yes, now ingredients required. First, absorbed fixed overheads. What are the ingredients required? Standard hours into standard rate, I told you. So standard hours you should calculate. Standard rate you should calculate. Second ingredient is what? Actual fixed overheads. We are going in the same sequence. Clear with this? You also need actual fixed overheads, guys. Correct? So actual fixed overheads. Then what else do you need? Here, guys? Oh, this is volume variance alone I did. Okay, fine. You visualize that. Okay, here I wrote. Okay, expenditure variance. You have what? Budgeted minus actual. So you need budgeted fixed overheads. This is one more line item you need. So budgeted fixed overheads. Now the other figures you have, actuals you have, absorbed and all you have, yes. And one more new figure here. What is it? Actual hours. You need this figure also called as actual hours. If you have these 5 ingredients with you, this entire fixed overhead variances can be completed. Guys, yes. Are you all understanding? Please reciprocate, guys. Yes, you guys are following this? Yes, shall we just go and do a numerical problem? Let's do this. Come on. Take question number 10. Guys, shall we start? Let's do this. Come on, guys. The cost details of J&G Limited. The cost details of J&G Limited for the month of September is as follows. Now, fixed overheads budgeted is 15 lakh. Actuals is 15,60,000. Units of production 7,500 budgeted, and actual units is 7,800. Standard time for one unit is 2 hours. Actual hours worked is 16,000 hours. Calculate all the variances. What are the ingredients you need? First 5 ingredients. What are they? Come on. Standard hours, standard rate, then very good. Actual fixed overheads, then very good. Budgeted fixed overheads, then as simple as that. Actual hours. List this one by one. You guys tell me. Standard hours in this question, how much is it? Huh? 2 hours, sir. Don't say 2 hours. Standard hours means what? For the actual production, how many hours I could have taken? How many hours? How much, guys? 15,600. How did you get? Actual output is 7,800. For my actual production, I could have taken 2 hours per unit. So 7,800 into 2, how much is that? 15,600 hours. Any problem here? No. Standard rate per hour. How much is that? Standard rate per hour. How much is that? How much is that? How much is that? No, what are you looking? Come on, tell me, guys. 100. How did you get 100? Budget fixed overheads divided by budget hours. Guys, correct? Budget hours is how much? So units, budget units is 7,500 and budget time per unit is 2. 7,500 into 2 budget hours is how much? 15,000 hours. So 15 lakh divided by 15,000 hours per hour. What is the rate? It's going to be rupees 100. Any problem here? Guys, simple, no? Next one, actual fixed overheads given in the question figure. 15 lakh 60,000. Then budget fixed overheads figure. How much is that? 15 lakhs. Then actual hours. How much is that? 16,000. That's about it. That's about this entire question. Now, can we just go and do this? Guys, can we just do this now? Yes, come on, tell me, what is the first variance? Fixed overhead cost variance. What minus what? Absorbed fixed overheads minus actual fixed overheads. Absorbed, how will you calculate in terms of hours? Standard hours minus standard rate. So standard hours into standard rate minus your actual fixed overheads. Standard hours, how much is it? 15,600. Standard rate, how much is it? 100. So 15,600 into 100. That's going to be your absorbed fixed overheads minus what? Minus your actual overheads. So now how much is this? 15 lakh 60 minus 15 lakh 60. So that is 0, which means there is no under or over absorption. Clear with this, guys? It doesn't mean the company has saved some money. It means that overheads accounted is equal to overheads incurred. POH account debit side is equal to credit side. That's all is the meaning. It doesn't mean that they have saved some money or incurred more. That actually gets captured under expenditure variance. Guys, correct? Are you all understanding this? Next one, expenditure variance. What is the formula here? Budgeted minus actual. Budgeted fixed overheads minus actual fixed overheads. Budget. Yes, budget is going to be 15 lakh, actual is going to be 15 lakh 60,000. Clear with this, guys? So literally they have incurred 60,000 more than what they had budgeted for. So that's going to be what? An adverse variance. Clear with this, guys? Is everyone able to follow this? Yes. Now how about on the other side, volume variance? Absorbed minus budgeted. Absorbed is what? We saw that 15,600 into 100. That's going to be 15 lakh 60,000. We saw this already, no? So 15 lakh 60,000 minus your budget overheads of 15 lakhs. So that's going to be what? 60,000 rupees favorable. Are you all clear with this, guys? So hence your expenditure variance was 60,000 adverse. Your volume variance was 60,000 favorable. It both knocked off and you ended up in a 0 amount of under or over absorption. Clear with this, guys? Any problem here? No. Now this gets further classified into efficiency and capacity ingredients. So efficiency variance and capacity variance, I think they have made a mistake here. Or is it correct? Yes. So here, okay, so it's first capacity. Okay, guys, capacity variance. First, let's do it in the same order. C and then E. Capacity variance. What is the formula? Actual hours into standard rate minus the top figure, budget overheads. So now what is this? So actual hours, how many actual hours? 16,000 into standard rate is 100 minus budgeted fixed overheads of 15 lakh is going to be 16 lakh minus 15 lakh. So here you get 1 lakh rupees as favorable. Clear with this, guys? And on the other side, efficiency is what? The balancing figure. Absorbed minus whatever we introduced now, AH into SR. So absorbed figure was 15 lakh 60,000. Guys, correct? Minus AH into SR, 16,000 into 100. That's going to be what? 16 lakhs. So now you're getting what? You're getting what? 40,000 adverse. Clear with this, guys? So if you knock off these two, net favorable is how much? 60,000. You get the top figure. Are you all understanding this? Is everyone able to follow this? Isn't it easy, guys? No. Yes, isn't it easy? Have the conceptual knowledge here. Do not mug this up. And this is why I keep telling you this particular area of Your fixed overage is an animal altogether. You need to clearly understand, deal with it separately. The first three are together. This guy travels alone, always. Clear with this, guys. Yes, are you all understanding this? Just go and update your library for adjustments right now. Write down. What is that? Fixed FOHV hyphen direct computation. FOHV hyphen direct computation. FOHV hyphen direct computation. Are we done here? Shall we move on to the next one? Shall we move on, guys? Yes, let's do the next one. Now, I will read the next question, and once I read this, I will introduce the concept of calendar variance. That's nothing, very simple, and that's all. With that, literally speaking, the entire chapter in terms of concepts will be over. Shall we do this? Guys, yes? Perfect. Let's do this. A company has a normal capacity of 120 machines working 8 hours per day of 25 days in a month. In a month, in a budgeted period, how many days are there? How many days, guys? 25 days. The fixed overheads are budgeted at 1,44,000 rupees per month, and the standard time required to manufacture one unit is 4 hours. In April, the company worked how many days? 24 days, right? Of 840 machine hours per day and produce so many units. The actual fixed overheads were so and so. Calculate all the variances. Now, first, guys. Now, generally, the period, at least budgeted period and the actual period should be the same, no? The period for which you're budgeting and the period for which you're actually doing something, these two should be the same. Guys, correct? Now, in this case, what has happened? The budget period had 25 days in it, working days, whereas the actual days only had 24 days in it, which means there is a difference between the budgeted period and the actual period. This difference gets tracked in a variance called as calendar variance. Calendar, why, sir? In your calendar only you will have days and all, no? Guys, correct? That is the logic for this. Calendar variance. Clear with this, guys? Basically, calendar refers to your time. That is your period. Are you all clear with this, guys? Are you all understanding this? Now, in this case, sir, what do we do? Very simple. Fixed overhead cost variance, no change in formula. What is the formula? Absorbed minus actual. Now, bifurcate into two. Expenditure volume. Expenditure variance. Budget minus actuals. No change. Next, volume variance. What is the formula? Absorbed minus budgeted. No change. Now, further volume variance, instead of 2, it gets bifurcated into 3. What, and what? Capacity efficiency is there. In between, you get this guy called as calendar variance. Now, I will put it up here. Now, fixed overhead volume variance. What was the formula? Volume variance, this one. Absorbed fixed overheads minus budgeted fixed overheads. Correct? Now, guys, I am bifurcating broadly into 2. This is what we did till now. What and what? Fixed overhead capacity variance, fixed overhead efficiency variance. Now, what was the formula we used, guys? Capacity variance. So we said I introduced something, actual hours into standard rate minus we did what? Budgeted fixed overheads. Correct? And on the efficiency variance, what did we do? We took this balancing figure. I need to now introduce this guy. Absorbed fixed overheads minus remove this guy, AH into SR. Now guys, what happened? The capacity difference is not purely on account of you deviating AH and SR and all. I told you that concept, no? Actual hours, budgeted hours. In between, there is one more contributing factor, which is your total number of days difference. Guys, correct? No? I told you. So now what you will do is, now guys, now in this particular question, now you guys tell me what was actually the total budgeted fixed overheads. Guys, what is the budgeted fixed overheads? So it was actually 1,44,000. Guys, correct? It was 1,44,000. Now this 1,44,000, right? Ideally, I budgeted for how many days? 25 days, but actually I worked only for 24 days. So this overheads will move in proportion to the period, guys, correct? So period it will move. It will not move in proportion to your output or hours, guys, correct? So literally speaking, the overheads that I need to compare, right now it's going to be 1,44,000 divided by 25 into 24. How much is that? 138 240. Am I right, guys? 138 240. Am I right? Now this figure I call this as actually possible budgeted fixed overheads. I'm just changing it, guys. Clear with this, guys? I'm just changing it. Are you all understanding this? Any problem here? No. So now what we do here, we just go here and we say, sir, wait, I introduce a guy called as fixed overhead calendar variance. Now what we do, instead of in this capacity variance, we subtracted the top figure, no? Budgeted fixed overheads, guys, correct? Now instead of budgeted fixed overheads, what we will do is, we will just erase this budgeted fixed overheads and instead we will introduce this new guy. Who is that? Possible budgeted fixed overheads. So now it will not tally with the top figure, no? Do not worry, immediately reverse this. Possible budgeted fixed overheads minus your budgeted fixed overheads. Are you all clear with this? Are you all understanding this, guys? Basically, here till now what we were subtracting, guys, here till now we were subtracting budgeted fixed overheads. Now what I did, instead of budgeted fixed overheads, I am comparing this AH into SR with possible budgeted fixed overheads. Why? Because the budgeted period was for a different number of days, actual period was for different number of days. Guys, agreeing with me on this? Hello? Yes. So now what I did, I'm comparing only my possible budgeted fixed overheads here. Then, sir, it will not tally with the total figure. Do not worry. I'm introducing a calendar variance and I'm immediately nullifying this effect. Now, if you see, this possible and this possible will get knocked off. Minus possible here, plus possible here, it will get knocked off. Guys, correct? And this figure will also get knocked off. In the top, in essence, what will you have? Absorbed fixed overheads minus budgeted fixed overheads. That's what you need to get. Guys, are you all clear with this, guys? Are you all understanding this? Yes, are you all understanding this? You guys are all following? Yes, yes. So now literally this is the final formula. And when will you use calendar variance? When the number of days in the budgeted period and the number of days in the actual periods are different. So now you create something called as possible budgeted fixed overheads, and what you will do, first you will adjust that with your AH into sir. You will use that for your capacity variance. Sir, it will not tally with the total. Immediately you pass a rectification here, or you immediately balance it out by introducing something called as a calendar variance. Are you all clear with this, guys? Is everyone able to follow? So now clearly this gets knocked off here. This also get knocked off here. You will be left only with two figures. What are they? Absorbed fixed overheads minus budgeted fixed overheads. That's what you need at the top. Are you all understanding this? Are you all understanding this? So look, guys, this is exactly what they have done here. So fixed overhead capacity variance is AH into SR minus possible budgeted fixed overheads. Immediately calendar variance, possible budgeted fixed overheads minus budgeted fixed overheads, and your fixed overheads efficiency variance is absorbed minus your AH into SR. Are you all clear with this, guys? Is everyone able to follow this? Guys, are you all able to understand this? Yes, this is the most intricate area, and once you're through with this, that's about this entire chapter. First, are you all understanding? Please tell me, guys. Any problem here? No. And this calendar variant comes when the number of days in the budget is different from the number of days in the actuals. So now in this case, you need one more ingredient. What is that? Possible budgeted fixed overheads. That's the maximum complexity of this particular area. Shall we just go and do one sum? This sum, can we do it? Now I will be reading this question. Now guys, let me read this question for you. Yes, fine. Now, okay, fine. So now a company has a normal capacity of 120 machines working 8 hours per day of 25 days in a month. The fixed overheads are budgeted at 1,44,000 rupees per month. And the standard time required to manufacture one unit is 4 hours. In the month of April, the company worked 24 days of 840 machine hours per day and produced A305 units of output. The actual fixed overheads were 1,42,000. Compute the fixed overheads variance, and they've asked for all the variances. Now, can you just attempt it once? Will you attempt it, guys? Yes, I will give you 2 minutes time. Please try to attempt it. Please try to attempt it. And for the online folks, pause the video now. Attempt this entire thing. First, calculate all the ingredients and do the formula substitution, and then we will discuss and do this together. Yes, so yeah, do it now. Now guys, first, everyone please participate. Tell me, guys, what are all the ingredients required? Everyone tell me first. Standard hours, standard rate, actual fixed overheads. Very good. Budgeted fixed overheads. Okay, let's go in the same order. Actual hours and then possible budgeted fixed overheads. Some people even call it as revised budgeted fixed overheads. Any which ways you want, you can use it, right? So here they have used the word revised. You can also use possible. Whatever it is fine. Clear with this, guys? Shall we start now? First, standard hours means what? Means what? For the actual output, how many hours you could have taken? Now, tell me, guys. So actual output 5305. Every unit you can take 4 hours. 5305 into 4. How much is that? 21,220. Next, standard rate. Rate stands for rate per hour. Budgeted overheads divided by budgeted hours. Budgeted overheads 1,44,000. Budgeted hours. I have 120 machines. Each machine works 8 hours a day, and like that in the budgeted period I had 25 days a month. So 120 into 8 into 25 gives me 24,000. 1,44,000 divided by 24,000 gives me 6 rupees. Are you all understanding? Any problem here? Guys, you guys are clear with this? Yes. Next one. Actual fixed overheads given. How much? 142,000. Budgeted fixed overheads given 1,44,000. Actual hours given. No, compute. What is the actual hours? Now 840 machine hours they have given per day, and like that there are 24 days in a month, that is in the period actually worked. Actual hours is 840 into 24. How much? 20,160 hours. Clear with this, guys? And finally, what is the possible budgeted fixed overheads? I told you 1,44,000 is what I planned for the budgeted days, but actually I worked for 24 days. For the actual period, what should have been the possible budgeted fixed overheads? So 144,000 divided by 25 into 24. How much is that? 138,240. Now you have the ingredients with you. Then go ahead and substitute the figures. Now guys, let's build this fully one last time. Let's build this fully. Come on, do this first. Let's do this together. Come on, you just participate. That will do. First, fixed overhead cost variance, right? Your formula absorbed, can I call it as standard hours into standard rate minus actual fixed overheads. Now let's substitute the figures. You guys tell me the figures, I will do it. Standard hours 21,200 in 220. So 21,220 is it? I'm sorry. So it's 21,220 into standard rate rupees 6 minus actual. Actual is going to be 1,42,000. Yes, 1,42,000. Tell me, guys, 21,220 into 6 is going to be how much? 127,320. This is my absorbed overheads minus what? Minus rupees 1,42,000. Figure. It's going to be 14,680 adverse. Now this adverse stands for what? Basically, I have absorbed 127 and odd, but I have actually incurred 142 under or over. Under absorption, and hence if you are having an under absorption, you need to now introduce more cost into your books. If you now add cost to your books, your profit will drop, and hence an adverse variance. This is how you need to understand this. Are you all understanding it? Guys, clear with this? Right? Now this gets classified into what and what? Fixed overhead, expenditure variance, and fixed overhead volume variance. Okay, expenditure variance formula. Yes, it's going to be budgeted fixed overheads minus budget minus actual. Sorry, guys. Budget fixed overheads minus actual fixed overheads. Budgeted figure 1,44,000 minus 1,42,000. So, how much is that? 2,000 rupees. Huh? 2,000 is going to be a favorable variance. Clear? On the other side, formula absorbed minus budgeted. So absorbed fixed overheads minus budgeted fixed overheads. Excellent, guys. Figures tell me. Figures. Huh? So absorbed, I already have the figure here. 127, 320 minus budget 144, 000. Figure 16,680. I get an adverse variance. Now this guy, now this volume variance, I will bifurcate into three. Why three? Because I have a calendar variance here. Now what are the three variances? Fixed overhead. One second here. Yes, fixed overhead, capacity variance, then fixed overhead, calendar variance, then fixed overhead, efficiency variance. Perfect. Capacity variance formula. So it's going to be actual R. This alone I asked you to remember, into standard rate minus. Now ideally budget should come, but this guy, new guy comes in, minus possible budgeted fixed overheads. Now immediately calendar variance, he will come to nullify possible budgeted fixed overheads minus budgeted fixed overheads. Clear with this, guys? And this guy is always that balancing figure, absorbed fixed overheads minus AH into SR. Substitute and finish it off. H how much? AH evrama? So 20,160 into standard rate 6 minus possible budget overheads is 138,240. Am I right? So 20,160 into 6 is 120,960 minus 138,240 is 17,280 is an adverse figure. Now this is 138,240 minus budget is 1,44,000. How much is that? 5,760 adverse. And then here absorbed, how much is the absorbed figure? 127,320 minus AH into SR. Okay, we'll put it as 20,160 into 6. Figure, tell me final answer. How much, guys? Figure, final answer. 6360. Adverse or favorable? It's a favorable variance. Now let's add these three figures and see. So now you get what? 17,280 plus, this is also adverse, 5760 minus 6360 favorable. Net off, do you get, daddy? 16,680 adverse. Clear with this? 16,680 adverse, net of 2,000 favorable, you get 14,680 as your overall fixed overhead cost variance. Clear with this, guys? Are you all understanding this? Isn't it easy, guys? Direct and easy, provided you understand it conceptually. Clear with this, guys? Always remember this. Know this chart, right? And then list out the ingredients. Find the ingredients, substitute the ingredients in the chart, and you are done with the entire sum in standard costing. That's about it. But the key here is to know what each of the components stand for, the logic behind it. Only then you will be able to write the formula. You need not mug up anything. Clear with this, guys? Just go and update your library for adjustments. Write down. Write down. FOHV, fixed overhead variance, hyphen with calendar variance. With calendar variance. This is question number 11, no? With calendar variance. Right? Yeah. You want a break now? Okay, fine, guys. So with this, I am concluding this session. Please revise till whatever we've covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, standard costing. So now, guys, we have literally covered this entire chapter in terms of all the concepts. So we've seen all the 4 variances. What are the 4 variances? Material variances, labor variances, variable overhead variances, fixed overhead variances. Literally, this chapter is completed. Now, I've just kept some questions which ideally are some practice questions, but still I wanted to take up a few questions for the sake of completeness, so that you also get a good coverage in the classroom. Now, because I want to handhold you on a few questions, literally the last 3 questions are missing figures. Nothing in terms of concepts new that you're going to learn. Everything is same. You just have to practice different varieties. And the next 2 questions are slightly different with respect to overhead components. So that's why I've kept these questions. Shall we start, guys? Yes. Now guys, any kind of formula in this chapter, do you have it in your fingertips? Yes, please have that. And trust me, guys, this will help you in the long run. Why in the long run? Even in the short run, in your exam, any kind of question from this chapter, you will be able to hit it for a 6. That should be your objective. Now, shall we move to this question number 12? Let's do this. Now, guys, will you be able to handle this? Will you do it? Yes, come on, I want the answers in a jiffy. Now, quickly, let's do this. Now, the following information was obtained from the records of a manufacturing unit using standard costing system. Standard data, actual data. Production 4,000 units, actual 3,800 units produced. First of all, tell me, guys, ideally, this is not standard. This is budget data. Clear with this? Exam, what students do is, who do not know the concept, they have given standards, sir, all the data was available. No, they are literally playing around with your terminologies. Clear with this? If it is meant for a different output level, that is a budgeted data. Standard means what? For the actual output, what should have been the ingredients? Clear with this, guys? Next, working days in the budgeted period is 20, actual period is 21, which means that's all. Calendar variance will be applicable. Clear? Next, machine hours, budget, actual. Fixed overheads, budget, actual. Variable overhead, budget, actual. You are required to calculate the variable overhead variances, fixed overhead variances. That's all has been asked in the question. Literally, both the variances they have asked. Now, can we do this? Now, first easy part we will do. What is that? Variable, which means fixed is difficult. Huh? For us, both are easy only. Right? Now, variable overhead variances. What are the ingredients needed? 4 ingredients. How many ingredients? I said 4. Standard hours, standard rate. Actual hours, actual rate. Perfect. Very good. Now, tell me, guys, standard hours means what? For my actual output, how many hours am I allowed to take? How many hours, guys? How many hours, guys? Calculate, tell me. Standard hours, calculate. Don't look at the solution. Calculate and tell me. You will be able to do it. Don't give up. Huh? 7,600. Why? Because it's mentioned below. Okay, tell me. 7,600. I was kidding. Tell me, how did you get this? Huh? Now, clearly, guys, using the budgeted data, you can arrive at standard hours per unit, no? You are allowed to take 8,000 hours to produce how many units? 4,000 units, which means per unit you are allowed 8,000 by 4,000. 2 hours is the standard hour per unit. You are allowed to take 2 hours for every unit. Actually, you produce how many units? 3,800. So the standard hours is 3,800 into 2. How much is that? 7,600. I have mentioned here it's nothing but 8,000 by 4,000 into 3,800. That's how you get it, guys. Clear? Next, standard rate. Standard rate of variable overhead. Standard rate. How will you get it? Standard rate. Huh? What is the standard rate of variable overheads? 15. How did you get it? Guys, standard rate means what? Per hour. What is the amount you are allowed to spend? Simple. 1,20,000 in the budgeted data. 1,20,000 rupees is the amount you are allowed to incur for a budgeted 8,000 hours. Per hour, how much you are allowed to incur? 1,20,000 divided by 8,000. 15 rupees. Are you all clear with this, guys? Using the budget data, you will arrive at all the standard figures. Now, actual hours. How many hours? This I will tell you. It's given. So, 7,800 hours. Clear? Yes, this is not a doubt. Yes, 7,800. Obviously, your actual rate, what is that? Guys, actual rate means what? Per hour. How much is the actual overheads I am incurring? Simple, actual overheads is given, actual hours is given, divide the two, 1,20,000 divided by 7,800. How much is it? 15.3846 goes on to your memory, not your memory, calculator's memory. Correct, guys? Yes, so you can just put it in M plus whenever you are calculating, you will do it. You guys know that M plus MRC? So MRC should have been cleared before you do this calculation. Now, shall we go and do the calculation, guys? Basically, guys, calculation, let's not do. Basically, simple, substitution. Now, you guys tell me what is the formula, everyone. Variable overhead cost variance. Standard hours into standard rate minus actual hours into actual rate. Now, bifurcated into two, what and what? Variable overhead expenditure. I don't call it as a rate because I'm paying to electricity board. So, variable overhead expenditure variance, variable overhead efficiency variance, expenditure variance. Standard rate minus actual rate into actual hours. And always actual hours stands for actual hours worked everywhere. Now, on the other side, efficiency variance. Standard hours minus actual hours into standard rate, and you just need to substitute these four figures wherever they have asked for. You will get it. Variable overhead cost variance 6,000 adverse, expenditure you're getting 3,000 adverse, which means obviously efficiency will be the balance 3,000 adverse. Direct formula substitution. Clear with this? Any problem you want me to do it? Are you all clear with this? Shall we move on to the next one? Yes. Now, fixed overhead variances. First, now for this purpose you should only take the fixed and all. Variable component is done and dusted. Now first list out the ingredients. Come on, guys. First, what are the ingredients? Standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, actual hours, possible budgeted fixed overhead. Excellent, guys. Very good, very good. List out the ingredients. First thing that is done. Now write down the ingredients. First, standard hours, I think we already computed. Standard hours will not change. It's going to be what? 7,600. We computed this already. Standard rate, wait, that was standard rate of variable overheads. Now you need to arrive at standard rate of fixed overheads. Clear? Don't take the same. Guys, clear with this. Right, now standard rate of fixed overheads, how much is it? How much is that, guys? 50. How did you get? Budgeted fixed overheads divided by budgeted hours. 4 lakh divided by 8,000. How much is that? 50. Any problem here? Any problem here? No. Next one. Actual fixed overheads. This I can tell you. 3,90,000 because it is a given figure. Right. Next. Budgeted fixed overheads. This also I can tell you. Once again, a given figure. 4 lakh. Next. Actual hours. Once again, this also I can tell you, 7,800 hours. Possible budgeted fixed overheads. Calculation. 4 lakh is what I budgeted for a budgeted period of 20 days. For the actual of 21 days, how much is that going to be? 4 lakh by 20 into 21. 4 lakh 20,000. You got all the ingredients? Substitute it. Now, guys, you need to tell me the entire tree once again. Come on, tell me. First, fixed overhead cost variance. Wait. This variance, it calculates what? What is this variance? What is this variance? What does it refer to? Under or over absorption. Very good. So, absorbed minus actuals. Now, absorbed, how will you calculate? Standard hours into standard rate. Fine. Minus your actual. Further, classification into two. What and what? Fixed overhead expenditure variance, fixed overheads, volume variance. This expenditure variance is also known as budget variance because here you're comparing what with what? Budgeted fixed overheads minus actual fixed overheads. Now on the other side, absorbed fixed overheads minus your budgeted fixed overheads. Very good. That's about it. Now the other one, your volume variance is bifurcated into 3 in this case. Why? Because calendar also comes in. What and what? Capacity variance, calendar variance, and efficiency variance. Now, capacity variance. AH into SR minus possible budgeted fixed overheads. Immediately it gets reversed. Possible budgeted fixed overheads minus budgeted fixed overheads. Very good. And finally, balancing figure, your absorbed fixed overheads minus AH into SR. And that's about it. Substitute everything. You are done with this sum. Clear with this, guys? This is one single question with both the variances. Clear with this, guys? If it comes in, it can come for 8 or 10 marks because it's a full-fledged question. Every single variance you are computing. Clear with this, guys? Right? Again and again. Now, anytime anyone is asking you this particular, any formula from this entire chapter, will you be able to handle it? Labor rate variance, what is the formula? Think, visualize, who's responsible? Standard rate minus actual rate into perfect into actual hours. Very good, guys. Clear with this, guys? Anything if you want, you will be able to pick it up, provided you visualize who is responsible and if you are able to do it. Clear with this, guys? Yes, excellent, very good. Can we just go and update our library for adjustments? Write down question number whatever 12, huh? Yeah, write down FOH and VOH variance hyphen FOH and VOH variance hyphen FOHV fixed overhead variance. FOHV within bracket with calendar variance. FOHV within bracket with calendar variance. Bracket close. And VOHV. That's all. And VOHV. VOHV stands for variable overhead variance. That's all. Shall we move on to the next question? No. Guys, don't look at the solution. Don't please look at the solution. I want you all to crack this a study material question. This is where your conceptual understanding will help you out. Shall we do this? Now, the overhead expense budget for a factory producing to a capacity of 200 units per month is as follow. What is this? Budget. And the budgeted capacity, they are preparing this budget for how many units? 200 units. Description of overheads. Now, power and fuel, repairs and maintenance, printing and stationery, other overheads. 4 different, they have broken up the different types of line items of overheads and all. Inside every overheads, they have mentioned how much is the fixed cost per unit, variable cost per unit, total cost per unit. Forget all that. Overall, the fixed cost per unit, fixed overhead per unit is how much? 3,000. Total variable overhead per unit is how much? 1,500. This is what you can get from the budgeted data. Are you clear with this? Next, the factory has actually produced only 100 units in a particular month. The details of the overheads actually incurred have been provided by the accounts department, which are as follows. Description of overheads. Line item wise, they have given how much is the actual overheads incurred. This actual overheads, is it fixed or variable? Huh? Actual overheads incurred, is it fixed or variable? It is both put together. Guys, clear? They have not given you the bifurcation of how much is fixed, how much is variable. They have just given the total amount actually incurred. One portion is fixed, one portion is variable. Clear with this, guys? How much and all that you need to calculate. Right? You are required to calculate. Look what they have asked. Overhead volume variance, only one variance, and overhead expense variances. Means what? Volume variance under which variable or fixed, under which it will come? Huh? So literally fixed overhead volume variance they are asking. And overhead expense variances means what? This will come under both variable as well as fixed. Guys, correct? So they are asking you for 3 variances in total. Calculate. Enjoy. Calculate. Come on, guys. Seriously, come on. Now assume this question has come in your exam. Bring that survival instinct. Do it, guys. Do it. You will be able to crack it. Now, in this question, any hourly data is given? Which means use your units data and do it. Absorb overheads and all. You know what to do. What to do. GOK, wa? God only knows. Guys, absorbed overheads is what? When you're using production units method. Standard rate per unit into actual output. Bring that on all logic. I told you nothing is given in terms of hours. This question only students are saying insufficient data, grace marks they were asking. Right, we have done so much. This is not insufficient data, no? It's all sufficient only. But it requires some assumptions to be done. Very valid assumptions you need to do. Do not look at the solution. You're gone if you look at it. Do it by yourself. I'll give you 2 minutes time, and the online folks, take 2 minutes. Try to crack this. Try to crack this, and then come back. Only 3 variants. Don't do all the variances. So first, what are the three? Only 3 variances. What are the 3 variances, and what are all the ingredients required? Based on that, you reverse work and calculate. Do it like that. Come on, 2 minutes time. Just a small correction, guys. 1 minute. I told you, no, this is they've asked for overhead expense variances. I just went through the question. In your variable overhead variance, expense variance, what is the formula? Variable overhead expense variance. Standard rate minus actual rate into actual hours. Hourly data is not given here, rates and all is not given, so that cannot be done. You leave that. Basically in this question, it's only with respect to your fixed overhead variances, right? So please have that alone in your mind. Since I was thinking they'd asked for plural, since I thought that data was also asked. No, only your fixed related overheads are overhead variances are asked. So focus only on fixed right now. Now guys, the first thing they have asked for is what? Guys, please. First thing they've asked for is fixed overhead volume variance. Volume variance, what is the formula? Absorbed minus budgeted. That is right side. Right side, absorbed minus budget. Okay. Absorbed minus budgeted overheads. We're talking only about fixed. We're only talking about fixed. Now guys, absorbed overheads, what is the figure? Absorbed overheads, how much is it? 3 lakhs. How did you get 3 lakhs? Now look at this. Absorbed overheads means what? Predetermined rate or the standard rate per unit into actual output. Unit data is given. Now predetermined rate, how much was that? 3,000 rupees. It's been given enough. I'm talking only about the fixed cost component, right? Into actual output is how much? 100 units, which means every time I produce a unit, I will be charging it with an absorption rate of 3,000 rupees. Guys, are you all understanding? So 3,000 into 100, that's going to be 3 lakh rupees. Absorbed overheads is going to be 3 lakh rupees. Clear with this, guys? Minus budgeted fixed overheads. How much is that? Simple. 3,000 into 200, that is pertaining to 200 units of capacity. Clear with this, guys? So that's going to be how much? 3,000 into 200, 6 lakhs. So 3 lakh absorbed, 6 lakh budgeted. So you have 3 lakh rupees of adverse variance. Any problem here? Any problem here? No. Next to what they have asked, overheads expenditure, fixed overheads expenditure variance. Expenditure variance means what minus what? Budgeted minus actuals. Now budgeted fixed overheads, I already know. How much is that? 6 lakh, 3,000 into 200. Actual, not actual full overhead, actual fixed component around. Now you add up these figures, totally what is the overheads you're getting? 4 lakh plus 2 lakh plus 175,000 plus 375,000. How much is that? 11 lakh 50,000. Correct, guys? Now, sir, 11 lakh 50,000 is the total overheads. Here, actual, I need to only take actual fixed overheads. Out of this, how much is variable? How much is fixed? Sir, how will I know? This doubt is there. Now, what you need to do is, in the absence of information, you can assume that the variable overheads per unit remains to be the same even in actuals. Guys, clearer? Are you all understanding this? So in the apps, they have not given how much is variable fixed. Nothing has been given. So can I say, so variable cost per unit or variable overhead per unit was 1,500 rupees, right? In the absence of information, I will assume that budgeted variable cost per unit is equal to actual variable cost per unit. I told you, remember, if in the absence of information, you can assume that budget is equal to actual. In case of fixed overheads, you will assume in total it is equal. Budgeted fixed overheads is equal to actual fixed overheads in total. Or in the absence of information, you can assume variable your variable production over or variable overheads per unit is equal to your, basically your budgeted variable overheads per unit is equal to your actual variable overheads per unit. Guys, clear with this, guys? Are you all understanding? So I will assume that 1,500 rupees is actually the variable overheads actually incurred on a per unit level. So now 1,500 into 100 units, how much is that? 1,50,000. So out of this 11,50,000, 1,50,000 is going to be your variable component. Fixed component is going to be 10 lakh. So budget was how much? 6 lakh. Actual fixed overage was how much? 10 lakh. There is an adverse variance to the extent of 4 lakh, and that's about the sum. That's all. The sum is over. That's all. The main catch here, two things. One, calculating the absorbed overhead using production units method, and number two, taking the assumption that the variable cost per unit is same for both the budgeted data and the actual data. These two, you can't take another assumption for this and all. Clear with this, guys? This is exactly what they have done. Budget minus actual. Budget was 6 lakh. Actual fixed overhead is how much? Total overheads minus variable overheads. Total actual overheads was 11 lakh 50,000. Out of this variable, I am assuming that 1500 rupees is going to be the actual variable overheads per unit. So now 1500 into 100, it's 1 lakh 50. So 11.5 lakhs minus 1.5 lakh gives you 10 lakhs as the actual. 6 minus 10, 4 lakh adverse. It is assumed that the actual variable overhead per unit is also 1500 rupees per unit. Are you all clear with this? Any problem, guys? Guys, are you all understanding this? Shall we just go and update the library of adjustments? Write down. Write down. FOHV hyphen FOHV hyphen FOHV hyphen FOHVV volume variance, FOHVV fixed overheads volume variance, and fixed overhead expenditure variance, FOHEV within bracket using units only, within bracket using units only, within bracket using units only. Clear? Done, guys? Are we done here? Are we all done? Yes? Shall we move on to the next one? Hello? Let's do the next three questions. Guys, the next three questions are all missing figure sums. Shall we do this? Yes, ideally, I could have given it as practice question, but nevertheless, let's quickly do it. Now, I will read the question. I will give you guys some time. Solid 5 minutes I'll give you. Try to crack something, and then quickly we will get started. Shall we, guys? Yes. Now, question number 14. Gap Limited operates a system of standard costing in respect of one of its products, which is manufactured within a single cost center. The following are the details. The budgeted data is given. Material A, material B, 60/40. Total input 100. Allowed for a normal loss of 20. Output expected is how much? 80. Clear with this? Any problem? No. Next, standard price is also given, 20 and 30. Amount they have multiplied and they have given it here. Actual data, actual output is how much, guys? 80 units, right? Now, what have they given here? What have they given here? Actual quantity for material A given 70, right? For material B, you need to find out. Similarly, actual price for A not given, for B it's given as 30. Clear? And they have not multiplied, they've asked all this question mark. And a few more data is given. Material price variance is how much? 105 adverse. Material cost variance is how much? 275 adverse. You are required to calculate the actual price of A, actual quantity of B, and material price variance, material usage variance, then material mix variance, and sub-usage means what? Yield variance. This is what has been asked in the question. Now, guys, it's like a puzzle that you need to solve. Will you be doing it? Will you handle it? Come on, guys, I'm telling you. Assume that this question has come in your exam and you're sitting in an exam hall. Bring that survival instinct. That's all. Just bring it and you will be able to crack it. The online folks, come on. Just try attempting it. I'll give you 5 minutes time. You take 5 minutes. Full 5 minutes you take. Right? Crack the entire question and come out. Right? 5 minutes and then you resume back the video. Guys, 1 minute. This 105 adverse is given, no? Right? This is material price variance of material A. Okay, please make a correction here. Correction doesn't just add it. This is MPV of A alone. Material A's MPV comes out to how much? 105 adverse. Clear with this? It is not total MPV. Total MPV is asked here. Total MPV is what? MPV of A plus MPV of B. Here MPV of A alone is given as 105 adverse. Please change it. Please change it. So this is what is given in the question. Now you start doing it. Basically guys, if you calculate this actual price of A and actual quantity of B, you will get all the ingredients required, correct? These two alone you compute, everything else automatically we can do all the variances. So here only these two are missing figures. If you are able to crack these two, then you will get all the required data, and that's about it. Formula substitution that you know how to do. Come on, attempt it, do it. Now guys, first they have given that the material price variance of A, the raw material A, is 105 adverse. Simple guys, you just need to calculate the actual price of A and actual quantity of B. If you get these two ingredients, then all the ingredients are available. Standard quantity, standard price, actual quantity, actual price for both the raw materials. Then you will be done. Any other, whatever is asked in the question, you can do it. Now shall we get started guys? Yes. Now first guys, actual price of material A, let us keep it as X, right? So material price variance of product A is given as 105 adverse. Correct guys? What is the formula for material price variance? Come on everyone. Hello everyone. Standard price minus actual price into actual quantity. Standard price of material A, how much is that? 20 minus actual price of material A, we need to calculate X, into actual quantity, it was 70. Guys, correct? Is equal to what? Is equal to 105 adverse is given. Adverse means what? Adverse means what? Your actual is greater than the standard, which means hence it will take a negative sign. Guys, correct? Right? So this is equal to minus 105. So now you just need to do all this LHS, RHS. This goes to the other side. This comes here. So 1400 plus 105 is 1505 is equal to 70x. So x is equal to 1505 by 70. How much is that? 21.5. Now you got what? The x value of 21.5, which is nothing but your actual price. Guys, clear? Simple? Any problem here? Now some students might have actually missed out this negative symbol here, or minus. If you have ignored that, then what is the answer you got? 18, 18.5. Be careful. Don't do this. Be careful. Clear with this? Yes, guys, that's about it. If you made a mistake, very good. Take a red ink, mark it definitely the day before your exam. Have a look at it. You did this mistake, you should not repeat it in exam. Be thankful for the mistake committed now. It is avoidance in the future. Now, shall we move on to the next one? Yes. Now, they have asked you to calculate what? The actual quantity of product, raw material B. Guys, correct? Right? How will you do that? Now, literally, guys, no, everyone. Now, material cost variance of both the products put together is given 275 adverse. Material cost variance is what? Standard quantity into standard price plus minus actual quantity into actual price for both the products. Guys, correct? So now can I say guys, here let's keep this actual quantity of B as X. So material cost variance is standard quantity into standard price minus actual quantity into actual price, which is 275 adverse, given now. Guys, correct? So now can I say material cost variance of both the products put together is material cost variance of A plus material cost variance of B. Correct, guys? Material cost variance of A is what? So for A, you tell me what is the standard quantity? 60 into standard rate, standard price 20 minus actual quantity 70 minus actual price, just now we calculated 21.5. Guys, correct? Plus similarly, I can do this calculation for raw material B. In my raw material B, what is the standard quantity? 40. Standard price 30 minus actual quantity, I need to find out X, into your actual price given as 30. Guys, correct? Hello? Any problem here? This is equal to 275 adverse. 275 adverse means what? A negative 275. Guys, correct? Now substitute all these things. 16 to 20. 1200. 17 to 21.5. Do it. How much is that? Do it along with me. How much is that? 1505. Right? Plus 14 to 30 is 1200 minus x into 30 is 30x is equal to minus 275. Guys, now you just need to solve this, and that's about it. So now you can take these figures here. So 1200 minus 1505 plus 1200. So how much is that? 1200 minus 1505 plus 1200 is equal to 895 minus 30x is equal to 2 minus 275. 30x goes to the other side, and this comes here. 895 plus 275, that's 1170 is equal to 30x. X is equal to 1170 by 30. How much is that? 39 units. And now what you got? You got this value of 39. Clear with this, guys? So now for both the products, you have a standard quantity, standard price, and actual quantity, actual price. Substitute the figures in the respective area, you will get the answer. That's the catch of this question. Clear with this, guys? Yes, that's about this question. Shall we just go and update a library of adjustments? Yes, you want me to do all this formula substitution? Substitution, you can do it better. Please at least do that. Come on, write down. Missing figures hyphen material variances. Missing figures hyphen material variances. Missing figures hyphen material variances. Now, quickly, let's go to the next question, shall we? It's 2 more to go, and that's all. Right? Now, please, all these are some practice questions. Do it. Shall we move on to the next question, guys? Yes. So question number 15. Paras Synthetics uses standard costing system in the manufacturing of its product star 95 mask. The details are as under. Looks like a COVID question. So during that time this question came in, I think so. Now particulars, what are they saying? Direct material 0.5 meter at the rate of 60 per meter 30. Direct labor 1 hour at the rate of 20. Variable overhead 1 hour at the rate of 10. Total is going to be what? 60 rupees. Means what? All these are standard data given for 1 unit of output. Output is called as star 95 mask. Clear with this? Hello? Yes. During the month of August, yes, this company, 10,000 units of this product were manufactured, and the details are as follows. Direct materials consumed 5,700 at the rate of 58. Guys, now 5,700 stands for actual quantity, that's all, no? And 58 actual price, not rate. Material is price. Clear? Now standard quantity, standard price, can I do standard quantity? This is standard price. I mean standard price is 60. Standard quantity will be 0.5 into 10,000. Guys, that's all, no? Are you all clear with this? Per unit I can take 0.5 meter. Actual 10,000 units, how many meters I could have taken? It's 0.5 into 10,000, 5,000. Clear with this, guys? No problem. Next, direct labor, they are giving a question mark, right, at the rate of question mark. So how many actual hours are taken? We don't know. Actual rate, we don't know. But the actual labor cost is given. Guys, clear? Then variable overhead incurred also, the total actual figure is given. Now variable overhead efficiency variance is how much? 2000 adverse given. Variable overheads are based on direct labor hours. You are required to calculate the missing data and all the relevant variances. If you calculate the missing data, all the other variances can be calculated. Now guys, in your material component, everything is given, no? Right? Only in your labor you need to calculate that. If you calculate your labor and all that, labor area, whatever is a missing figure, then the remaining sum you can easily do it. Will you guys attempt it? Yes, I'll give you about 2 to 3 minutes time. Just try to crack the missing figure here, and obviously one variance is given, so using that variance attempt something, you will get it. There is nothing conceptual here. It requires some presence of mind. This is like solving a puzzle. Guys, you guys know the Sudoku puzzle? Yes, whether we solve it or not, we all know because it gets printed on the backside of every newspaper, no? Now this Sudoku, can I always say, start from the left side most corner, then go 2 steps forward, 5 steps backward, and always do this. Will you get the answer? Can I tell something like this? No. Based on the given data and the required data, I need to customize, and only I need to do it. It requires some presence of mind. Exactly on the same line, this is how this works. Even if you solve 100 questions in missing figures, there could be an 101th question that can come in your exam. So basically this requires practice in order so that you get this presence of mind. Will you guys attempt it now? Yes, just take 2 to 3 minutes, try to figure out the missing figures, and we are done here. Let's do this, guys. And the online folks, pause the video now, attempt the missing figures, and then resume back. Okay, guys. Now, first, guys, first, now what you need to do is labor hours. You need to calculate the actual hours and actual rate. Similarly, variable overheads also, actual hours, actual rate. Now, material, actual quantity, actual price is available. For all the components, material, labor, variable overheads, standard data is all available. So basically, guys, what I need to compute only for labor and variable overheads, if I get actual hours, actual rate for labor, similarly, actual hours, actual rate for variable overheads, any kind of variance I can compute, guys, correct? Are you all understanding this? Now, first, what is the starting point? Now, variable overhead efficiency variance is given as how much? 2000 adverse. Variable overhead, third variance. Variable overhead efficiency variance, what is the formula? Standard hours minus actual hours into standard rate. Perfect. Now let the actual hours be X. So standard hours, how much is the standard hours? Now look at this, 10,000 units I'm producing. Every unit I'm allowed to take 1 hour of variable overhead time. It's going to be what? So 10,000 hours minus actual hours, I don't know, X, into standard rate. How much is the standard rate for variable overhead? 10 rupees is equal to 2000 adverse, or is nothing but minus 2000. Guys, correct? So standard, if it is negative, I mean, it's adverse means what? Your actual is more than your standard, guys, correct? Or you get a resultant negative figure on the cost side, right? So now, how much is this going to be? So 10,000 into 10, that gives you what? 1 lakh minus x into 10. 10x is equal to minus 2000. So now this goes to the other side. This comes back here. So 1 lakh plus 2000 is 1 lakh 2000 is equal to 10x. X is equal to 1 lakh 2000 by 10. 10,200. So with respect to variable overheads, actual hours is how much? Guys, 10,200, and they've clearly given, so it is based on your labor hours, which means what? The actual labor hours was only 10,200, and here variable overheads is also driven by labor hours only. So actual hours for both your variable overheads as well as for your labor hours is going to be 10,200. Any problem here? Guys, are you all understanding this? Any problem here? No. Now you know what to do. Direct labor cost, how much is this? 2,24,000, right? So 2,24,000 is the actual labor cost, guys, correct? 2,24,000, sorry, 224,400. Yes, guys, 2,24,400. This is equal to actual hours into actual rate, guys, correct? Or 10,200 into actual rate, guys, correct? So what is the actual rate? 224,400. 224,400 divided by 10,200. How much is that? Actual rate is equal to 22. Wait, this actual rate is what? Actual labor rate. Guys, correct? This is actual labor rate. Guys, clear with this? Similarly, for overheads also, I can have an actual rate. So how much is that? Simple. 1,12,200, right, is equal to 10,200. That's nothing but my actual hours into actual rate. This actual rate is variable overhead rate. So here it's going to be what? 1,12,200 divided by 10,200. How much is it? 11 rupees. The actual rate for my variable overhead calculation is 11 rupees. Actual rate for my labor calculation is going to be 22 rupees. Any problem here, guys? Any problem here? Are you all clear with this? Any issues here? No. Fine. Guys, you all are clear with this, right? Yes. Fine. And that's about this chapter. That's about this particular question. So now you've got all the ingredients right now. Standard data are all available. Guys, focus here. Standard data are all available. Actual data, certain things were missing, that also we now calculated. And with this, all other variances you can compute. Guys, any problem in this? Any problem in this? So now the variances you can compute. That is a normal elementary calculation. Missing figure is the reason why I am taking this for discussion. Clear with this, guys? Right? So the previous question, only material was there as a missing figure. This question, labor and overheads is there in the missing figure area. Clear with this, guys? I'm trying to cover all the variety of sums. Just go and update your library of adjustments right now. Previous question, library of adjustments. What did I dictate? Missing figures hyphen material variances. Similarly, write down missing figures hyphen labor and VOHV. What is that? Variable overhead variances. So write on missing figures hyphen labor and VOHV. Labor and VOHV. Yes, let's move on to the last question. Yes, no matter how you start, finish it like Dhoni. Yes, let's do this, guys. This was tested in An MTP of September 2024 attempt, MTP number 1. Okay, every attempt you have 2 MTPs, you know that? Series 1, Series 2 and all. MTP questions generally have a good standard. Nowadays, from 2024 onwards, yes, the new syllabus came in, no? So 2023, the syllabus was introduced. The first attempt was from May 2024. From then onwards, the standard of questions in MTP has significantly increased, and RTP quality has reduced drastically. But suddenly RTP here and there, some questions like that relevant costing question we didn't know, and that break-even point using stocks and all, that came very long back. But anyways, basically guys, some questions here and there, rarely RTP is good, but MTP has a good standard nowadays. Okay, that's why every attempt for your attempt, whenever you're writing, do this MTP 1 and MTP 2 of ICA. Right, you need not rely on anything else. Do that MTP for sure. Quality is very nice. Either, if possible, go to the institute, write it. In a worst case scenario, download, and in your house, exam condition, exam timing, you just do it like that. 145 to 2, do it like that. You know how I practice generally when I was studying? You know, a May attempt especially is very hot, no, during the time. And our luck will always be in such a way that the fan will be in the corner, we will be somewhere else. So literally, I'm not kidding guys, when I practiced MTP in my house, I turned off the fan and I practiced, because I wanted to practice in that condition. I'm not asking you to follow that, your choice. But because in that exam hall, suppose if I'm sweating, now that should not be a distraction for me. I'm not kidding, because I wanted that exam atmosphere when I do it, because exam is just another day, right? If I do it like this today, in the same condition, we will be able to actually crack the exam. This will not serve as a distraction. Always I have this thing in my mind. Hope for the best, but be prepared for the worst. Both things are important. Hoping for the best will give you actually a good motivation to proceed forward. But we all are CAs, correct? You are also future CAs only. So conservatism, prudence, always be prepared for the worst. Both should parallelly happen. You know, when India was facing Pakistan, in Pakistan there was a bowler who was 7 feet tall. There was a bowler who was 7 feet tall. I forgot his name, Asif, or I forgot his name. That guy actually, he was very difficult for Indian batsmen to practice. I mean, to bat, because 7 feet tall, the ball will come from top. So it's easy for him to bounce the ball. He has a very good view. 7 feet is slightly, it's not normal, no? 7 feet is his height. So when he's bowling, Indian batsmen were facing it difficult. You know what they did in the practice net session? They took a stool, and when the in the practice session, they call it as net bowlers and all, they stood on the stool and they bowled, so that these guys will practice in that same situation. And they said that the performance was better in the next match, because now they were actually facing, the ball came from that height. I'm telling you, exam condition, practicing is very important. You need not turn off the fan. At least practice it between 145 to 2. That's very important. Clear? And especially guys, have this habit. 145 to 145 to 5, 145 to 5, 15 minutes la onum panna mudiyadhu. So 145 to 5, no matter what you do, you go for a you go for an outing or do whatever you do, definitely do not sleep. If you sleep during this time, gone. Exam is just another day. You might consciously be aware, your mind will not think. Guys, there are a lot of things about our human body we do not know. It has much more memory than what we think we have in our brain. You know, this nose that we have, no, 3-4 generation back, maybe the same kind of nose structure our grandfather or 4 grandfather might be having it. Do you know? Have you even seen him? No, but it comes in your gene. Or maybe the ear could be the same, or your eye could be the same. Your body has an inbuilt memory. The way you treat your body, automatically it comes in. So this is the reason I'm saying all these things. When I was sitting in your position, one old man came and he would have advised me. I said, boomer. But then I later on realized with my own experience, oh my God, there are, so because we think we know everything, that is the problem of that age. So I'm not saying that you all have that mindset, but I had that mindset honestly when I was at your age. Again, I don't want to sound I'm very elderly and all. I'm not that elderly. I'm less than 30 only. So guys, but when I was thinking that, hey, what this guy is saying, maybe it worked for him, he's preaching something. But there are a lot of things. All of us are human beings. All of us have similar things certain things are similar. Yes, and there are a lot of things which are dissimilar between people, I agree. But we think we know a lot of things, but actually when you get the tight slap of reality, you will get, okay, fine, I should have maybe listened. So that's why I say, so great people learn from their mistakes. Legends will learn from others' mistakes. And I want you guys to be legends. Will you? In the process, I called myself a great person also. I learned from my mistake. No. Okay, guys, coming back. Let's go to question number 16 and let's close it off. Anjul Limited produces a product PECT, which is sold in a 10 kg packet. The standard cost per packet of PECT are as follows. Direct materials 10 kg at the rate of 45. Direct labor 8 hours at the rate of 50. Variable overheads 8 hours at the rate of 10. And fixed overheads per unit, they have given it as 200. Total is given. Budgeted output for the third quarter was 10,000 kg. So all this data has been prepared keeping in mind 10,000 kgs as the overall output, right? Budgeted output. Actual output was how much? 9,000 kg. Actual cost for this quarter is given as follows. So here direct material, actual quantity consumed, actual rate. Labor, actual hours into actual rate. And then variable overheads incurred, figure is given. Fixed overheads incurred, figure is given. Okay, calculate all the variances is being asked in this question. Now guys, read this question. I'll give you a couple of minutes time. Read this question once again. What you need to do. Now I don't think this is a missing figure question. We need to create all the ingredients and keep formula substitution. You guys know how to do. Create the ingredients and keep it. I'll give you 2 minutes time. Ingredients for what? For the entire chapter. All the 4 variances are asked. Single question. All the 4 variances are. No, indirectly what they've done. Material usage price cost. Labor efficiency rate cost. Variable overhead cost. Fixed overhead cost. So only the top figures are asked for these 2. Okay, concession they are giving, it seems. Okay guys, do it. Come on, just do it. Attempt. 2 minutes, I'll give you time. Create all the ingredients and keep. Calculation I don't want only. Just do the ingredients, right? Online folks, pause the video, 2 minutes. Finish it off and that's about it. Guys, for this variable overheads, actual hour, actual rate breakup is not required in this question. Why? They have only asked for the topmost, variable overhead cost variance, fixed overhead cost variance. Variable over cost variance is what? Your basically your standard variable cost, that is nothing but standard hours into standard rate, minus actual variable overheads, actual total figure also you can use. Inside breakup not required. Similarly, fixed overhead cost variance, what is the formula? Absorbed minus actual. Actual totally you can take, guys, correct? Absorbed alone you need to have the breakup and all. So be careful here. That's something that I wanted to tell you, right? Please do it. Now guys, first guys, come on, guys, give your time, please focus here. Now first let's do it on the material side. Materials, actual quantity, actual rate, actual price available. Yes, I need to calculate what? Standard quantity and standard price. Anyone tell me standard quantity how much? 9,000. How did you get? Now guys, it is sold in a 10 kg packet and all these costs are not per kg. They are for 10 kg. Simple. If I am allowed to consume 10 kg of raw material for an output of 10 kg, which means what? For every unit of output, I am allowed to consume 1 kg of raw material. Actually, I have produced 9,000 kgs of output. So for 9,000 kgs of output, I am allowed to consume 9,000 kgs of raw material. Guys, clear with this? Or in other words, 10 by 10 into 9,000. Clear? Guys, any problem here? So standard quantity is how much? 9,000. Clear? What is the standard price? 45. That is given in the question. 45. Actual quantity 8,900. Actual price 46. Compute all the material variances. No problem. Clear? In this question, what is the material mix variance? Not given. Cannot be calculated. There is only one type of raw material. No, guys, it is applicable only if you have more than one raw material, right? I was just playing around, guys, but understand that's nothing but you will have your mix and yield and all only if you have mix of raw materials. Clear? Fine. The next one is regarding labor. With respect to labor, actual hours available, actual rate available, standard rate per hour available. Now standard hours I need to calculate. How much is standard hours? I am allowed to take 8 hours to produce how many kgs of output? 10 kgs of output. To actually produce 9000 kgs of output, how many hours I could have taken? 8 by 10 into what? Into 9000. So 8 by 10 into 9000 gives me 7200. So with respect to my labor area, so actual hours is equal, standard hours, sorry guys, standard hours is equal to 7200. Is everyone clear with this? Guys, I have given all the solution, don't worry, but here are you all understanding the concept here? Yes, how many of you got this? Oh, literally everyone. Okay, very good, very good. The next one, same goes for variable overheads also, no? Guys, variable overheads also, you need the standard hours, standard rate for variable overhead. How much is it? Guys, 10. No, standard rate is 10 rupees per hour. Standard hours with respect to your variable overhead, same calculation. 8 is for 10 kgs. How much is it going to be for 9000 kgs? Guys, correct? No. So even for variable overheads, the standard hours is going to be, it's going to be how much? 7200. Any problem here? No. Napa? Understood? Where understood? Yes. Next, finally guys, they've asked for fixed overheads. Fixed overheads, I need to calculate what? The absorbed fixed overheads. Guys, we need to calculate absorbed fixed overheads. Now how do you calculate absorbed fixed overheads? Here rate and all these things don't use, logically do it. How will you do it? If 200 rupees is the fixed overhead absorption for how many kgs? 10 kgs. For a total of 9000 kgs, how much I would have absorbed? Or in other words, 200 divided by 10, how much is coming? 20 rupees. 20 rupees per kg is the absorption rate. We are using production units method. Guys, clear with this? Rate and all is not given here. So production units method is what we are following. Logically understand, right? So 20 rupees the absorption rate. Multiply it with 9000 units. How much is that? It's going to be 1,80,000 rupees is the directly absorbed fixed overheads. What is the actual fixed overheads, guys? 1,92,000. So clearly you can say Harrison, under or over? 1,80,000 absorbed. Actual is 192. That is under absorption to the extent of 12,000. That's going to be an adverse variance. Guys, clear with this, guys? Right? That's all. Literally, we have computed everything. You can just substitute the figures and arrive at the answers. That's about it. Guys, clear? Wow. With this, guys, we have done this entire chapter and it's completely over in all aspects, guys. Right? Very good. I like the participation from you all. Very good, guys. Very good. Yeah. Now. Library for adjustments. Okay. Thank you. Thank you for reminding. Please write on. Quickly, guys. Let's write on. Missing figures hyphen. Material, labor, VOH and FOH variances. Material, labor, VOH and FOH variances. Okay, done. Now, when we did the first chapter, what is the first chapter? The first basic concepts. I told you there are 3 objectives of our subject, A, B and C. C is what? Control. Under control, I told you cost can be classified as controllable cost, uncontrollable cost. I told you I will tell you this when we are doing our standard costing chapter. You guys forgot, huh? Okay, fine. No, I didn't forget. Let me tell you what that is. Now quickly, guys, let me just tell you. No. Very easy. It's just a theoretical area. Let's say material price variance formula. Standard price minus actual price into actual quantity. Let's say the standard price was 10 rupees. Every kg the purchase manager should have purchased by paying 10 rupees. He actually paid 12 rupees into actual quantity. Let us say 10,000 kgs. Example. Now guys, simple. Every unit he paid how much extra? 2 rupees. Now, Immediately don't go and punish this guy and say, look, because of you, 2,000 rupees, I mean, 2 into 10,000, 20,000 rupees adverse variance, you've pulled down my profit. Go and analyze this 2 rupees. Genuinely speaking, out of this 2 rupees, 0.5 rupee was genuinely because of inflation. When I prepared the budget, I said per kg you were supposed to pay 10 rupees. But during the year, what happened? Genuinely the market forces price increase to the extent of 0.5, genuinely because of the market forces, the price increased. And to the extent of 1.5, it was because of this guy's inefficiency to negotiate properly. Guys, clear with this? In this case, you tell me, this 0.5, is it controllable or uncontrollable? Uncontrollable. It is not in the control of anybody. Guys, correct? Are you all clear with this? Whereas this 1.5, this is actually a controllable cost. So basically, now one step further we will do in real life. Having computed every variance, you don't jump to the conclusion and pounce on the fellow and give him the full credit, or you and on parallelly you will not actually tell him that, look, because of you we have lost so much amount of profit. Bifurcate every variance into controllable portion and uncontrollable portion. Uncontrollable portion not in your control. To the extent of controllable portion, you will actually what? You will punish or reward him. Are you all clear with this, guys? And that is called as the controllable and uncontrollable cost. Are you all clear with this, guys? Are you all understanding it, guys? And that's about this particular chapter. Now, guys, any variance at any given point of time, if we ask, will you be able to answer it? Yes. Should you mug this up? No. Only one thing I asked you to remember. What is that? AH. So only one thing in the entire subject, not chapter, entire subject itself. That too I said, where to the extent possible I gave you the logic. Beyond that, if you do, that's actually very confusing at the moment. Right? Guys, what is your material yield variance? Think, answer. You will get it. Very good. Standard quantity minus revised actual quantity into standard price. Very good. What is your labor efficiency variance? Huh? Standard hours minus actual hours into standard rate. Okay. What is your variable overheads expenditure variance? Who is responsible? Huh? Maintenance department. Good. Standard rate minus actual rate into actual hours. Very good. Now your fixed overhead, your volume variance. Absorbed overheads minus budget overheads. As simple as that, guys. Any variance, and I like that. When I ask you a question, you think, you visualize who is responsible, and then you do it. That is there, no? That is called conceptual understanding. If not, what will you think directly? In which corner of the page, which formula I wrote, I need to mug up? That should not be the way to learn the subject, right? You should think who is responsible and do it. That's conceptual understanding. Excellent, guys. Very good. I hope the online folks, you also, whenever I'm asking you something, you just shout back to the screen. Trust me, you will get back more than what you ever think. Clear with this, guys? So with this, we have completed this beautiful chapter called as standard costing. So please practice, especially those missing figures, sums and all. Please do practice, and I will see you all in the next one. Thank you all so much. Bye-bye.